Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, when you look at the markets these days, it's just wild. We've got free money flooding the globe, we've had cryptocurrencies that seem to come out of nowhere, and then there are the meme stocks soaring to these unbelievable heights. It can feel like pure chaos. So you gotta ask yourself, in a market that seems to have thrown out all the rules, how is anyone supposed to make a rational decision? Well, what if I told you that the answer to today's crazy market wasn't some new high-tech algorithm, but a set of principles that were hammered out almost 100 years ago? Today, we are diving deep into the brand new 7th edition of a truly legendary text to explore the timeless wisdom of security analysis. And this is the book right here. It was first published way back in 1934. I mean, right in the absolute pits of the Great Depression. The authors, Benjamin Graham and David Dodd, basically created the blueprint for what we now call value investing. And its power, the reason we're still talking about it today, comes down to one core idea. That even when everyone else is panicking or going wild with greed, a disciplined, analytical approach can always uncover true value. All right, so here's our game plan. First, we're going to talk about the one problem every single investor has always faced. Then we'll get into why this book is literally called the Bible of its field. After that, we'll break down its most important idea, the massive difference between investing and speculating. We'll take a peek inside the analyst toolkit, see what they're actually hunting for, and then wrap it all up by asking the big question: can these old school ideas really survive in today's market? Okay, let's kick things off with Section 1, The Investor's Timeless Problem. This really gets to the core of why a book like this even needs to exist. Seth Klarman, he's the legendary investor who edited this new edition, and he just nails the challenge right here. I mean, if you've ever felt totally overwhelmed by all the options out there and kind of terrified of making the wrong move, you're not alone. That feeling? That's always been the central problem for anyone trying to invest their money. The real trick, then and now, is figuring out how to cut through all that noise with some good old-fashioned discipline and reason. So, how did this book become the guide for generations of investors? Well, its reputation isn't just about its age. It's about the absolute titans of the industry who swear by it. And of course, you can't even begin to talk about this book without bringing up its most famous student, Warren Buffett. I mean, he didn't just read it. He actually studied under Benjamin Graham at Columbia. He's called Graham the second most influential person in his entire life, right after his own father. So when the most successful investor in history says your book is the cornerstone of everything he does, yeah, you probably ought to pay attention. And look, it's not just the old school legends. This praise comes from the very heart of the modern financial system. Jamie Dimon points out that even though the markets are always changing, these bedrock principles are constant. The game might look different on the surface, but the fundamental rules of value, they're exactly the same. You know, the hedge fund legend Stan Druckenmiller makes such a key point here. This isn't about being stuck in the 1930s. It's actually the complete opposite. The discipline that Graham and Dodd teach isn't a rigid set of rules. It's more like a stable foundation that gives you the confidence to adapt and evolve, no matter what crazy thing the market does next. If you look at the history of this book, you start to see a really fascinating pattern. The first edition, born out of the Great Depression. The 6th edition comes out right after the 2008 financial crisis. And now, this new 7th edition lands after a global pandemic, the meme stock craze, and crypto meltdowns. It's almost like whenever the market feels the most unhinged, people reach for Graham and Dodd to find their footing again. Okay, so its authority is rock solid. Now let's get into the single most important idea in the entire book. It's a distinction that defines the whole philosophy, and you find it right there in Chapter 4. Which is all about the difference between investment and speculation. And this table just lays it out so perfectly. For Graham and Dodd, it was simple. An investment is something that after you've done a ton of analysis, promises two things: safety of your initial money and a decent return. Anything else, anything that doesn't meet that strict test, is speculation. And this has nothing to do with stocks versus bonds. You can speculate on the safest blue chip company if you buy it at a crazy price without doing your homework. It's all about your mindset and your method, not what you're buying. So how does an investor actually know if their money is safe? Well, they do it by calculating something Graham and Dodd famously called intrinsic value. Now, this isn't some magical secret number. It's a logical, educated guess about what a business is really worth, based on cold, hard facts, its assets, its earnings, and its future. The entire job of the analyst is to figure out that value and then compare it to the price tag the market is putting on it today. So how in the world do you actually find that intrinsic value? Let's pop the hood and take a quick look inside the analyst's toolkit. It's a really deep, almost forensic kind of process. The book basically walks you through this deep dive into a company's financial reports. And it's not about just glancing at the headline earnings number. Nope. You start with the income account, and you pick it apart to find the real, sustainable earning power of the business. Then you move over to the balance sheet to figure out what the company actually owns. And the really crucial part is connecting those two things. And trust me, this is not just some dry academic theory. The book is jam-packed with real-world warnings. Chapter 33, for instance, is basically a masterclass in how to spot shady accounting tricks. Graham and Dodd were so clear on this. Reported earnings are often just someone's opinion, not a hard fact. Your job as an analyst is to be a detective, to cut through all the fluff and find out how much the company is really making. So after you've dissected the earnings, you turn your attention to the balance sheet. Why? Because the stuff a company owns gives you a fundamental floor to its value. By looking at what the assets are worth, an analyst can guess what the company might be worth if it were just shut down and sold off for parts. This gives you a hard, factual anchor for its value. And that's the key to what Graham called the margin of safety, the absolute bedrock idea of buying something for way less than you've calculated it's worth. It's your cushion against bad luck, or being wrong, or just the day-to-day craziness of the market. Okay, let's get to the payoff. After all of this painstaking work, digging through financial statements, what's the actual end goal? This is where all that detective work finally pays off. So think about it. You've done the work, you've read the reports, you've crunched the numbers, you understand the business inside and out. What's the reward? What's the one thing you're hoping to find? And there it is, right there in Chapter 50. This is the whole shebang. The entire point of all this work is to find a gap, a big discrepancy between the market's emotional price and the business's real calculated value. It's about finding those moments when fear or greed causes the market to offer you $1 worth of a business for, say, 50 cents. All of that analysis leads to this one single moment of opportunity. All right, for our final section, let's circle all the way back to the beginning. Does any of this 90-year-old wisdom actually still work? I mean, in a world of high-speed trading, social media hype, and digital assets, isn't this kind of slow, deep-dive analysis just obsolete? Well, in his new preface, Seth Klarman argues that this framework is actually more essential now than ever before. Yeah, the specific assets might look different today, but those core principles, they don't change. The discipline of asking, what is this business really worth, and am I getting a margin of safety, becomes this timeless lens you can use to analyze anything, whether it's a railroad stock from the 1930s or a brand new cryptocurrency today. And that really is the big idea to leave you with. You know, so much of our modern financial world feels like it was designed to encourage speculation, to reward speed and hype over careful analysis. But maybe that's the very thing that creates the biggest opportunities for the people who are willing to be patient, to be disciplined, and to follow the timeless path laid out by Graham and Dodd all those years ago. Maybe, in an age of constant noise, the search for true value is the most radical idea of all. Welcome to The Explainer. Today, we're digging into something absolutely central to finance: security analysis. We're going to get into what it is, what it isn't, and that all-important hunt for a company's real, true worth, what we call its intrinsic value. All right, so here's the game plan. First, we're going to take a trip back in time to a pretty wild market crisis that, honestly, changed investing forever. Then we'll break down what an analyst actually does day to day. After that, we'll get into the big one, this almost mythical idea of intrinsic value. We'll look at real-world examples, figure out why it's so darn hard to pin down, and finally, we'll draw a really sharp line between smart analysis and just, well, risky speculation. You know, to really get why solid, rigorous analysis is so crucial, we've got to go back. I'm talking about a time when the whole idea was put to the test, thrown out, and pretty much left for dead during one of the craziest periods in the history of the market. Okay, just look at the story this timeline tells. It's fascinating. Over on the left, before 1927, you've got security analysis starting to get some real respect. But then, bam, we hit the new era, the roaring 20s. And suddenly, analysis based on cold hard facts, it gets tossed right out the window for this pseudo-analysis that was all about justifying insane speculation. That was the first hit. But the second punch, the real knockout blow, came after the '29 crash. The economy just cratered so badly that even good, solid companies saw their actual tangible value just evaporate. So sound analysis seemed totally pointless all over again. I mean, what a devastating 1-2 punch. So, coming out of that chaos, what does a disciplined analyst even do? I mean, what's in their toolkit? How do they cut through all that noise and confusion in the market? Well, it really comes down to 3 main jobs. Think of it like this. First, there's the descriptive part. This is just pure detective work, right? You're gathering all the important facts, laying them out nice and clear. Second, you have the selective function. And this is the big call. Based on everything you found, do you say buy, sell, or hold? And then finally, you've got the critical function. This is where the analyst puts on their skeptic's hat, questioning absolutely everything, from the accounting practices to whether the management team actually knows what they're doing. And all 3 of those things, the describing, the selecting, the critiquing, they all point to one thing, one central mission. You could even call it a quest to find a security's intrinsic value. Okay, and this is maybe the most important distinction we're going to make today. Intrinsic value is not the price you see flashing on your screen. Not at all. That market price can get pushed around by hype, by fear, by pure manipulation. No, intrinsic value is the value that's justified by the facts, the company's assets, its ability to earn money, its dividends, and what it can realistically do in the future. It's what the business is actually worth, deep down. But, and this is a big but, here's the real challenge. A market price? That's definite. You can look it up in a second. Intrinsic value, though, man, it is elusive. It's not some single perfect number just waiting for you to calculate it. The analyst's job isn't really to find an exact figure. It's more about figuring out a reasonable range of what something is worth. And the way we think about this has totally changed over time. The old school view was that intrinsic value was just the company's book value, its net assets. But that turned out to be pretty much useless since market prices didn't seem to care about it. The newer, more modern way of looking at it is that value really comes from its earning power. But of course, that has its own huge problem. You have to be pretty confident about what it's going to earn in the future, and, well, we all know how hard that is to predict. I know this can all sound a little academic, a bit abstract, so let's make it super concrete. Let's look at some actual examples where the market price and the calculated intrinsic value were just worlds apart. All right, let's kick things off with a couple of bonds. On the one hand, you've got this bond where the company is barely earning enough to cover its debt payments. It's like a rickety, swaying rope bridge. There is zero room for error, no margin of safety, as they say. An analyst would take one look and say, no thanks. But then, on the other hand, you've got a bond from a company that was earning many, many times what it owed in interest, even during a depression. That's a solid stone bridge. The value is obviously there, making it a clear buy. Now, that's bonds, but let's check out a stock example that's even more mind-blowing. All right, picture this. The year is 1922. You can buy one share of a company called Wright Aeronautical for just $8. Now, here's the crazy part. The company had more than $8 in cold, hard cash for every single share of stock. Just think about that. A sharp analyst would see that you're literally paying $8 to get $8 in cash, and they're throwing in the entire aviation business, the factories, the patents, all of it, for free. The intrinsic value was just massively, undeniably higher than the market price. Okay, now let's jump forward just a few years. It's the peak of the market in 1928. And that exact same stock is now selling for a whopping $280 a share. So what did the analysis show then? Well, the facts were pretty clear. The price had completely disconnected from reality. With the company still earning around $8 a share, that $280 price was built on nothing but pure speculative hype about the future of flying. The intrinsic value was now way, way, way below what people were paying for it. And this right here shows you just how tricky trying to nail down earning power can be. Take this company, J.I. Case. Sure, you can do the math and find a simple 10-year average earning of about $9.50 a share, but just look at the actual numbers. The earnings are all over the place, from a huge profit one year to a massive loss the next. That average number, it's a total statistical illusion. It tells you absolutely nothing useful about what the company's actually going to earn next year. This is where analysis really bumps up against its limits. So you might be thinking, if it's possible to find these massive gaps between price and value, why isn't everybody rich? Why isn't everyone doing it successfully? Well, it's because every analyst, no matter how smart, is up against 3 huge unavoidable roadblocks. First off, the data you're working with can be incomplete or even flat out wrong, sometimes because of sneaky accounting or companies trying to hide things. Second, and this one's a much bigger deal, is the simple truth that the future is just unpredictable. Any conclusion you draw from the past can be completely wiped out by something new. And finally, maybe the biggest obstacle of them all is that the market itself just doesn't always act rationally. So, all of this leads to a really critical point. You have to separate disciplined, fact-based analysis from pure, hopeful speculation. And that brings us to one of the most famous and powerful metaphors in the entire world of finance. I want you to really think about this for a second. In the short run, the stock market is not a weighing machine. It doesn't act like some precise scientific scale that perfectly weighs all the facts about a company, its earnings, its assets, its debt, and then spits out a perfectly rational price. No, instead, you should think of it like a giant voting machine. It's basically a popularity contest. Every single day, millions of people cast their votes with their money, their buys, and their sells. And those choices are a mix of cold, hard logic and powerful, raw human emotion. Things like fear, greed, and just pure excitement can easily overwhelm the actual facts. This chart here does a great job of visualizing that whole conflict. Just follow the flow from the left. You've got two rivers flowing into the market. That bottom river represents the investment factors. This is the hard data the analyst works with, earnings, assets, that stuff. But the top river represents speculative factors, market gossip, psychology, pure guesses about the future. Both of these rivers merge and influence the public, which creates the buying and selling that ultimately sets the market price you see over on the right. The analyst lives in that bottom river, but they are always fighting against that powerful current of speculation from the top. It's kind of like playing roulette. A speculator is making a big bet on a single spin of the wheel. On one spin, having a tiny analytical edge means nothing against pure luck. But the analyst is playing a totally different game. They're spreading their bets out over thousands and thousands of spins. And over that long period, that same small edge pretty much guarantees success. And that is the key takeaway here. For the analyst, the edge isn't trying to predict the short-term vote of the market. It's about knowing the long-term weight of the business. It's all about playing the long game, where eventually the facts tend to win out. So that leaves us with a final question for you to think about. When you look at the market, do you see a weighing machine or a voting machine? Are you focused on figuring out a company's true weight, its real intrinsic value? Or are you just trying to guess how the crowd is going to vote tomorrow? Every single day, investors are making decisions worth billions and billions of dollars. But what are those decisions really based on? Today, we're going to dig into the absolute core elements of security analysis. We're going to break down how you actually evaluate an investment by looking at both the hard numbers and, just as importantly, the crucial stories that those numbers can't always tell. At the end of the day, all the research, all the fancy spreadsheets, it all comes down to this one simple question, right? Buy, sell, or hold. It is the ultimate goal of any analysis. So where in the world do we even start to find a reliable answer? Well, the good news is we don't have to just guess. We can actually build a framework. We can create a clear, logical path that helps us get to a solid decision. It turns out that any investment decision, whether you realize it or not, really involves these four fundamental factors. It's about the thing you're buying, the security. It's about the price you pay for it. It's about the moment in time you're doing it. And maybe most importantly, it's about who you are as an investor. So let's dive into these four factors because it is so much more than just the company itself. A typical analysis obsesses over the security, but completely ignoring the other three can be, and often is, a disastrous mistake. Let's start with the background factors. First, you. You, the investor, are always part of the equation. Your financial situation, your personality, your temperament, they all determine what makes sense for you. And of course, timing is a huge deal. A great opportunity one month can be a terrible one the next. Now, while these background factors are absolutely vital for today, we're going to focus on the core principles of analysis that hold true no matter who you are or what day it is. And this right here, this is one of the most important ideas in all of investing. I mean it. Price is not just some detail. It is an integral part of the analysis. You could buy the best, most wonderful company in the world, but if you overpay for it, you've made a bad investment. Simple as that. And this danger is especially true when it comes to common stocks. Okay, let me show you a perfect example. This AT&T bond from 1929. The company was a titan, an absolute giant. The bond was considered rock solid. But look at this chart. Investors who bought at the peak price of $227 were paying a massive, massive premium. And even though the bond itself was safe, the price was so inflated that the investment lost over half its market value. The quality of the security couldn't save them from the foolishness of the price they paid. So how do we avoid a trap like that? Well, to get there, we need to completely reframe the entire problem. Let's shift our perspective and use a much more powerful framework. So we're going to shift from asking, in what security at what price, to a much, much better question. In what enterprise and on what terms? Now look, this isn't just playing with words. It's a profound change in thinking. Enterprise captures the quality of the business itself, while terms covers the whole deal. The price, yes, but also any protections you have, your claim on assets, everything. Now this is where it gets really interesting, watching how these two ideas can clash. Back in 1929, New York City real estate seemed like the safest enterprise on earth. But the terms on this particular stock, they were awful. You were behind a huge mortgage, facing high costs, and getting a tiny return. Now contrast that with a bond for a struggling elevated railroad in 1932. The enterprise, not so hot, but the terms, they were fantastic. You had first dibs on earnings and a huge potential yield. The terms of the deal can absolutely trump the reputation of the industry. So all this leads to a really crucial principle for, say, the average investor. If you can't do the deep, nitty-gritty analysis to really evaluate the terms, your best defense is just to stick to high-quality enterprises. It's a simple rule of thumb, and it's designed to protect you from what you don't know. But, and this is a big but, for the serious analyst, the principle is the exact opposite. They understand that a good reputation isn't enough. Their job is to find value, and that means recognizing that almost any security can be a brilliant investment at the right price or a terrible one if the terms are wrong. Okay, so this whole discussion about enterprises and terms brings us right to the two sides of analysis that every investor has to master: the hard numbers and the story that's hiding behind them. So quantitative analysis, that's all about the figures. It's the earnings record, the balance sheet, stuff you can measure. Qualitative analysis, on the other hand, is about judgment. It's the character of the management, the company's competitive position, and, as we're about to see, the inherent stability of the business itself. And you absolutely, positively need both. All right, let's put this to the test with a real case study from 1932. If you just look at the numbers, the preferred stock for Studebaker looks way better than First National Stores. Its dividend coverage averaged 26 times, which just crushes First National's 6 times. The quantitative data here is telling a very, very clear story. So, based on these numbers alone, the decision seems pretty easy. Studebaker looks like the far safer bet. But is it? This, my friends, is a classic trap for anyone who relies only on the statistical exhibit. And here's the story the numbers didn't tell you. First National was a grocery chain, a business with incredibly stable demand, because, well, people always need to eat. Studebaker, on the other hand, was a car company, an industry that lives and dies by the wild swings of consumer taste and economic cycles. Studebaker's stable record was really just an illusion, and it was masking an inherently volatile business. And the result? First National thrived, while Studebaker went into receivership just a year later. The qualitative nature of the business was the real indicator of safety. This leads to a huge warning about one of the most tempting quantitative measures out there: the trend. We all love to see a chart of earnings going up and to the right, and we just can't help but project it out into the future. But that projection, it isn't math. It's a qualitative assumption. It's a psychological bet that the future is going to look just like the recent past. And as we just saw with Studebaker, conditions can change in the blink of an eye. So after all this, what is an analyst's actual job? What's their true north? Let's pull all these concepts together and define their true purpose, finding real value in a world that's obsessed with speculation. Here is the fundamental difference, the thing that separates the two. The speculator's whole game is to predict the future. Their success depends entirely on being right about what's coming next. The analyst's approach is the complete opposite. They are concerned with demonstrable value in the present, supported by facts. For the analyst, the future isn't some wellspring of profit, it's a hazard to be carefully guarded against. And this quote just perfectly summarizes the entire philosophy.
You have to start with the numbers. A strong statistical showing is a necessary condition. It's like your ticket to the game, but it is not sufficient. The numbers alone are not enough. They have to be backed up. They have to be validated by favorable qualitative factors, especially the inherent stability of the business.
And that leaves us with a final thought to chew on. In a market that's completely obsessed with predicting what's next, with forecasting trends and chasing the next big thing, maybe, just maybe, the greatest and most lasting advantage doesn't come from guessing the future, but from thoroughly mastering the value and the risks that exist right here, today, based on the facts right in front of us. Welcome to The Explainer. Today we're going to put on our detective hats. We're diving into a classic guide to see how the best financial analysts uncover the real story behind a company, how they cut through all the marketing fluff to find what's actually going on. So, this is it, right? This is the big question for any investor, journalist, or really anyone who's just curious about a business. How do you find the truth in a sea of press releases and flashy ads? Well, let's jump in and see how the pros follow the breadcrumbs. So, here's our roadmap for this investigation. First, we'll look at how an analyst even starts. Then, we'll get into decoding the reports the company itself puts out. After that, we're going to go beyond their glossy brochures. Then we'll zoom out to see the whole industry. And finally, we'll talk about the ultimate sources of information. Okay, Section 1. An analyst's investigation begins. It's all about laying the groundwork. You can't just start digging around randomly and expect to strike gold. A good investigation starts with a plan. You've got to know what you're looking for before you can find it. According to our source material, it all boils down to 3 key starting points. First, you have to understand the terms of the issue. That's the nitty-gritty of the stock or bond you're looking at. Second, you examine the company's data. What story are they telling? And third, you need the industry context. How do they really stack up against the competition? All right, on to Section 2, decoding company reports. This is where we start following the paper trail. Now we're looking at the most direct piece of evidence there is, the reports the company actually publishes about itself. This is their story, in their own words, and it's ground zero for our investigation. Just how often a company reports can tell you a lot. Back in the day, you might have gotten weekly figures from railroads or monthly sales from retailers. Nowadays, pretty much everyone is on a quarterly schedule. But that rhythm, that frequency, is itself a clue about the pace and the nature of an industry. But of all these different reports, the annual report is the big one. It's the cornerstone. This is the yearly checkup that has the 2 most critical documents: the income account, which shows if they're profitable, and the balance sheet, which is basically a financial snapshot of the company's health. But as you're about to see, not all annual reports are created equal. So what should you be looking for? Well, our guide says a reasonably complete income account needs to have at least these 8 things. Now, this seems pretty basic today, right? But get this. Before the SEC was created, less than half of industrial companies shared even this much information. It was a total black box. And this just shows you the huge difference between the bare minimum and, well, the gold standard. A truly transparent company like U.S. Steel gave you the whole shebang. They didn't just give you dollar amounts, they gave you production and sales in actual units. They broke down expenses into wages and taxes. This wasn't just reporting, it was a masterclass in telling your owners what's going on. Okay, so that's the story a company wants to tell us. But that's just one side of it. The smartest analysts know you have to dig deeper. You have to go find the official, mandatory filings to really get the full picture. And the contrast between these two is just night and day. The report they send to stockholders, you can think of it as a form of marketing. It's curated. It can leave stuff out. But the reports they have to file with public agencies, that's a different animal entirely. Those are mandatory, detailed, standardized, and filed under penalty of law. One's a performance, the other is sworn testimony. Let me give you a perfect case study. For years, this company, Consolidated Gas, was known on Wall Street as the mystery stock. Why? Because they told their stockholders next to nothing, which just led to all kinds of wild speculation. But here's the kicker. The complete financial data was publicly available the entire time. It was just sitting in reports filed with the Public Service Commission. Any analyst who actually did their homework knew the real numbers. And here's another one. The pipeline companies from the Standard Oil Group were famous for being secretive. The reports they gave to shareholders were practically useless, but their mandatory filings with the Interstate Commerce Commission revealed something incredible. They were sitting on a massive hoard of cash and securities, a hugely important piece of the puzzle just hiding in plain sight. Before we had all the modern regulations, one of the best places to find information was in a company's application to be listed on a stock exchange. The exchanges demanded way more detail than companies like to give out, forcing them to reveal things like sales figures and their accounting methods. But then, the creation of the SEC in the 1930s was a total game changer. All of a sudden, that kind of detailed disclosure wasn't a one-time thing you did to get listed. It was the law. Documents like the Form 10-K became the new gold standard, and transparency went from being a choice to a requirement. So even when you have all this great company-specific data, the numbers don't mean much in a vacuum. A great analyst has to understand the entire ecosystem the company operates in, so let's take a look at how they get that bigger picture. To get this context, analysts use a totally different set of tools. We're talking about government publications, census data, and maybe most importantly, trade journals. These are the sources that answer the really big questions. Is the whole industry growing or shrinking? Is the company a leader or a follower? Are they a big fish in a small pond or a tiny fish in a giant ocean?
Okay, we've followed the paper trail from the company's reports to the public records, and we've sized up the entire industry. Now it's time for our final section, the ultimate and maybe most powerful tools in an investigator's toolkit. Now, services from firms like Moody's or Standard & Poor's are without a doubt incredibly valuable. They compile and summarize massive amounts of data, and they save analysts a ton of time. But, and this is a big but, our guide gives a critical warning. A real detective knows there is no substitute for looking at the original evidence yourself. Summaries can miss nuance, and transcripts can have errors. You have to see it with your own eyes.
So, what's the analyst's ultimate secret weapon? You might be surprised. It's simply a direct question. After all that digging through documents, sometimes the most effective tool is to just ask. As a stockholder, you have a fundamental right to ask for legitimate information from the company's management. And this quote right here is the reason why. It says, "It must never be forgotten that a stockholder is an owner of the business and an employer of its officers." Let that sink in for a second. You aren't just a customer, you're an owner. And the officers of the company, they are your employees. This one idea completely reframes the whole relationship. That single idea, ownership, that is the source of your power. It's what gives you the right to demand clarity, to ask the hard questions, and to hold the people running your company accountable for how they're doing. You know, the really incredible thing is that these principles, which come from a guide written almost a century ago, are still the absolute bedrock of good analysis today. We have more data at our fingertips than anyone back then could have ever imagined. What this explainer shows is that the tools have always been there for anyone willing to put in the work. So the real question is, with all this unprecedented access to information, are we asking the right questions? So what is the real difference between investing and speculating? It's one of those questions that sounds simple, right? But getting it wrong has been at the very heart of some of the biggest financial disasters in history. So today, we're going to cut through all the common myths and build a really clear analytical way to tell them apart for good. So how are we going to tackle this? Well, here's our game plan. First, we'll get to the bottom of why the word investment itself is just so confusing. Then, we're going to look at 5 common but totally flawed rules people use to try and separate it from speculation. We'll see exactly why they don't work, and then we'll build a much more powerful definition. And finally, we'll apply it to a really fascinating real-world case study. Let's just kick things off with this cynical but very, very telling definition. This quote really just perfectly captures the confusion we're here to solve. I mean, think about it. If the only way you can tell the difference is by looking in the rearview mirror, you're not analyzing. You're just gambling and hoping things work out. That kind of thinking is dangerous, and it's exactly what we need a better framework to avoid. Okay, let's start by digging into the real root of the problem. The word investment gets used so loosely that it often loses all its meaning, and that leads to some serious confusion and pretty big financial risks. You know, the term gets tossed around in at least 3 different ways. First, you've got the business sense. You invest in a new grocery store, for example. Second, there's the broad financial sense, where Wall Street calls pretty much every security an investment. It's like a catch-all term. But the third use?
That's the one that really matters for us. Investment as the direct opposite of speculation. This is the critical analytical distinction that we really need to pin down.
Now, what's really interesting here is how most people try to make this distinction. Let's take a look at the 5 most common rules of thumb that you've probably heard, or maybe even used yourself at some point.
So here they are. You know the ones: investment is for bonds, speculation is for stocks. Investment is buying outright, speculation is using margin. Investment is for the long haul, speculation is for a quick buck. Investment is for income, speculation is for profit. And of course the big one: investment is safe, speculation is risky. They all seem pretty straightforward, right? But as we're about to see, they're just full of holes.
So, these simple rules might seem logical when you first hear them, but honestly, they completely fall apart under any real scrutiny. So let's just pull them apart one by one and see exactly why.
First up, bonds versus stocks. I mean, this is a classic, but it is dangerously misleading. A bond from some company that's on the verge of bankruptcy, that's one of the riskiest speculations you could possibly make. On the flip side, owning stock in a dominant, stable, and profitable company can be a perfectly sound investment. The key takeaway here: the label on the security, whether it says bond or stock, tells you almost nothing about the actual risk you're taking. Okay, next, let's talk about how you buy something or how long you plan to hold it. Well, get this. The most speculative penny stocks out there can only be bought outright because no one in their right mind would lend you money against them. And conversely, back during World War I, people were actually encouraged to buy ultra-safe Liberty bonds on margin, and you wouldn't call that speculating. Your intention to hold something for the long term doesn't magically make a terrible purchase a good one either. And that brings us to our last 2 myths: income versus profit and safety versus risk. Now, these get a little closer to the heart of it, but they fail for one huge reason. What does safe actually mean? I mean, in the run-up to the 1929 crash, investors felt perfectly safe, buying stocks at insane prices, totally convinced that future growth would justify anything. Their feeling of safety was based on market psychology, not objective analysis. And that right there is the fatal flaw in all of these rules. All right, so now that we've kind of cleared away the myths and all those flawed rules of thumb, we can build a definition that actually works, one that's grounded in serious analysis, not just popular opinion or what the market's feeling that day.
Here it is. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Now, did you catch that crucial word there? Operation. The definition is not about a type of security. This is so important. The very same stock can be an investment one day and a total speculation the next.
So let's break this down into its 3 essential pillars. First, thorough analysis. This means you've actually studied the facts and you've measured them against established standards of value and safety, not just wishful thinking about the future. Second, promises safety. Now, this doesn't mean zero risk. It means you're protected against loss under any normal or reasonably likely scenario. And third, a satisfactory return. This is whatever return you, the intelligent investor, decide is acceptable after you've done all that hard work. And this brings us to the single most important variable that all those other rules just completely ignored: the price you pay. A wonderful company can be a terrible investment if you overpay for it. Quality alone is not enough. The price absolutely must be justified by the numbers, by the analysis. So let's see how this all plays out with a fascinating real-world example from way back in the 1930s. It just brilliantly shows how price, and price alone, can turn the exact same stock from a wild speculation into a rock-solid investment in just a matter of weeks. Okay, so here's the first scenario. It's December 1934, and General Electric's high-quality preferred stock was selling for $12.75 a share. But here's the catch. GE could buy it back at any time for just $11. So anyone buying at $12.75 was making a pure speculation. They were consciously betting over 10% of their money that the company wouldn't decide to just call the stock away from them. And can you guess what happened? That very same month, GE announced it was calling the stock for redemption at $11. So everyone who bought at that higher price instantly faced a guaranteed loss. The speculation failed. Simple as that. But then, the situation completely flipped on its head. After the call was announced, the price of the exact same stock dropped to $11. And now, buying it was no longer a speculation.
Why? Because you knew with absolute certainty that in 3 months, GE was contractually obligated to pay you $11 plus a final dividend. The risk of losing your principal? It had just vanished. And this is where it gets really cool. Let's just look at the numbers real quick. You could buy 100 shares for $1,100. You knew for sure you'd get that $1,100 back, plus the dividend in 3 months. By using margin, you only had to put up a fraction of the cost, let's say $100. The guaranteed profit you made on that tiny bit of capital resulted in a completely safe return that worked out to 40% per year. This wasn't a bet, it was a textbook investment operation defined by analysis and a guaranteed safety of principal. So what's the ultimate lesson here? It really forces us to adopt a whole new way of looking at things. It's not about the asset, it's not about your intentions, it is all about the analysis you do at a specific price. So let's explore the final implications of this really powerful mindset. An analyst using this framework might look at a stock's price and break it down into 2 different parts. For example, through their analysis, they might figure out that a company is worth $25 a share based on its real assets and earnings. That's its investment value. But if the stock is trading at $38, that extra $13, that's the speculative component, the price the market is putting on future hopes and unproven ideas. And just knowing you're paying that premium is absolutely essential.
Now, this doesn't mean that all speculation is bad or that you should avoid it. The key is to know the difference between 2 types. Intelligent speculation is when you've done the work, you understand the probabilities, you know the risks, and you take a calculated chance. Unintelligent speculation is just gambling. It's taking a risk without doing the analysis or even understanding the odds you're facing.
And this all leads to a really provocative, even kind of a radical conclusion from our source. If an investment requires safety of principal based on established, analyzed value, well, then it follows that most of the time, even the best companies have to be considered speculative purchases. And why? Simply because their market price is just too high to be justified by anything other than future hopes. Now, our source is pretty upfront that this viewpoint is definitely not the prevailing opinion on Wall Street, where high-quality companies are often called investments, no matter what the price is. So the final question I want to leave you with is this. After seeing the logic and the evidence, who do you think has the stronger argument? The traditional rules of thumb or this rigorous price-conscious definition? So you think you know the difference between a stock and a bond, right? I mean, one's ownership, the other is a loan. Pretty simple. But what if I told you that for the better part of a century, some of the sharpest minds in finance have been arguing that this simple distinction isn't just wrong, it's actually dangerous, and that not getting it could be costing you? Let's dig in. Okay, so here's our roadmap. We're going to start with the classic textbook definition, and then we're going to see why investing legends Graham and Dodd basically said, nope, that's not good enough. From there, we'll check out their much better classification system, we'll unpack the forgotten difference between investing and speculating, and we'll wrap it all up with some timeless lessons that, honestly, feel more relevant today than ever. All right, first things first, let's get on the same page. This is the conventional wisdom, the stuff you learn in Finance 101. It's the foundation for how most of us are taught to think about all this. So, on one side, you've got the bondholder. Think of them as a creditor, a lender to the company. They've got a fixed prior claim on everything. What this means is they get paid first. And in exchange for giving up a shot at those huge company profits, they get a much higher degree of safety. Now, on the other side, you've got the stockholder. They're a partner, an owner. They're the ones taking on the major risks of the business. But in return, they get to share in all the profits. See? It's a pretty clear line in the sand. Safety versus opportunity. I mean, that separation sounds great, doesn't it? It's clean, it's logical, it makes sense. But according to Benjamin Graham and David Dodd, the guys who literally wrote the Bible of investing, security analysis, this simple view has some really, really big problems. And look, Graham and Dodd weren't just arguing over semantics here. They truly believed that blindly trusting these labels, bond or stock, was a recipe for disaster. They laid out 3 huge objections to this whole way of thinking. First up, we've got the problem with preferred stocks. Now, legally speaking, a preferred stockholder is a partner, an owner, just like a common stockholder. But here's the thing. Do people buy them to be partners? Not at all. People buy preferred stocks for the exact same reasons they buy bonds, for a fixed, steady income and for the safety of their principal. So their purpose is that of a creditor, even though their legal title says they're a partner. The label just doesn't match the reality of why you'd own it. Okay, the second objection is where things get even more serious.
The conventional view has this dangerous habit of equating the form of a bond with the idea of safety. It leads investors to believe that the word bond itself has some kind of magical protective shield around it. And that, Graham and Dodd argue, is a fundamentally unsound way to think that has led to a ton of financial pain over the years.
And here is the crucial point, right from the source. They argued that a security's safety has absolutely nothing to do with what it's called. A bond from a company that has no assets and no earnings is just as worthless as its stock. What creates safety is one thing and one thing only: the company's financial strength and its ability to pay its bills. That's it. And their final objection? Well, it's that the world of finance is just messy. You see, over the years, a whole zoo of securities has been created that just don't fit into those two neat little boxes. They have all these mixed features that blur the lines between debt and equity, making the simple labels of bond or stock completely useless. And this is where it all gets really tangled. The financial world is just filled with these hybrid creatures that are impossible to classify easily. You've got income bonds, convertible bonds, bonds that come with stock warrants. You even have preferred stocks that act more like common stocks. And the most famous case of all, the Great Northern Railway preferred stock. Guess what? It was a preferred stock in name only. It was actually just common stock. Now imagine buying that based on its title. You would have been completely blindsided by the risk you were actually taking. So, you're probably thinking, okay, this is a mess. How do we make sense of it? Well, Graham and Dodd didn't just point out the problems. They came up with a solution. They proposed a completely new way of looking at securities, one based not on legal names, but on practical reality. Their solution was just so elegant and powerful. They said, forget the title, just ignore it. Instead, ask a much smarter question. How is this security likely to behave once it's in my portfolio? What are its actual risk and profit characteristics? The whole focus shifts from what a security is on paper to what it actually does for your money. And this right here is where their genius really comes through. They propose this whole new framework that just cuts through all the noise. They broke the entire universe of securities down into three main types, based entirely on how they're likely to behave for you. You've got your fixed value type, where safety is everything. Then there's the variable value type, for things with more risk and more upside potential. And finally, the common stock type, for anything that gives you a piece of the unlimited profits of ownership.
Okay, let's break that down into plain English. Class I is basically your high-grade investment quality stuff, the bonds and preferred stocks where your number one priority is getting your money back. Class 2 covers the more speculative senior securities, think lower-grade bonds or convertibles, where you're taking on more risk hoping for a bigger payoff. And Class 3, well, that's anything that acts like a common stock, no matter what its name is, because its value is tied directly to the future profits of the business.
Now, to really get this, we need to understand a crucial point that the great modern investor Howard Marks brings up. The very meaning of the word investing has changed a lot since Graham and Dodd were writing. You see, back in 1940, investing wasn't just a generic term for trying to make money. It was a very specific activity. It meant buying assets that were, by their very nature, conservative, prudent, and safe. Everything else, well, that wasn't investing. That was called speculating. Today, we call pretty much any purchase for financial gain an investment. But back then, that distinction was absolutely critical.
This incredibly sharp observation from John Maynard Keynes just perfectly captures the danger Graham and Dodd saw. When you buy a sketchy company's security just because it has the word bond in the name, you think you're being a safe investor. But in reality, you're being a speculator, running a risk you don't even see. The misleading label has tricked you into becoming an unaware gambler.
So, what's the big takeaway here? Why are we talking about these 80-year-old ideas? Well, it turns out their core principles are more vital than ever in the crazy complex markets we have today. You know, while some of their language can sound a little rigid or old-fashioned today, Howard Marks points out that at their heart, Graham and Dodd were true pragmatists. They weren't about memorizing a bunch of rules. They were about logical analysis, and they insisted that investors look at the substance of a company, what's really there, not just its form or its label. And this all boils down to some timeless principles that every single one of us can use. First, remember that picking bonds is a negative art. Your main job is to avoid the losers, not to pick the absolute biggest winners. It's about playing defense.
Second, always prioritize substance over form. A solid company's simple unsecured bond is way safer than a shaky company's super secure sounding mortgage bond. In today's market, that means looking past the hype of a new crypto asset or a hot SPAC and asking, what's the real underlying business value here? Third, you've got to evolve. The standards that worked 10 years ago might not be enough today. You have to be flexible. And finally, and this is the big one, it all comes down to the relationship between risk and return. The label on the security is just noise. The real work, the real value is in doing the analysis. Which brings us to our final thought. In a world that is now filled with complex derivatives, structured products, and cryptocurrencies, things that totally defy easy categorization, isn't this 80-year-old lesson to ignore the label and analyze the substance, the actual risk and profit behavior, isn't that the most important lesson of all? It really seems like Graham and Dodd weren't just writing for their time. They were giving us the tools we'd need for the future, way back in 1940. Welcome to The Explainer. Today, we're asking a pretty fundamental question. When you buy a so-called safe investment, like a bond, what exactly makes it safe? We're going to dig into an idea that says the most common answer to that question is just flat out wrong. All right, let's just jump right in. What is the true source of a bond's safety? When push comes to shove and things go sideways, what's the one thing you're counting on to make sure you get your money back? If you ask most people, they'll give you the same answer. It's the lien, the legal claim on the actual physical property, the factory, the railroad, the power plant. That's the collateral, right? That's the guarantee. But here's where it gets really interesting. Our source material today makes a pretty shocking claim. This whole idea, this bedrock concept of the lien being your safety net, is mostly a complete fallacy. Now that's a statement that should make you sit up and pay attention. So let's unpack that. Why would this supposed guarantee of safety be nothing more than an illusion? Why can't you just count on the property that you have a legal claim on? Well, the argument is that this reliance on a lien is basically a trap. Sure, the right to seize property if the company defaults sounds amazing in theory, but in the messy reality of corporate finance and bankruptcy, it almost never works out that way. And it really boils down to three big problems. First, the value of those assets you have a claim on, it can shrink dramatically. Second, actually enforcing your legal right to take them is way harder than you think. And third, the whole process is just bogged down by these long, exhausting delays. This is so critical to understand. The value of a company's property isn't some standalone number. A railroad line is only valuable because a successful railroad is running trains on it. A factory's value comes from the profitable business being done inside. So when the business itself fails, the value of all its specialized stuff just evaporates. And here is just a perfect, painful example of that in action. This was a first mortgage bond. We're talking the highest ranking, most secure claim you could possibly get on a brand new railroad. And yet it ended up trading for a penny on the dollar. Why? Because a lien on empty railroad tracks is pretty much worthless. Okay, but let's say the property actually is still worth something. Now you run into problem number 2, enforcement. See, unlike with your house, courts are really hesitant to let one group of creditors just come in, foreclose on the assets, and shut the whole company down. That would wipe out everyone else, other bondholders, stockholders. The whole legal system is built to try and reorganize the company, not let you walk away with the keys. And all of that leads to the third killer, delay. These corporate bankruptcies can drag on for years, and the whole time your money is tied up, the value of your bond is getting crushed on the open market, and you're just stuck in limbo. That is the complete and total opposite of the peace of mind a safe investment is supposed to give you. So, if the lien is an illusion, then what's real? How are we supposed to actually measure safety? We need a completely new framework. And here it is. True safety isn't found in a legal document. It's found in the financial strength of the company itself. It's simply the ability of that company to pay its debts. But, and this is the most important part, you can't measure that ability when times are good. You have to test it under the absolute worst-case scenario, in the middle of a depression. This whole philosophy gives us 4 new rules to live by. Number 1, safety is all about the ability to pay. Forget the lien. Number 2, you have to measure that ability during hard times. Number 3, you can't let a higher interest rate trick you into buying a risky bond. That's not investing. That's speculating. And number 4, you have to be disciplined about it.
with strict, numbers-based rules. Okay, so once you really start to embrace these principles, you end up facing some really fascinating and kind of counterintuitive choices. It makes you look right past the fancy labels on a bond and focus on what really matters, the health of the underlying business. So think about this classic dilemma. You've got two options. Option A is a first mortgage bond, secured by a lien, but it's from a pretty shaky company. Option B is a debenture, an unsecured bond, but it's from an absolute financial powerhouse. Which one is actually safer? Well, according to this new framework, it's not even close. The unsecured bond from the strong company wins every single time.
And hey, this isn't just a thought experiment. Check out this real-world example from 1930. We've got two different utility bonds, both selling for the exact same price. One is from Pacific Power. It's a secured first mortgage bond. The other is from American Gas. It's an unsecured debenture. On the surface, you'd think the Pacific Power bond is the safer bet, right? But then you look at the true measure of safety, the actual ability to pay the bills, and the picture completely flips. American Gas and Electric, the company with the unsecured bond, was earning enough money to cover its interest payments more than 2.5 times over. Pacific Power, barely 1.5. The superior financial muscle of American Gas made its simple promise to pay far more valuable than Pacific Power's lien. Now, this logic doesn't just work when you're comparing two different companies. It also creates some really interesting situations when you're looking at bonds from the very same company. I mean, should you automatically just buy the most senior bond? Or could there be a time when the junior bond is actually the smarter move?
Let's take a look at this really cool table for the Atchison Railway. It shows the prices for its senior bond, the General Fours, and its junior bond, the Adjustment Fours, over a bunch of different years. The column you really want to watch here is the one on the end, the spread. That's the price difference between the two bonds. And this chart just tells the whole story. Look what happened during the panic in June of 1932. The market completely freaked out. The price gap between the senior and junior bonds exploded to over 14 points because everyone was desperately running for what they perceived as safety. But an investor who actually understood that Atchison was a fundamentally strong company knew it could easily support all of its debt. They could have bought that junior bond at a huge discount. And sure enough, by 1936, the panic subsided and that spread shrank to almost nothing. It's a classic case of fear creating opportunity. So where does all this leave us? What's the big takeaway? It really leads to this profound shift in how you think about investing. It's a move away from trying to pick winners and a move towards a much more defensive, disciplined game plan. This quote from Walter Bagehot just captures the whole idea perfectly. Choosing fixed value investments is a negative art. It's not about the brilliant things you say yes to. It's all about having the discipline to say no to anything and everything that gives you even the slightest bit of doubt. Think about it. With a stock, your potential upside is unlimited, so maybe taking a bit of risk makes sense. But with a bond, your return is capped. Your best case scenario is getting your interest and your principal back. So your primary job is not to maximize your gain. Your primary job is to eliminate, as much as humanly possible, any chance of loss. You win by not losing.
And that really leaves us with one final question to think about for yourself. When you look at your own portfolio, and especially the parts you count on to be safe, what's your real goal? Are you chasing a little extra yield, hoping to win? Or have you built a portfolio that is designed, first and foremost, not to lose? Because the answer to that question changes absolutely everything.
All right, let's dive right in. In this explainer, we're digging into some absolutely timeless wisdom on how to select safe, fixed-value investments. We're going to unpack two core principles from a classic text that, honestly, are just as crucial for investors today as they were decades ago. So, let's kick things off with a big question. I mean, if you could only apply one single test to figure out if a bond or any fixed-value investment is truly sound, what would it be? What's that one non-negotiable hurdle it absolutely has to clear?
And the answer? Well, it's incredibly simple, but it's also really, really powerful. Any sound investment has to be able to survive a depression. That's it. That's the bottom line. That is the ultimate acid test.
So, this really gets us to our first big idea, the investor's acid test. Look, it's easy for any investment to look like a winner when the economy's flying high, right? Everything looks good. But that strength is just an illusion if it can't handle the bad times. The true quality of an investment only shows up when it's put under some serious stress. Now, investors tend to fool themselves into thinking an investment is safe in a couple of common ways. The first is this idea of safety by industry. The belief that a whole category, like public utilities, is just inherently depression-proof. The other is safety by protection, the idea that a specific company has such a massive financial cushion that it can just absorb any hit. As we're about to see, both of these assumptions can be pretty dangerous.
And here's the kicker. The simple, hard truth is that no industry is actually immune to a serious economic storm. And once you really accept that any business can suffer, it forces you to look past the industry's general reputation and really dig into the specific company's ability to withstand the pain.
Okay, so this sets the stage perfectly for our next section, a tale of three industries. The source material we're looking at treats the Great Depression of the 1930s as a kind of real-world laboratory test. It was the ultimate opportunity to see which investment ideas held up and which ones just completely fell apart under the most extreme pressure you can imagine.
So to really paint a picture here, think about this. Back in 1929, at the very peak of the Roaring '20s, the net income for America's railroads was over $1.2 billion. You couldn't get more blue chip than the railroads. They were an absolute pillar of the economy.
Okay, now fast forward just 3 years, a blink of an eye really, into the depths of the Depression. By 1932, that massive number had collapsed to just 326 million. That is just a jaw-dropping decline that showed how vulnerable even the most established giants could be.
And you can really see the whole story unfold right here in the data. Just follow that column for net railway operating income for the railroads. See that cliff it falls off of from 1929 to 1932? But now, slide your eyes over to the net index for public utilities. Big difference, right? Yeah, it dipped, but look at how much more stable it was. It's a masterclass in relative strength.
So what's the takeaway from all this? Why did so many of these bonds fail? Well, it wasn't for the same reason. For public utilities, the failures weren't really because the business was bad. It was because of reckless financing and way, way too much debt. For the railroads, it was a different story. The financing was actually more conservative, but investors had just completely overestimated how stable the industry really was. And for many industrials, it was something else entirely. Their earning power just vanished, almost overnight. The big lesson here? Risk isn't a one-size-fits-all problem. Digging into what went wrong back then brings up a really important and maybe even counterintuitive point about debt. We're all taught to see debt on a balance sheet as a weakness, right? But is it always a bad thing? Let's take a look at the truth about debt. So you've got these two totally different ways of looking at debt. On one side, you have the common belief, issuing bonds is a sign of weakness and the strongest companies have no debt. But then the source material flips that on its head. It says that for a strong, thriving business, taking on a reasonable amount of debt is actually an advantage. It's the weak companies that are forced to borrow just to stay afloat. And this is what leads us to what we could call the proper theory of bond financing. A healthy, strong company chooses to borrow at a low interest rate because it's confident it can use that money, your money, to earn an even higher return for its stockholders. The key thing for you, as an investor, is to figure out why they're borrowing. You only want to lend to a company when it's a strategic choice, not a desperate necessity. If a company is complaining that it has to borrow, that's a huge red flag. All right, let's switch gears and talk about something that tempts pretty much every investor at some point, the high-yield trap. This whole section is about asking one critical question. When you see a bond offering a higher interest rate, are you really being paid enough for the extra risk you're taking on? So let's just ask it straight up. That extra percentage point of yield you get from a riskier bond, does it really mathematically make up for the higher chance that you could lose everything? Most of us just kind of assume the answer is yes. But the author's answer is a very clear, very loud no. And this is a huge, huge point. Bond yields aren't calculated like insurance premiums, with actuaries and tons of historical data. No, they're based on much fuzzier stuff like popularity, what people think about the company, and how easy it is to sell the bond, not some cold, hard calculation of risk. This leads to a really powerful idea, a principle you should probably write down. Income return and risk of principal should be regarded as incommensurable. That's a fancy way of saying you can't measure them on the same scale. You can't logically trade a real risk of losing your entire principal for just a little bit of extra income. They're apples and oranges. This kind of flawed logic often gets packaged up and sold to people as a businessman's investment. It's usually some high-yield, lower-quality bond where they tell you that the extra income compensates you for the risk.
But according to our source, that's just an illogical and frankly unsound idea. The average investor isn't an insurance company. You're not equipped to underwrite those kinds of risks.
Okay, so if that's the trap, what's the solution? If that's the wrong way to think, what's the right way? Well, it involves flipping the whole selection process completely on its head.
And this slide just lays it out so perfectly. The wrong way, which is what most of us do by default, is you start at the top with the safest things imaginable, and then you work your way down. You ask, okay, how much safety am I willing to give up to get a little more yield? The right way is to start from the ground up. You first establish a strict, absolute minimum standard of safety. Anything that doesn't clear that bar is instantly out. Only then do you pick from the much smaller, pre-qualified group of safe investments.
All right, so let's boil this all down to the key takeaways you should remember. First, always apply that acid test. Can this thing survive a really bad depression? Second, don't just trust an industry's reputation. You have to analyze the specific company's financial strength. Third, remember you're not an insurance company. Don't take chances with your principal for a few extra drops of income. And finally, figure out your minimum safety requirements first and then never ever compromise on them.
And that really leaves us with one final, and I think really important question you should ask yourself about your own investments. When you're reaching for that higher yield, are you truly being paid for the risk you're taking, or are you just paying for the illusion of a higher return, with the real price being the safety of your hard-earned money? Something to think about.
So if you're investing for safety, there's a question that's probably been bugging you at some point. How do I really know this bond is safe? How do I know it's not going to just blow up in my face? Well, it's not really about finding that one perfect bond. It's about building a portfolio that can handle whatever the market throws at it. And today, we're going to explore a powerful way to do just that by setting some clear, definite standards for every single bond we even think about buying. So let's just start right there with that big fundamental question. You're looking at a bond. Maybe it has a great rating, a famous company name, but what's the one thing that actually makes you confident that it's a safe bet? Is it the yield? The company's reputation? As we're about to see, that question is a lot trickier than it sounds. And right here, this is the core idea for our entire discussion. The author argues that true safety in investing, especially in bonds, isn't really about being a genius who discovers hidden gems. Nope. It's more about being a really tough gatekeeper. It's about having a disciplined process that automatically kicks out the unsuitable investments from the get-go. All right, so here's our game plan for today. First, we'll talk about this whole quest for safety. Then we're going to look at an old investment blueprint to see what we can learn from its mistakes. That's going to lead us straight into the main event, the battle between rigid rules and intelligent principles. We'll put that idea to the test with a really tricky case, foreign bonds, and then we'll see why company size matters so much. And finally, we'll wrap it all up into an investing mindset you can actually use. So the idea here is actually pretty simple. I mean, think about it. Why should big banks and insurance companies be the only ones with these super strict safety standards? If an institution needs clear rules to protect other people's money, doesn't it make a ton of sense for you to use that exact same thinking to protect your own money? Now, just so we're all on the same page, we're talking about something called straight investment. This isn't about speculating or trying to hit a home run. This is investing for a steady, reliable income. The number one, absolute top priority is making sure your original investment, your principal, is safe. Everything else we talk about is built on top of that foundation. To really get a grip on how these standards work in the real world, and more importantly, where they can go wrong, we're going to travel back in time a bit. We're going to use a historical example, the old New York savings bank law. Back in its day, it was considered the gold standard, but as we're about to find out, it was seriously flawed. So the law basically created a checklist. It looked at what kind of business it was, how big it was, the details of the bond itself, its track record of paying its bills, the key financial stuff. It even looked at how well its earnings covered its interest payments. Seems pretty thorough on the surface, doesn't it?
But here is the huge problem. The law's biggest feature was something called blanket prohibitions. It wasn't about nuance or careful analysis. It was about creating two giant simple buckets. So things like U.S. government bonds and railroad bonds, they were in. But entire categories, like all industrial bonds and all foreign government bonds, were just completely out, thrown out. It didn't matter how good an individual company might be.
And this whole two-bucket system, well, it reveals the central flaw in that old way of thinking.
And this is where we find our most important lesson for today. It's all about the critical difference between blindly following a rigid rule and thoughtfully applying an intelligent principle. This quote from the source just nails it perfectly. Investment theory should be chary of easy generalizations. Basically, whenever you hear an absolute statement in investing, like never invest in tech stocks or always buy real estate, your internal alarm bells should be screaming. Easy generalizations are the enemy of smart investing. And this slide just lays out the whole shift in thinking perfectly. The rigid rule is simple, sure, but it's also lazy. Exclude all industrial bonds, period. But the intelligent principle is way smarter. It says, okay, I get it, industrial bonds as a group can be riskier. So, you know what? I'm simply going to require stronger proof of safety from them. It means I'll need to see that their profits cover their interest payments by a much bigger margin. It doesn't ban the category, it just raises the bar for entry. You know, the funny thing is, even the lawmakers who wrote the thing eventually realized this was a problem. In 1938, they passed an amendment that basically created a backdoor. It allowed a banking board to just waive the rules and approve bonds that the law technically excluded. It was a pretty clear admission that the original, rigid system just didn't work in the real world. Okay, now, while we're arguing against these blanket prohibitions, there is one category where the author says, hang on a second, maybe a little generalization is actually justified here, and that's when it comes to foreign government bonds. Let's take a closer look at why. This right here is the heart of the problem. Unlike a corporate bond, where if the company goes bust, you have legal rights, you can foreclose on assets, with a foreign government, a bond is basically an unenforceable contract. A bondholder has almost no real power if a country just decides not to pay you back. It's a promise based on goodwill, not on law. And man, the history really backs this up. It's a history of disappointment. If you look at the data from back then, out of 42 countries that had issued dollar bonds, only just three, managed to maintain a top-tier investment rating. A staggering 39 failed. That is a massive, massive failure rate for an entire class of investments. So it boils down to this twofold objection. First, you have the theoretical problem. The contract is essentially unenforceable. And second, you have the practical problem. The historical track record was, to put it nicely, just awful. This doesn't mean every single foreign bond in history was bad, but it sure does justify being extremely cautious with the whole category. All right, let's pivot to another one of these criteria, company size. And you guessed it, we see the same old pattern here, the law getting all tangled up in these weird arbitrary rules instead of just using a simple guiding principle. I mean, just look at how bizarre some of these rules were. For a company to be considered safe, a telephone company needed 5 times the revenue of a gas and electric company. Why? Who came up with that? And it gets even weirder. They set minimums for the size of the bond issue itself. Now think about that for a second. If a company is financially strong, a smaller amount of debt should be even safer, right? Not disqualified. It just makes no logical sense. So in contrast, the author suggests a much more straightforward and sensible approach. You know, maybe $2 million in gross revenue for utilities, $3 million for railroads, something like that. The exact numbers aren't what's important here. It's the logic. They're simpler and they provide a reasonable first filter to screen out companies that are just too small to have a good cushion. But, and this is a really, really critical point, a minimum size requirement is just step one. It's just a filter. Large size by itself is absolutely no guarantee of safety. You can have a massive company with a mountain of debt, and that company can be far, far riskier than a medium-sized company with a clean balance sheet. Size is not a magic bullet. So after going through all of this, from the blanket rules to the weird size requirements, what's the final actionable takeaway for us as investors? Well, it all comes down to the mindset we choose to adopt. And this is the core message of this entire explainer. Forget about the checklist. A checklist lets you turn your brain off. Instead, you need to embrace a set of intelligent principles. Principles force you to think, to analyze, to weigh the evidence, and to make a real judgment call based on the specific facts in front of you. So here are the principles you can apply today. First, think like a bouncer at an exclusive club. Your main job is to keep the bad investments out. Second, get really skeptical anytime you hear a rule that uses the words always or never. Third, don't just ban entire categories of assets. Instead, raise your standards and demand more proof of safety from them. And finally, and this is the big one, remember that all of these are guides to help you think, not rules to replace your thinking. And that leaves us with one last question, and this one's for you to think about. Take an honest look at your own process.
Are you outsourcing your decisions to a simple set of rules you heard somewhere? Or are you actively applying flexible, intelligent principles to every single decision you make? The answer to that question could make all the difference in the world. All right, let's dive into a really crucial idea from a classic text on investing, specific standards for bond investment. We're going to unpack a dangerous assumption that a lot of investors still make even today. We're talking about the property value trap. So let me ask you this. You're looking at a bond, and it's backed by this huge, tangible asset, a skyscraper, a factory, you name it. Your gut reaction is probably, hey, even if the business gets into trouble, I'm covered. We can just sell the property. It feels like the ultimate safety net. But is it really? Well, that exact line of thinking, that piece of what seems like common sense, wasn't just a little bit wrong, it was catastrophically wrong. It actually fueled a massive speculative bubble back in the 1920s that wiped out an incredible number of investors. So today, we're going to unpack exactly how that went down, and more importantly, what it teaches us about finding real security in investment. Okay, so let's get right to the heart of it. On one side, you have this powerful myth that just feels intuitive and safe. And on the other, you have a fundamental investment principle that is so much more reliable. This is the central battle we need to understand, the tempting idea of property value versus the hard, cold reality of earning power. Here's the breakdown. The common belief, the one that makes sense on the surface, is that the physical asset is your protection. You know, if the loan is for $1 million and the property's worth $2 million, you're golden. But the core principle of sound investing says something totally different. It argues that a business's consistent ability to generate cash, to pay its bills, its earning power, is the only real measure of safety. The property? That's a distant second. And this quote just nails it. It really gets to the core of the issue. At the end of the day, a bond is a loan. So the most important question for any lender isn't, what can I sell if this all goes wrong? It's, can the borrower actually afford to pay me back from their regular business? You see, the first question is a backup plan. The second one is the business plan. And what's really fascinating is just how deeply this myth is embedded in our thinking. It's not just individual investors who get tripped up. The source material points out that even official regulations, like New York State's rules for what bonds were considered safe, historically focused on these property-to-debt ratios, completely ignoring the much more important factor, the actual health of the underlying business. Now, like any good rule, this one has a couple of key exceptions. There are some very specific cases where the value of the asset is, in fact, the primary source of safety. And understanding these exceptions actually helps us understand the main rule even better. So first up, we have something called equipment obligations. Think trains. Seriously, these are bonds backed by things like locomotives and freight cars. And unlike a factory that's, bolted to a specific piece of land, a train car is a standard piece of equipment that can be moved and used by pretty much any other railroad in the country. And this is exactly why this works so well. The value here isn't tied to the success of just one company. The asset is mobile, it's standardized, and it has a real independent market value. And crucially, the bondholder can make a very credible threat to just come and take their train cars back, which gives them a ton of leverage that a person with a mortgage on a specialized factory just doesn't have. The second big exception is something called a collateral trust bond. Now here, instead of being backed by a physical building, the bond is secured by a whole portfolio of other stocks and bonds. The key word here is liquid. These are assets that have a daily market price and can be sold in an instant. And here's a perfect real-world example of that. This company, Reliance Management Corp., completely imploded. The stock price was basically wiped out, went from $69 to $1. For a normal company, the bondholders would have taken a massive hit. But in this case, because the bonds were backed by that portfolio of liquid securities, the company was forced to sell those assets to repay the bondholders in full. The assets had a value completely separate from the company's own failed operations. Okay, so with those two exceptions in mind, let's pivot to the main event, the cautionary tale of the 1920s real estate market. This is where forgetting that primary rule of earning power led to absolute, widespread disaster. So, why does real estate feel so safe in the first place? Well, this is a great way to think about it. A mortgage on a home is pretty safe because its value is tied to a big, stable market of lots of potential renters or buyers. Even if rents fall, there's usually enough income to cover the loan. But a factory, its value is 100% tied to the success of that one specific business. If that business goes belly up, what's a specialized factory actually worth?
Maybe just the value of its scrap metal?
So this is the crucial point. Even for general real estate, like an office building, the value isn't just the bricks and mortar. It's what's called a going concern value. That means it comes directly from the income, the rent, that the property can generate. It all comes back to earning power. This brings us to the nuts and bolts of the 1920s bubble. How did promoters convince the public to hand over millions and millions of dollars for bonds that were basically destined to fail? The scheme was both simple and, in a way, brilliant in its deception.
So let's use some simple numbers to see how it worked. Imagine a promoter wants to build a new office building. The actual all-in cost to buy the land and put up the building is $1 million. This is the real money being spent. But they don't tell investors the cost. Instead, they go hire an appraiser who, for a nice fee, of course, takes the super high rents of a brand new building and turns them into a much higher valuation. All of a sudden, that $1 million building is appraised at $1.5 million. And this chart just shows the fiction right there in plain sight. That extra $500,000 gap, it's not real value. It's just paper value, created by making the ridiculous assumption that the temporarily high rents of a new building would last forever. It was pure fantasy, and its only purpose was to justify selling more bonds to the public.
And here's the playbook they ran. Step 1, get that inflated appraisal. Step 2, sell bonds to the public for, say, $1 million, which covers the entire construction cost. Step 3, the promoter gets to keep 100% ownership of the building without investing a single dollar of their own money. And in a lot of cases, they could even walk away with a cash profit just from the financing alone. They had absolutely zero risk. The bondholders shouldered all of it.
I mean, it was a total house of cards. You had appraisals based on temporary rents that were guaranteed to fall. The debt was based on inflated construction costs from the middle of a building boom. They made no distinction between a stable apartment building and a super risky specialized hotel. And to top it all off, the bondholders received zero financial statements, so they were flying completely blind until the default notices started showing up in the mail.
So, after dissecting that historical disaster, what can we actually do about it today? Well, the source material gives us a very clear set of rules, a playbook for the modern investor to avoid falling into these exact same traps. But first, one last warning. Take a look at the Trinity buildings. Quantitatively, on paper, this investment looked bulletproof. I mean, earnings covered interest 6 times over. The bonds were trading at full value even in the middle of the Great Depression. But it still defaulted. Why? It was a qualitative factor. Its neighborhood, the financial district, went into a steep decline, and the rental income just evaporated. It's a powerful reminder that even if the numbers look good, you have to understand the bigger picture. And that brings us to the checklist. This is your takeaway. First, demand to know the actual cost, not the appraisal, and make sure there's a big cushion between that cost and the loan amount. Second, analyze the income, but be a pessimist. Assume vacancies will go up and rents will go down. Third, make sure there's a sinking fund, which is basically a mandatory savings plan to pay down the debt over time, not just all at once at the very end. And finally, demand transparency. Insist on regular financial reporting. If a company won't give you these things, it is a massive red flag. So we'll end with this question for you to think about. In any market, whether it's today or 100 years ago, you are going to be bombarded with appraisals, projections, and exciting stories. The lesson from all of this is to be the skeptic. To always ask, where is the real sustainable cash flow coming from? Because learning to distinguish that true earning power from just hopeful fiction, well, that's the absolute key to sound investing. All right, let's talk about one of the most powerful words in all of finance, guarantee. I mean, it just sounds safe, doesn't it? Secure, like a financial safety net. But as we're about to find out, not all guarantees are what they seem. Today, we're going to peel back the layers and uncover the hidden and sometimes shocking story behind that promise.
On the surface, it's really this simple. A guarantee is just a promise that if one person can't pay you, someone else will step in and make you whole. It's the whole idea of financial insurance, right? It's meant to take the risk off the table. Seems pretty straightforward.
And right there, that's the million-dollar question. History, and especially financial history, is littered with broken promises. And when that promise breaks, it can be the difference between a safe investment and a total wipeout. So how do you tell a real promise from an empty one?
Well, to figure that out, we've got to understand what makes a guarantee strong in the first place, and what happens when those foundations just completely crumble.
So here's our game plan. We'll start with the ideal, the promise of a guarantee. Then we'll dive headfirst into a catastrophic failure from the 1930s to see what went wrong. After that, we're going to uncover hidden value where you'd least expect it and expose some serious dangers lurking off the balance sheet. We'll look at the classic subsidiary trap, and then we'll wrap it all up by building a new analytical toolkit to help you see things a lot more clearly.
Okay, so first things first. In a perfect world, what is a good guarantee? The basic idea is totally sound. It's insurance. You give up a little bit of return, a slightly lower yield on your investment, and in exchange, you protect yourself from something going terribly wrong. But, and this is a big but, for this insurance to actually be worth anything, the conditions have to be absolutely perfect. Now, this is the blueprint for a bulletproof guarantee. First off, the underlying loan, the thing being guaranteed, has to be conservative. No crazy, reckless lending. Second, the company making the promise, the guarantor, it's got to be big, totally independent from the deal, and diversified, with its hands in a lot of different pots to spread out the risk. And finally, the overall economy needs to be pretty stable. When you have all three of these things, a guarantee is an amazing tool. But what happens when you don't?
And now we get to see what happens when those conditions get thrown right out the window. We're going to turn the clock back to the late 1920s, a time when that idea of a sound guarantee was just completely ignored, and it led to an absolute total collapse of the real estate mortgage market. And you can see the whole disaster unfold right here on this timeline. Before 1924, things were pretty sensible. Mortgages were limited to 60% of a property's value. But then came the roaring 20s, the new era boom. New aggressive companies jumped in, competition got fierce, and everybody just started throwing their lending standards out the window. Loans got incredibly risky. And then by 1931, bam, the market breaks and the entire system implodes. The guarantors, the mortgages, the property values, everything collapsed in on itself. The scale of this is just, it's mind-boggling. $3 billion. That's the value of mortgages guaranteed just by New York companies that became basically worthless. Investors learned a brutal lesson. The word guarantee was just a word. It was a name, nothing more. They were left holding the bag. So what's the takeaway here? It's that a guarantee is only as strong as the company behind it and the sanity of the times in which it was made. Okay, so after all that doom and gloom, here's where things get really interesting. Sometimes the most powerful guarantees aren't called guarantees at all. They're actually hidden in plain sight, usually inside long-term lease agreements. See, a smart analyst realizes that a fixed rental payment coming from a super strong company is, for all intents and purposes, a promise to pay. This is such a great example. Picture this. It's 1932, and you have two choices. On one hand, a bond from a company called Tobacco Products. On the other, the preferred stock of the much stronger, much bigger American Tobacco. Now, here's the twist. American Tobacco was leasing all of Tobacco Products' assets and was legally on the hook to make rent payments big enough to cover those bonds. That lease was, in effect, a guarantee from a rock-solid company. But look at the yields. The market was so confused that it demanded a way higher return, 8.9% for the bond, which was actually safer, than it did for the preferred stock, which legally had a weaker claim. It makes no sense. And believe me, this wasn't just some fluke. This was a recurring pattern. This chart shows a bunch of other cases where a security with a hidden guarantee offered a much higher yield than a riskier, non-guaranteed one from the same parent company. For any analyst who'd bothered to read the fine print, this was a massive opportunity. Getting paid more to take on less risk, all because the market wasn't paying attention. Now let's flip the coin. Just as leases can hide value, they can also hide a world of pain. A company might look incredibly safe on paper, reporting very little debt on its balance sheet. But these long-term lease contracts can act like a secret, invisible debt that can pull an otherwise healthy-looking company right under. Let me give you a perfect example. United Cigar Stores. Back in 1928, this company looked golden. On its official books, it reported no funded debt, and its earnings covered its preferred stock dividends 7 times over. By any normal metric, this was the picture of financial health. And yet, it went bankrupt. So what on earth happened? Well, the balance sheet didn't show the one thing that mattered, the crushing weight of its long-term leases. These were huge, fixed rental payments signed during the good times, and when the Depression hit, they became an anchor that dragged the whole company down. It's such a stark reminder that what you don't see on a balance sheet can be what kills you. So how do we find these hidden monsters? We have to adjust how we look at things. The problem is that these leases act like debt, they're fixed, you have to pay them, but the accounting rules, at least back then, let them stay hidden. The solution? We have to do the work the balance sheet doesn't. We have to start treating a chunk of those rent payments as if they were interest on a giant hidden loan. Okay, now this looks a little complicated, I know, but the core idea is actually pretty straightforward. The key is to take about 1/3 of a company's total rent for the year and add it to its other fixed charges, like interest payments. The logic here is that rent isn't just rent. It's kind of like a mortgage payment on the property, part principal and part interest. So by adding in that interest portion of the rent, we can calculate how well the company's earnings cover its true total obligations. And as you can see, this new calculation gives you a much more sober and much more realistic view of a company's health.
All right, on to our next trap. This one is a classic, and it catches so many people off guard. It's the subsidiary trap. It's so easy to look at a bond from a small company, see that it's owned by a huge, profitable parent company, and think, oh, this must be safe. But if that bond isn't explicitly legally guaranteed, you could be in for a very nasty surprise.
This slide just lays it out perfectly. On one side, you have the appearance. The company puts out a consolidated income statement that makes it look like the parent's massive earnings are there to protect the subsidiary's bonds. But then there's the cold, hard reality. The subsidiary is a totally separate legal entity. The parent has zero legal obligation to pay its debts. And if that little subsidiary starts losing money, the parent can, and often will, just cut it loose and let it fail to protect the bigger company. And if you want the textbook case for this, look no further than the United Drug Bond. United Drug was a subsidiary of the massive and hugely successful Drug Incorporated. On that consolidated report, the parent company's earnings covered the interest on these bonds 10 times over. I mean, it looked like one of the safest investments on the planet.
But then reality hit. A piece of United Drug's business got into trouble, and the market suddenly woke up and realized that the parent company, Drug Inc., had no intention of stepping in to save it. And look at this price collapse. The bonds absolutely plummeted, from 93 cents on the dollar all the way down to 42 in just a few months. And get this. This happened while the parent company was still worth over $100 million. The parent protected itself, and the people holding the safe subsidiary bonds were just left out in the cold.
So, after going through all these failures, these hidden values, and these dangerous traps, what's the big takeaway? We can actually boil all these lessons down into a really powerful, simple toolkit that any of us can use when we're looking at these kinds of investments. Here it is. It really comes down to this 3-step checklist. First, you have to scrutinize the guarantor. Don't just see the word guarantee and stop. Dig in. Is the company making the promise actually strong and independent? Second, uncover those hidden leases. You've got to treat long-term leases as the debt they really are. And third, always, analyze a subsidiary on its own 2 feet. If there is no explicit, legal guarantee, you have to assume the parent company's strength means absolutely nothing to you. And really, that brings us to the final thought here. The names on the buildings have changed, the companies are different, but these principles, they are absolutely timeless. The temptation of a simple promise, the danger of what's hidden off the books, the traps laid by complex corporate structures, they're all still out there. So the question I want to leave you with is this. In today's incredibly complex market, what guarantees, both the ones written down and the ones you just assume, are you taking at face value?
So when you invest in a company's bonds, you're lending them money, right? And you expect to have some kind of protection, a safety net to make sure you get paid back. All those protections are written into these incredibly complex legal documents. But here's a crazy thought. What happens when that safety net is actually designed to fail? Let's dive into this fascinating world of promises made to investors and the often messy reality when things go south. And that's really the huge question we're tackling here. Just imagine you have a contract that gives you the right to sue a company if they miss a payment. Sounds good, right? But what if actually using that right, dragging them into court, ends up destroying the company's value, making it even less likely you'll ever see your money again? That is the bizarre paradox we're going to unravel today.
To really get to the bottom of this, we're going to take a journey through 5 parts. We'll kick things off with the paradox itself. Then we'll jump in a time machine to see how corporate reorganizations used to be the Wild West. After that, We'll look at the new rules that tried to fix everything, explore a really radical alternative, and then wrap up with some absolutely bonkers examples from market history.
All right, first up, let's lay down the rules of the game. We've got to understand the legal framework that's supposed to protect bondholders before we can really see how it all goes so wrong so often. And you know what? It all starts with one single, incredibly important document.
This right here is the foundation of everything, the indenture. The best way to think about it is like the Constitution for a bond. It's this massive legal contract that lays out the whole shebang, when you get your interest, when you get your principal back, and crucially for our story today, what happens when the company doesn't hold up its end of the deal.
And inside that indenture, you've got these little tripwires, known as events of default. Now, what's really interesting here is that it's not just about a company missing a payment to you. No. If the company defaults on another loan, or if it issues a bunch of new debt that gets to cut in line ahead of you, that can trigger your right to take action. This is supposed to be your power, your leverage.
And there it is, the whole paradox, summed up in one perfect sentence. The ultimate weapon for a bondholder is to force the company into bankruptcy or what's called receivership. But that whole process, it's so destructive, so expensive, and creates so much chaos that it often just incinerates the very value you are trying to protect. You might win the legal battle, but you absolutely lose the financial war.
Now, to really get why this process was so broken, we've got to go back in time. We're talking before the big reforms of the 1930s, when corporate reorganization was a system that honestly seemed like it was designed by insiders for insiders. Let's see how this game was rigged right from the very start. The old way of doing things was, well, shockingly predictable and totally self-serving. A company gets into trouble, so what does management do? They run to a friendly judge and get themselves, or one of their buddies, appointed as the receiver to oversee the whole process. Yeah, you heard that right. The same people who drove the company into a ditch were now in charge of pulling it out. The plan was cooked up by insiders, and the whole thing would end with a foreclosure sale at a ridiculously low price.
So as you can imagine, this system was just riddled with problems. The old management and their banker friends held all the cards. That foreclosure sale, it was basically a sham. The price was set so low that you, the bondholder, had no choice but to accept the new securities they were offering. Why? Because taking the tiny cash payout would have been an even bigger loss. It was a coercive system, plain and simple, designed to protect the insiders, not the investors.
Of course, a system this broken couldn't last forever. The Great Depression really dragged all its flaws out into the open, which led to a wave of landmark laws in the 1930s. The goal was to bring fairness, transparency, and a bit of independence to the whole corporate restructuring mess.
And this slide, wow, it just perfectly captures the huge shift that took place. Friendly receivers who were buddies with management, gone. Replaced by a disinterested trustee. Plans cooked up by insiders in a back room? Nope. Now they're overseen by the court and the SEC. That coercive foreclosure sale was totally eliminated, replaced by a plan that, once it's approved, is binding on everybody. The goal was to break the insider's stranglehold.
The Chandler Act was really the centerpiece of all these reforms. It demanded an independent trustee whose job was, first, to investigate the old management, and second, to figure out if the business was even worth saving. Responsibility for the actual rescue plan was shifted to these neutral parties. I mean, this was a seismic shift, all designed to level the playing field and make sure any reorganization was actually fair.
And then on top of that, you had the Trust Indenture Act. Its focus was a little narrower, but it was just as important. See, in the past, the trustee listed in the bond contract was often just a passive agent. They'd just sit there and do nothing unless a huge chunk of bondholders got together and demanded action. This new act forced them to be proactive, to act like a prudent man would in handling his own money. They now had a real duty to actively protect investors.
Okay, so the system was reformed. It got better. But our source makes a really compelling argument that even with all these improvements, the process is still way too complicated, way too slow, and it still relies too much on the courts. It proposes a simpler, more direct, and maybe more powerful solution. So check this out. Instead of immediately running to a judge the second a payment is missed, what if the indenture said that voting control of the company automatically flips over to the bondholders? Just like that. They would elect new directors, they would take over the board, and they would decide the company's fate from the inside. The court system suddenly becomes the last resort, not the very first step.
Now, here's where it gets really clever. During this period when the bondholders are in charge, the company's obligation to make those fixed interest payments gets put on pause. The bond basically morphs into an income bond. It only gets paid if the company actually earns enough money to pay it. This gives the new management, the bondholders' management, the breathing room they need to try and fix the business without the immediate threat of bankruptcy hanging over their heads.
And while this whole idea might sound totally radical, the concept of bondholders getting a vote isn't actually new. It's an old idea that's been making a comeback. It's already standard practice for certain kinds of bonds that come out of reorganizations. And as you can see here, a lot of modern bond contracts already let bondholders vote on certain changes, which shows that the machinery for this kind of control is already being built into the system. All right, for our final section, let's look at why any of this really matters in the real world. The uncertainty and the insider dealing of that old receivership system, well, it didn't just hurt investors during the bankruptcy process. It created complete and utter chaos in the stock market, leading to some of the most illogical, head-scratching valuations you can possibly imagine.
Back then, the word receivership was basically a death sentence on Wall Street. The second a company entered that process, investors just panicked. Nobody knew what a fair plan would look like, who would get wiped out, or how long it would all take. And this massive cloud of uncertainty drove prices down to levels that were completely disconnected from a company's real assets or its ability to make money. And this first case is just staggering. I mean, look at this. Fisk Rubber in 1932. The stock market valued the entire company, all its bonds, all its stock, everything, at just over $2 million. Here's the kicker. At that exact same time, the company was holding almost $8 million in cash. The market was literally saying the company was worth less than a third of the cash it had in the bank, putting a value of less than zero on all its factories, inventory, and everything else. It's insane. But the Studebaker situation? My gosh, it might be even more absurd. So you have a company in default. The debt holders have the first claim on everything. They are legally entitled to get paid back in full before the stockholders see a single penny. And yet the market valued their debt at less than $9 million, while at the same time valuing the stock, which was legally worthless, at over $16 million.
This quote just says it all, doesn't it? The market, in its absolute panic and confusion, completely turned legal reality on its head. It valued a worthless lottery ticket, the stock, at almost double the value of the legally senior first-in-line claim on all the company's assets. This is what happens when a system of investor protection just fails to provide any clarity or confidence.
So, what does this all boil down to? It's a pretty simple but powerful truth. A contract is only as good as the remedy it gives you. You can have an ironclad legal document that gives you all the rights in the world on paper. But if the only way to actually enforce those rights is through a value-destroying, confusing, and years-long court battle, then your real-world power is a whole lot less than what's written on the page. And that leaves us with one final big question to think about. We have spent the better part of a century building up layers and layers of complex laws and regulations to protect investors, but in doing all of that, have we maybe overlooked a much simpler and maybe much more powerful idea? That maybe the ultimate protection isn't a better lawsuit, but the simple, direct power to take control. So when you buy a corporate bond, you're not just an investor, right? You're a lender. And like any lender, you want to be sure the borrower plays by the rules. Specifically, rules that are designed to protect your money. In the world of corporate finance, we call these rules protective covenants. Think of them as the hidden architecture, the fine print that keeps your entire investment from falling apart. Let's dive in and see how they work.
I mean, just imagine this for a second. You've just loaned a company millions of dollars. What's actually stopping the management from taking on some crazy new risk, or paying out every last dime of cash to the stockholders, or even selling off the very assets that are supposed to generate the money to pay you back? This is the fundamental problem, right? And it's exactly what protective covenants are built to solve. They are the legally binding promises that hopefully keep the company's actions in line with your interests as the lender. All right, so here's our game plan. First, we're going to unpack the basic conflict of interest that's at the heart of every single corporate bond. Then, we'll see how specific rules can protect your place in the line to get paid and force a company to stay financially healthy. We'll also look at a really clever mechanism called a sinking fund that makes the company pay down its debt over time. But then, we get to a fascinating twist, a paradox that makes these rules surprisingly hard to enforce. And finally, we'll land on what is, without a doubt, the most important protection for any bond investor. So here it is, the core dilemma. As a bondholder, your goals are pretty simple: safety and getting your principal back. But the company's management?
Well, they ultimately serve the shareholders, and shareholders are often rewarded for taking bigger risks to chase higher returns. You see the problem? It's a natural conflict of interest, and it's all managed in the fine print of the bond contract in a document we call the indenture.
Okay, so the very first line of defense is all about protecting your spot in the pecking order. You have to make sure that nobody can just cut in front of you to get paid, especially if the company gets into trouble. This is where asset and lien covenants come into play. These are rules specifically designed to protect your claim on what the company actually owns.
And there are a few tools in the toolbox for this. A company might be flat out prohibited from putting a new, higher-ranking mortgage on its property. Sometimes, a bond might even agree to be second in line to future bank debt, just to help the company get some crucial financing. But maybe the most clever, most powerful tool of all is a specific promise known as the equal and rateable security clause.
This clause is like a springing security. It's awesome. You might start out as an unsecured lender, just holding a promise to get repaid, but if that company later decides to pledge its assets as collateral for a new loan, this clause automatically kicks in, and it pulls you into that secured position right alongside the new guys. All of a sudden, your claim gets a massive, powerful upgrade.
And a real-world case shows you just how incredibly important this one little clause can be. Back in the early 1900s, a railroad issued two bonds that were almost identical. One, due in 1956, had the equal and rateable clause. So when the railroad later mortgaged its property, boom, those bondholders were automatically secured. The other bond, due just 1 year later in 1957, didn't have the clause. It stayed unsecured, forever. The financial difference between the two was, well, it was just staggering.
Just look at these numbers. By 1939, the protected bond was trading for 16 cents on the dollar. The unprotected one, which was basically the same in every other way, was trading for just 5 cents. That one sentence in the contract was worth more than 3 times the price. It is a perfect and brutal reminder that the fine print really, really matters.
So protecting your claim on the assets is mission critical. Got it. But what about the company's day-to-day financial health? The best covenants go way beyond just securing collateral. They act like a continuous financial checkup, forcing the company to maintain some fiscal discipline for the entire life of the bond.
Now, these financial checkups, they take different forms depending on the type of business. For an industrial or utility company with pretty steady cash flow, an earnings coverage test is really common. It basically means profits have to cover interest payments by a healthy margin before they can even think about taking on more debt. For an asset-heavy business like a railroad, a debt-to-equity ratio makes more sense. And for, say, a manufacturing company where day-to-day cash is king, the key metric is making sure they maintain a certain level of working capital.
And the penalty for breaking these rules? It's not always the same. In some cases, if a company's working capital dips too low, the consequence is pretty mild. It's just blocked from paying dividends to shareholders until it fixes the problem. But in other, more serious cases, it can be considered a full-blown event of default, which gives the bondholders the right to demand immediate repayment of the entire loan.
Okay, so beyond just preventing bad behavior, the absolute best covenants will proactively improve the bondholder's position over time. And this brings us to the sinking fund, a really powerful tool you can think of as a kind of forced savings plan for paying down debt. The way it works is actually pretty simple. The company is required, by contract, to regularly set aside cash. It then uses that cash to buy back and retire a piece of its own bonds, either by calling them at a set price or just buying them on the open market. The end result is that the total amount of debt actually shrinks year after year after year. And this gives you two huge advantages. First, and this is the obvious one, it makes the remaining bonds safer. The less debt there is floating around, the more secure the remaining bondholders are. Simple. But second, and this is a bit more subtle, it creates this constant, reliable source of buying pressure for the bonds in the market, which helps support the price. It's a win-win.
Now, this is where we have to make a really crucial distinction. For some companies, a sinking fund is just a nice feature to have. But for others, it is absolutely non-negotiable. If a company's main value comes from what we call a wasting asset, an asset that gets used up over time, like the ore in a mine, the years left on a patent, or the term of a lease, a sinking fund is the only way to make sure the debt gets paid back before the main asset literally disappears.
So what does it look like when a company with one of these wasting assets just ignores this principle? Oh, the case of the Iron Steamboat Company is the perfect, and I mean tragic, example of just how badly things can go wrong.
So back in 1902, the company issued $500,000 in bonds, and they were secured by its steamboats, which are clearly a depreciating asset, right? But the bonds had no sinking fund. So for years, the company just paid out massive dividends to its stockholders, way more, in fact, than the total value of the bonds. Well, when the company finally went bankrupt in 1932, the entire $500,000 bond issue was still outstanding, and those boats, they were sold for scrap.
So what was the final result for the people who loaned them the money? They got back less than 1 cent on the dollar. An adequate sinking fund could have paid off the entire debt using the exact same earnings that were instead just handed over to stockholders. It's just a devastating cautionary tale.
Okay, so we've got all these fantastic rules, right? Asset protection, financial health tests, sinking funds. It sounds great, but having a rule on a piece of paper and actually being able to enforce it are two very, very different things. And this leads to what we can call the enforcement paradox.
So let's just play this out. A company violates one of the covenants. It skips a sinking fund payment, or maybe its working capital ratio falls below the required level. The contract says this is an event of default. So, what happens next? What's the real penalty?
And here's the paradox. Bondholders are suddenly faced with two terrible options. Option 1, do nothing. Just sit back and watch as the company's finances get worse and worse, hoping things somehow get better. Option 2, enforce the contract. Declare the full principal due immediately and almost certainly push the company into a messy, value-destroying bankruptcy, which of course ends up hurting the bondholders too. It's often a choice between a really bad outcome and a truly catastrophic one.
And this all brings us to our final and definitely most important takeaway. After looking at all these super detailed rules and the very real problems with trying to enforce them, what is the ultimate source of safety for a bond investor? Now, let's be totally clear. Protective covenants are valuable. They absolutely add a layer of safety, and as an investor, you should definitely look for them and understand what they mean. But, and this is a huge but, they are not a magic shield. They cannot turn a bad business into a good investment. In the end, the greatest protection for your investment isn't found in some legal clause buried in a contract. It's found in the fundamental success and profitability of the underlying business. A well-written contract can protect you from mismanagement, sure, but only a thriving, successful enterprise can truly guarantee that you're going to get your money back with interest. And in the world of investing, that is the most important rule of all.
All right, today we're doing something really cool. We're cracking open one of the foundational texts of finance, Graham and Dodd's Security Analysis, to see how its, timeless principles on watching over your investments actually hold up in today's most intense financial arenas. It's going to be a journey from old school wisdom to modern day chaos. Let's get into it. Portfolio manager Dominique Miel just nails the feeling of picking up this book. It feels like history. It's heavy, it's substantial, but, and this is the key thing, its ideas are anything but dusty. This book, which is basically the Bible of value investing, has some surprisingly sharp things to say about how to navigate markets, even here in the 21st century.
So here's our game plan. First, we're going to bust an old myth about permanent investments. Then we'll dig into the new burdens this puts on investors. From there, we're going to jump straight into a modern battlefield to see these ideas get tested by fire. And finally, we'll wrap up by looking at the huge shifts that are shaping investing right now.
Okay, let's start at the very beginning. A generation or two ago, the whole philosophy for a conservative investor was built on this really simple, kind of comforting idea, an idea that Graham and Dodd themselves could see was starting to fall apart.
This was the absolute dream, right? You buy a sound investment, you stick it in a safe deposit box, and you basically forget it exists, except, when the dividend checks come rolling in. This idea of a permanent investment was the bedrock of conservative finance. It was supposed to be easy, safe, and completely hands-off. But then, reality came crashing in. The massive market depressions of the 1920s and 30s just shattered that illusion. Even the so-called gilt-edged securities, the safest of the safe, took a beating. And this really painful experience created a brand new rule on Wall Street, a new canon that was the exact opposite of the old way. There is no such thing as a permanent investment. Every single thing you own needs to be watched.
And this leads to a really fascinating problem that Graham and Dodd were wrestling with. Think about it. If you have to constantly supervise every single investment you make, on top of all the hard work it took to pick it in the first place, Well, have you just signed up for more trouble than the potential return is even worth? It's a huge question that really gets to the heart of whether investing is even practical for the average person.
So, if buy and forget is dead and gone, what are you supposed to do? This new reality creates a pretty heavy burden, and Graham and Dodd really dedicated themselves to finding a practical way for investors to navigate all this noise.
And this is their core solution. Honestly, it's just brilliant. The margin of safety. The idea is, don't just buy a good company. You have to buy it at a price that gives you a massive, massive cushion. You're building this protective buffer that's so strong that even if things go wrong, and let's be honest, they probably will, your initial investment isn't immediately toast. It's basically an insurance policy against a future you can't predict. Now, to handle this new burden, investors obviously needed some help. Back in the 1940s, these were pretty much the 6 places you could go for advice. But as Graham and Dodd were quick to point out, every single one of them, well, they all came with their own set of serious problems. What's so wild here is that there was no clear winner. Your commercial banker, yeah, they meant well, but their knowledge was often just scratching the surface. The investment bank, they knew the market inside and out, but they had a massive conflict of interest. They wanted to sell you their stuff. Even a truly impartial counsel was so expensive it could eat up a 1/7 of your annual income. The takeaway was clear. At the end of the day, the investor was still pretty much on their own.
Okay, seatbelts on. We are about to jump forward in time, dramatically. We're leaving the 1940s in the rearview mirror and landing smack in the middle of the modern era, in one of the most complex, high-stakes games in all of finance, distressed investing. This, right here, is the ultimate testing ground for these classic ideas.
Now, to get what's happening on this battlefield, you got to understand the 2 warring clans of investment theory. On one side, you have the Graham and Dodd gang. They believe a stock has a real, true, intrinsic value, and the whole game is to buy it for less than that. But on the other side, you've got the modern portfolio clan. They believe the market is totally efficient, so the price is the value. And here's the kicker. They see market swings, volatility, as a risk you need to manage, while the value investors see that very same volatility as a massive opportunity. And sitting right in the middle of this huge philosophical war is distressed investing. This is where people go in and buy the debt of companies that are failing or close to it. Why would anyone do that? Because in the absolute chaos of a bankruptcy, the market is anything but efficient. Prices get totally disconnected from reality, and that creates this incredible space where Graham and Dodd's ideas about finding intrinsic value become more powerful than ever. This quote just perfectly captures how active and strategic this all is. This is not passive, sit-on-your-hands investing. It's about being a detective, digging through legal documents and balance sheets to find the true value that the panicked market has totally missed. It really is a high-stakes chess match. So, what does this actually look like in the real world? Let's dive into a case study that Dominique Miel lived through herself. A modern crisis where these old-school principles were put to the ultimate test and, well, came through with spectacular results. The investment we're talking about was something called an EETC. That's an Enhanced Equipment Trust Certificate. Basically, these were bonds backed by commercial airplanes. And they were considered incredibly safe, almost bulletproof. These were the kind of things held by super conservative investment-grade funds that would never, ever go near a distressed situation. So this market for these bonds just exploded. But then, after the horrific attacks of September 11th, the entire airline industry was suddenly on the verge of total collapse. And all those conservative funds that owned these safe bonds, well, now they were holding toxic assets. Their own internal rules forced them to sell at literally any price, which created a mad stampede for the exits. And this is where the wisdom of the old masters just shines. This quote, written decades and decades earlier, perfectly explains what created this amazing opportunity. The original owners of these bonds weren't just institutionally scared. They were constitutionally terrified of this situation. And it was their fear and their forced selling that created completely irrational, inefficient prices. It was just a perfect storm. You had panicked, forced sellers creating the opportunity. The margin of safety was absolutely enormous. You could buy these bonds for less than what the planes backing them were worth as scrap metal. A shrewd detective could do the work, figure out the real value of the aircraft, and, this is crucial, the bondholders had the legal power to actually go and repossess the planes. They had real leverage to get that intrinsic value back. It was a textbook, real-world application of the entire Graham and Dodd framework. That EETC crisis was a huge, defining moment. But here's the thing. The world never stands still.
In the years since then, the entire landscape has changed dramatically, and that's created a whole new set of challenges for today's value investor.
Miele points to three huge, seismic shifts. First, distressed investing isn't some tiny niche anymore. It's a mainstream business run by mega funds. This means those hidden gems are way harder to find. Second, the Fed steps in. Central banks are so quick to act now that those buy-the-dip moments that value investors live for can disappear in hours, not months. And third, the rise of the retail investor. The whole meme stock phenomenon means that even a brilliant analysis can be totally derailed by a tidal wave of social media hype, adding this wild new layer of chaos.
This just says it all. The amount of money chasing these same deals has absolutely exploded. Back in 2001, the entire sector was maybe $24 billion. By 2022, just the top 25 players were managing $600 billion. The secret is out, and that means for everyone, the battlefield is a whole lot more crowded.
So what on earth does it take to win now? This question just captures the new, complicated skill set you need. You might need the sheer size of an elephant to even compete, the speed of a bunny to grab those fleeting opportunities, and maybe, just maybe, the cleverness of someone like Roaring Kitty, who understood the new social dynamics of the meme stock world better than anyone.
And that really leaves us with a final, crucial piece of wisdom. The principles from Graham and Dodd, the ones we understand by looking back at history, are still our best guide. But we have to apply them with new creativity, new awareness, because the market, just like life itself, must always be lived forward.
Welcome to The Explainer, where we break down big ideas right from the source. Today, we're diving headfirst into Chapter 22 of an absolute investment classic, and we're talking about a fascinating and, let's be honest, often misunderstood type of security.
So let me ask you a question. What if you could find an investment that had the rock-solid safety of a bond, but also the sky's the limit, massive upside of a stock? I mean, it sounds like the perfect deal, doesn't it? Almost too good to be true. Well, that's exactly the kind of security we're digging into today. All right, here's how we're going to break it all down. First, we'll look at why these things are so tempting in the first place. Then, we'll see if they actually live up to the hype by checking their track record. We'll look at a couple of real-world examples, unpack the psychological trap they can set, and land on a really solid principle to guide us. And finally, we'll tackle the big conversion question.
Okay, let's get right into it. To understand the appeal, we have to start at the beginning. What in the world are we even talking about when we say privileged issues?
Okay, so at their heart, these are what we call senior securities. Things like bonds or preferred stocks, the kind of stuff that gets paid first if a company gets into trouble. But here's the twist. They're not just your plain vanilla boring bond. They come with this special bonus feature, this privilege that links them directly to the performance of the company's common stock. And this privilege can look a few different ways. The most common one you'll see is convertible, and it's exactly what it sounds like. You can literally trade in your bond for a set number of the company's shares. The other types, like participating or subscription, all do a pretty similar thing. They give you a ticket to the stock market party, and that's where the magic is supposed to happen. And this quote from the source material just nails the appeal. On paper, it is the absolute perfect investment. It's the holy grail, right? Your money is safe because you own a bond. But if the stock goes to the moon, you get to join in on the fun. You get maximum safety and unlimited profit. I mean, what could possibly go wrong?
Well, if they look so perfect on paper, how have they actually performed out in the real world? This is where the story starts to get a little more complicated.
Yeah, it turns out the reality didn't quite live up to the promise. Looking back at history, especially during their heyday in the wild 1920s, the performance of these securities was, let's just say, often disappointing. And the source gives us two big reasons why.
So, the first problem is pretty straightforward. The privilege was often just a shiny object used to distract you from a weak, risky company. It's like putting fancy rims on a clunker to make you forget the engine is shot. But the second reason? This one is much sneakier. It's all about psychology. It's about how these investments can mess with your head, luring a careful investor into becoming a flat-out speculator, often without them even realizing the ground is shifted right under their feet.
All right, let's make this real. The source material gives us a perfect tale of two bonds, and it's the best way to see the night and day difference between a truly solid issue and one that's fundamentally weak.
Okay, first up, a good one, the Rand Cardex bonds. Now the key here is that this was a solid company to begin with. Just look at those numbers.
When these bonds came out, the company was already earning way more than enough to cover its interest payments, and that coverage was growing like a weed, reaching over 12 times by 1925. This was a strong company first. The conversion feature was just icing on an already delicious cake. And yeah, investors who bought it did great. The price almost doubled. And now for the flip side, national trade journals. Right off the bat, you see this massive red flag. The company was selling these bonds based on estimated earnings. Basically, they were selling a dream. But the reality, it was a total nightmare. The real numbers were weak, and within just a few years, the whole company went into receivership. That bond price collapsed from nearly $100 all the way down to $5. A total wipeout. The safety people thought they were buying was a complete illusion from day one. This brings us right back to that dangerous psychological trap. Because even when you do everything right and pick a good convertible bond, something strange starts to happen. How does your safe, boring bond slowly start to act like a high-flying, risky stock right before your eyes?
So let's just walk through a quick example. You buy a convertible bond for $100, and you can convert it to stock at $50 a share. At first, you've got the best of both worlds. If the stock tanks, hey, no big deal. Your bond is still worth about $100 because it's a solid IOU. But if the stock starts to climb, your bond's value goes right up with it. Protection on the downside, participation on the upside. Beautiful.
But here's the catch. As that stock keeps climbing higher and higher, your safety net starts to get thinner and thinner. The bond's price is no longer anchored to its value as a bond. Instead, it's being pulled out by the rising stock price, like a balloon tied to a rocket.
So now, imagine the stock absolutely soars to $90. Your bond, the one you paid $100 for, is suddenly worth $180. Now think about that. At this point, its value has nothing to do with it being a bond. It's entirely tied to that volatile stock price. If the stock falls from 90 back to 50, your bond's price could plunge from 180 all the way back down to 100. You are no longer a bond investor enjoying some upside. You are a stock speculator risking an $80 profit.
And this is the absolute key. That unlimited profit potential doesn't come from being a bondholder. It comes from you, the investor, taking on the full risk of being a stockholder. To get that massive reward, you have to implicitly accept the massive risk, whether you realize you've signed up for it or not. So, with all this complexity and these psychological games, how is an intelligent investor supposed to handle these things? Well, the source material gives us a powerful and incredibly clear guiding principle. The rule is simple and it doesn't compromise. You have to judge the security as one thing or the other, but never as some mushy hybrid in between. You have to ask yourself, is this a fundamentally safe bond that I'd be happy to own anyway, with the conversion feature just being a nice little bonus? Or is this company's stock so compelling that I want to speculate on it, and this bond is just a creative way for me to do that? You have to make a choice. Are you buying a safe investment that just happens to come with a free lottery ticket attached? Or are you really just buying a lottery ticket that happens to be disguised as a safe investment? There is no middle ground. And why is this so critical? Because that middle ground is where you get into serious trouble. It leads to confusion. You end up buying a risky bond you'd normally never touch because of that sweet-looking privilege. Or you pay way too much for a stock bet because it has the illusion of safety. You're basically tricking yourself, and that's a recipe for disaster. So this strict principle leads us to one final critical piece of advice from the source. And honestly, this one might really surprise you, especially if you happen to be sitting on a big winner. That's right, you heard me correctly. If your convertible bond does exactly what you hoped it would and its value soars, the source argues that the wise investor should almost always sell it, not convert it into stock. I know, it sounds crazy, right? Why wouldn't you convert and let your winner run? Well, think about it. The whole reason you bought it was for that bond-like safety. When you convert, you're voluntarily throwing that safety net away. You're trading in your position as a creditor for a position as a stockholder, fully embracing all the risks that come with it. The truly wise move is to recognize when the security has changed its character. When it's moved out of the investment range and into the speculative range, you sell, you take your profit, and you thank it for a job well done. And that's our deep dive into privileged issues. It leaves us with a really powerful final thought to chew on. It's critical to know not just what you own, but to be hyper-aware of how its fundamental nature can change right before your very eyes, transforming a safe investment into a risky speculation without you even lifting a finger. Welcome to The Explainer. Today, we're diving into something really interesting:
a special class of investments that tries to give you the best of both worlds, safety and growth. We are talking about privileged senior securities, and they're designed to give you the stability of a bond with the exciting upside of a stock.
So let's jump right in by talking about a fundamental problem every single investor faces. You've got some money, you want to put it to work, but you're immediately hit with a classic choice.
You've really got two main paths you can go down. On one side, you have the slow and steady stuff, bonds, preferred stocks. They're all about stability, a fixed income, they're higher up in the food chain, so if the company gets into trouble, they get paid first. Then, on the other side of the coin, you've got common stocks. Now, this is where the real excitement is, right? The potential for massive growth, but it comes with a whole lot more risk.
For years and years, we've all been told you have to pick one. Either play it safe or you shoot for the moon. But what if you didn't have to choose? What if there was a way to get that defensive, safe position of a senior security, but still keep the upside potential of a stock?
Well, that's exactly where privileged securities come into play. So here's how we're going to break it all down. First, we'll get into what that privilege actually is. Then we'll look at the three main types, put them head-to-head in a comparison, and finally uncover the ultimate edge this can give you as an investor.
Okay, so what is it that makes a privilege valuable? Well, it's not just one thing. If you really want to analyze one of these securities, you have to look at two totally different factors: the deal itself and the company that's offering it. And getting that balance right, that's the whole game.
The first thing you look at are the terms of the privilege, the nitty-gritty rules of the deal. The second thing is the prospects of the company. And this slide just lays out that tension between them perfectly. Look at Bond B. On paper, it looks like a slam dunk, right? You get 3 shares for your bond instead of 2. But here's the thing. Great terms on a company that's going nowhere are basically worthless. If Company A stock is about to take off, Bond A is absolutely the smarter play, even with what looks like a less generous deal.
And this brings up a really interesting challenge for investors. We all know the biggest money is made by picking the right company, but let's be honest, that's basically trying to predict the future, which is, well, it's tough. The terms of the deal, on the other hand, that's something you can actually analyze. Right here, right now, with some real certainty.
So when we're digging into the terms, what we're really looking at are 3 key elements that tell us just how powerful this privilege is. We're talking about its extent, its closeness, and its duration.
Let's kick things off with extent. You can think of this as the raw firepower of your investment. It's all about how much stock you get a claim on for every dollar you put in. Then there's closeness. How close is the stock price to the price where your privilege actually becomes profitable? Is it almost there, or is it a total long shot? And finally, duration. How long do you have? A 10-year option is obviously way more valuable than a 2-year one. But out of all these, it's really the extent that creates that explosive potential. Let's look at an example.
Okay, this table just brilliantly drives home the power of extent. Look at this. The Reliable Stores bond gives you a claim on just 5 shares. Rand Cardex, 22.5. But the Intercontinental Rubber bond, we're talking a massive 500 shares. Now watch what happens when the stock price doubles. The value of that privilege on the Intercontinental bond just skyrockets by $5,000. That is the kind of explosive power we're talking about with high extent.
All right, so now we know about these key elements, let's look at how they're actually packaged up in the real world. You're generally going to find them in 3 main flavors. These are the core types of privileged securities you'll see out there.
First up, you've got the conversion privilege. This is pretty straightforward. You can literally swap your bond or preferred stock for common shares. It's an all-or-nothing trade. Second, there's the participation privilege. This one's cool because it lets you get in on the profits, usually through extra dividends when the company's doing great, without having to give up your safe senior position. And third, we have subscription warrants, which are basically detachable long-term coupons that give you the right to buy stock at a fixed price.
So, we have our 3 types, but how do they actually stack up against each other? They've each got their own strengths and weaknesses, and honestly, which one is best can really depend on what the market is doing at the time. Now, in a perfect world, on paper, participating issues are kind of the dream. Why? Because you get to share in the company's success. You get that extra income, but you never have to give up your safer senior position. You get the upside without losing your defense.
The old Westinghouse Electric preferred stock is the perfect case study for this. It paid a base dividend of 7%, but it also got to share equally with the common stock on any dividends paid above that. So when Westinghouse was booming, these preferred shareholders were cashing extra checks right alongside the regular stockholders.
But here's the brilliant part. When things went south and the profits dried up, the common stock dividend got wiped out. But the participating preferred holders, well, they lost the extra profit, sure, but their base 7% dividend was safe and their original investment was totally fine. They just weathered the storm.
Now that sounds amazing for a steady, long-term investor. But what happens when the market goes wild? When speculation takes over? That's when a whole different type of privilege really starts to shine.
Just look at this data. This is from the absolute peak of the 1929 bull market. The number you really want to focus on is in that far right column, the premium. The two issues that came with warrants, Mohawk Hudson and White Sewing Machine, they were selling for massive premiums, 58 and 26 points above what they were worth, just as a straight conversion. Now compare that to the convertible issues. They sold for basically no premium at all.
So why on earth does that happen? It all comes down to one word: separability. See, the warrant can be detached from the bond and traded all by itself. So speculators who are hungry for high leverage on just a little bit of cash, well, they'd much rather buy the cheap warrant than the whole expensive bond. And all of that focused speculative buying just drives the price of the warrant and the whole package way, way up.
But this whole idea that you can detach the warrant, it isn't just a magnet for speculators. It actually creates the ultimate strategic advantage for the careful, long-term investor. Let's break down why.
So securities with warrants have three huge advantages. First, as we just saw, they can trade for crazy premiums in a hot market. Second, the warrant itself usually survives even if the company decides to pay back the bond early, which is a big risk for normal convertibles. But it's the third advantage. That one is the real game changer.
This quote really gets to the heart of it. It's the unique power of the warrant. Unlike a convertible bond, where your safe investment and your speculative upside are all mixed together, a warrant lets you pull them apart. You can cash in your speculative chips without ever touching your core investment. Let's make this real. Imagine it's 1929. You're holding the Commercial Investment Trust preferred stock. The warrants that came with it are now trading at a huge price. An investor could literally sell just the warrant, pocket a massive profit in cash, and still hold on to their original, safe 6.5% preferred stock. You cashed in on the wild speculation, but you kept your safe investment, which, by the way, kept paying dividends right on through the Great Depression.
This ability to surgically separate the speculative part from the core investment, it just gives you a level of strategic flexibility that other securities can't even come close to matching. And that leaves us with one final thought to chew on. If you knew you could cleanly separate risk from reward, how would that change the way you think about building your own portfolio?
Welcome to The Explainer. Today, we're going to dive deep into the fine print of convertible securities. We're going beyond the basics to uncover the hidden rules that really determine who holds the power in these surprisingly complex investments.
So let's say you own a convertible security. You've got the right to convert your bond into stock. It feels like you're in the driver's seat, right? But is that freedom of choice really as absolute as it seems? As we're about to see, the real answer is hidden in the technical details.
You see, a convertible security isn't some static, buy-it-and-forget-it investment. It's a dynamic relationship, almost like a financial tug-of-war, where the terms, and of course the value, can shift and shift dramatically over the life of the security.
You can really frame this whole topic as a strategic game between two sides. On one side, you have the investor, who obviously wants to get the most value they can out of their conversion option. And on the other side, you've got the company, which is trying to manage that conversion to benefit its existing shareholders. So first, let's step into the investor's shoes. What's the biggest threat to their conversion privilege, and what's their main line of defense? The number one risk is something called dilution. And it's pretty simple, really. If a company suddenly issues a flood of new shares without its assets growing, the value of every single share can drop. For someone holding a convertible, that means the prize you're hoping to convert into, well, it just became a lot less valuable. Your slice of the pie gets smaller.
And this dilution can happen for a few common reasons, like stock splits or big stock dividends. The good news for investors, though, is that standard convertible issues almost always have protection built right in against these exact scenarios. Now, what's really fascinating here is how that protection is formalized. It isn't just some vague promise. No, it's a precise mathematical formula written directly into the bond's contract. This is what's known as the anti-dilution clause.
And look, you do not need to be a math whiz to get the concept here. The formula's goal is really simple. If the company dilutes its stock, your conversion price gets lowered to match, making sure the value of your conversion right stays whole.
And this illustrates it perfectly. Check out this real-world example from Central States Electric. After a 100% stock dividend, boom, the conversion price was cut clean in half. Then, later on, after an even bigger 200% stock dividend, it got slashed again. This is the investor's shield at work.
But this is not a one-sided affair. While investors have their shields, companies have their own bag of tricks to influence the game in their favor. It's their turn to pull on the rope in that tug-of-war.
One of the most powerful tools a company has is the sliding scale, and its purpose is pretty clear. It's designed to pressure the investor to convert sooner rather than later, which effectively shortens the life of the option and, with it, its real value.
Now, these sliding scales usually come in two main flavors. The first is time-based. It's basically a ticking clock. The conversion price just goes up on a set schedule. The second type, though, is a little more complex. It's block-based, which turns the whole thing into a race to the finish line.
Let's see how a block-based scale actually works with the Hiram Walker bonds. As you can see right here, the early converters got the best price, and that creates a really powerful incentive not to wait around for too long.
I mean, this table makes it crystal clear, doesn't it? It is a race. The first group of investors, they get to convert at $40 a share. But if you wait and another 2 million in bonds get converted before you, your price jumps to 45. Wait even longer, and it goes up again to 55, and then 60. And the effect of this is profound. The stock actually shot all the way up to $54. Now, in a normal convertible, the bonds would have been worth a ton, at least 135. But because the sliding scale forced investors to convert early just to lock in those lower prices, the bonds' value never got to fully appreciate with the stock. They were essentially forced to cash in their chips too early.
So the key point here is that this kind of mechanism introduces compulsion. It creates a conflict for the investor, pitting that desire to wait for more profit against the fear of getting a worse deal than everybody else. It completely undermines the very freedom that's supposed to make a convertible so attractive in the first place.
Now, this battle over timing isn't the only thing investors need to watch out for. There are also some unconventional structures that can look pretty appealing on the surface, but are actually carrying some hidden risks.
A classic example is a bond that converts into preferred stock. Now, it might offer a slightly higher dividend, which sounds appealing, but here's the catch. Preferred stocks typically have a limited upside. That means your potential profit from the conversion is capped. It doesn't matter how high the company soars, your return has a ceiling. That's exactly why the source calls this a potential danger to the unwary when you compare it to a standard conversion into common stock.
Okay, now we come to a particularly dangerous variation, a feature that doesn't just influence the power dynamic, but completely flips it on its head.
For an investor, this type of provision is a massive red flag. It's a fundamental distortion of what a convertible security is even supposed to be. Here it is, a bond that is convertible at the option of the company. In this scenario, you, the investor, lose all control. The company gets to decide when and if your bond gets turned into stock, completely stripping you of your freedom of choice.
And the source material is incredibly direct about this, calling this kind of security a contraption. It argues that this isn't a bond at all, but really just a preferred stock masquerading as one, an artifice that could easily mislead an investor about what they truly own.
So the key takeaway from all this is simple. The headline features of a convertible, the interest rate, the initial conversion price, that's only half the story. The real value and the real risk are always buried in the technical details of the indenture, that formal contract between the issuer and the bondholders.
And this leaves us with a final question. Is the conversion privilege you're being offered a powerful tool for profit, or is it just a cleverly designed trap? The only way to ever know for sure is to read the fine print and understand the hidden rules of the game.
All right, let's dive into a really fascinating chapter from the Value Investor's Bible, Security Analysis by Graham and Dodd. Today, we're tackling a type of investment that most people, they either fear it or they completely forget it even exists. Senior securities of questionable safety.
So let's start with a really provocative idea straight from the masters themselves. They basically said that a huge chunk of the American market is filled with what they called misfit securities. These are the unpopular ones, the low-grade bonds and preferred stocks that just don't really fit neatly into any category. And as we're about to find out, that's exactly where the hidden opportunity might be. Okay, so here's the plan. First, we'll look at what makes these securities misfits.
Then, we'll dig into why being unpopular can actually be a good thing for an investor. We'll cover Graham's common stock approach to analyzing them, how to find hidden safety, and a really important warning about the preferred stock trap. And finally, we'll wrap it all up by seeing how these ideas are still super relevant today.
All right, let's get into it. The misfit securities. So, what actually makes a security a misfit in the first place? Well, it really just boils down to a fundamental conflict in what different investors are trying to achieve.
I mean, think about it for a second. If you're a super conservative investor, right, you're all about safety, you're not going to touch a bond that has a questionable rating. No way. It's just too risky. But what if you're an aggressive speculator? You want those huge returns, that explosive growth. So why on earth would you buy a bond with a limited capped upside? You just buy the common stock instead. So these things, they fall into this weird middle ground, this kind of financial no man's land where they don't really make anyone happy. Okay, but here's the really interesting part. This is the twist. This fact that everybody avoids them, this total lack of demand, it's not a weakness. Actually, for a smart analyst, it can be a huge, huge source of strength.
And this, right here, is really the core of Graham's whole idea. When a whole category of investments gets ignored or shunned by the market, their prices can drop to, well, just completely irrational levels. You've got a large supply of these things, but very little demand. And what that means is the price can get so low that it's way more attractive than the security's reputation is bad. It's a paradox, right? The very reason everyone ignores them is what makes them such a potential bargain.
So let's compare. When you buy a common stock, you're hoping for unlimited profit, but you're also taking on a lot more risk. With one of these speculative senior securities, your profit is capped, but the risk is supposed to be lower. Graham's point is all about the trade-off. Let's say you buy a bond for 35 cents on the dollar. If it gets paid back in full, you've made a huge return, maybe 200%. Now, is that unlimited? No. But Graham argues that most people buying common stocks rarely hold on for more than that anyway. So what you're really doing is trading that fantasy of unlimited gains for a more probable profit that has a much, much clearer risk profile. So, if the old way of looking at these bonds doesn't work, what do? How are we supposed to figure out if they're a good deal? Well, Graham comes up with a pretty radical idea. He says we should borrow a technique from a totally different world of investing. And this is just a brilliant shift in perspective. Instead of analyzing it like a bond and just asking, hey, will the company pay the interest? You flip it on its head. You start analyzing it like you're buying the whole company. You ask questions like, is this actually a good business? What does its future look like? What is this whole thing really worth? It forces you to go so much deeper, to look at the health of the entire business, not just its ability to make a payment. So this brings us to a 3-step process. First, you analyze it as if it were a common stock. That's the big mindset shift. Second, you really put the company's financials, the income statement, the balance sheet, under a microscope. And third, you have to evaluate all the future possibilities, the good and the bad. This whole approach means you're not just glancing at a yield. No, you are tearing this business down to its studs and figuring out what makes it tick. And what's cool is that when you do this kind of deep dive, you often start to find these concrete, tangible clues of hidden safety, things the rest of the market, in its rush to just label these things junk, is completely missing. So what are we looking for? Well, things like strong working capital. That's basically the company's short-term cash cushion to handle its bills. That's a huge deal for a bondholder. Another one is something called a sinking fund. This is where the company is contractually forced to buy back and retire some of its bonds every year, which automatically lowers the risk for everyone who's still holding them. These are like built-in safety nets that you just don't get with common stocks. And look, this isn't just some abstract theory. This table, it's from the original book back in 1934, and it shows real companies from the middle of the Great Depression. I mean, check out American Seating. Its bonds were trading for 17 cents on the dollar. 17 cents. And yet, the company had more in liquid current assets than its entire debt. The market was screaming bankruptcy, but the balance sheet was telling a completely different story. And here's another great example to hammer this home. Kelvinator Corporation, back in 1929. The company had some losses, so its bonds fell to 66 cents on the dollar. But get this, its net current assets were almost 4 times the market value of all its bonds put together. 4 times! And guess what happened? The bonds recovered and they were paid off in full just a couple of years later. But, and this is so important, Graham is not selling you a magic formula here. This is not a guarantee. Strong asset coverage is a powerful clue, but it's not a promise of safety. He points to other companies where this didn't work out, where a big asset cushion was just eaten away by continuing losses until it was all gone. So you have to remember, this is one really important piece of the puzzle, but it's not the whole picture. Okay, let's switch gears a little bit because we need to talk about a really powerful cautionary tale. We've been talking about opportunities, but there's also a big trap to watch out for, especially when it comes to preferred stocks. They are notorious for getting caught up in these crazy, irrational, speculative bubbles. So to keep yourself safe from this kind of hype, Graham gives us a super simple but really profound rule of thumb. He calls it the rule of maximum valuation. And it's just this: a piece of the pie can never, ever be worth more than the whole pie, right? A preferred stock is just one claim on a company. It can't possibly be worth more than the entire company itself. It sounds completely obvious, I know, but you'd be shocked how often the market just forgets. So how do you apply this rule? Graham suggests a mental exercise he calls communizing. Here's what you do. You just imagine that the preferred stock becomes the only stock. That's it. It now represents total ownership of the company. It's a simple little trick, but it's so powerful because it forces you to ignore all the confusing details, especially those big, juicy, unpaid dividends that get speculators so excited. It brings you right back to what matters. What is the underlying business actually worth? And the American Zinc case is the perfect example of this trap in action. So in 1928, there was all this hype about massive unpaid dividends, and it drove the total market value of the company up to almost $21 million. But here's the crazy part. The company had only earned about $500,000 that year, and that was after 8 straight years of losing money. If you did Graham's little communizing exercise, you'd realize you were paying a price that was completely detached from reality. The market had gone wild. Okay, so these are some really powerful lessons from the 1930s. But does any of this stuff still apply today? You know, in our world of tech companies and intangible assets and everything moving at lightning speed. Let's try to connect the dots. Well, in a more recent edition of the book, Modern Investor, Todd Combs makes the case that yes, these core principles are absolutely timeless. The goal hasn't changed. You're still trying to figure out what a company is truly worth, its intrinsic value, and then buy it for less than that. You're looking for a margin of safety. It doesn't matter if the company's assets are giant steel mills or lines of code. The fundamental job of the analyst is exactly the same. In fact, Combs boils it down to this really powerful 3-part framework. First, find a good business, one with a moat or a real competitive advantage. Second, find good management, people you can trust. And third, find it at a good price. And he says you should think of it like multiplication. If any one of those 3 things is a 0, the whole investment is a 0. And I think this is such a critical point. It really echoes what Graham was saying all those years ago about going beyond just the numbers on a page. You have to understand the business itself, the management, the competition, all that qualitative stuff. As Todd Combs puts it, a spreadsheet is great, but it's not business reality. It tells a story, but it might not be the right story. And that really brings us full circle. In a market that's always chasing the next big thing, maybe the greatest value is hiding in the assets that everyone else just ignores. So the next time you come across one of these misfit investments, one that seems unloved and overlooked, maybe, just maybe, it's worth taking a closer look.
Have you ever wondered why we feel this deep need to justify our financial decisions? You know, to wrap them in logic, even when we're really just taking a big gamble. Well, today, we're going on a journey into the theory of stock investing. We're going to see how a very seductive and very dangerous new idea completely upended time-tested principles, fueled the roaring 20s bull market, and ultimately paved the way for the historic crash that followed.
So here's how we'll break it down. We'll start with why we're all so drawn to analysis in the first place. Then we'll jump back in time to see what investing looked like in the old days. After that, we'll watch the new era theory arrive on the scene, and we'll really dissect its flaws. Then we'll look at the bubble it created with some pretty wild case studies. And we'll wrap it all up with a timeless warning that feels just as important today as it was almost a century ago.
You know, deep down, we all want to believe that our financial moves are smart, that they're driven by pure intelligence. But the truth is, even when greed or just plain speculation is the real driver, we feel this incredible urge to cloak our impulses in the respectable disguise of logic and, sound reasoning.
This quote just perfectly captures that human need for justification, doesn't it? It's a spin on a famous line by Voltaire, and it really highlights our powerful desire for a system, any system really, to validate the stocks we buy. It's like if a legitimate method of analysis doesn't exist, we'll literally invent one, we'll counterfeit it just to feel better about the gamble.
So before this whole new philosophy took over, how did people even think about the stock market? Well, let's take a trip back to the pre-war era, a time when a much more cautious and very different set of principles guided how you invested in common stocks.
The old school approach, it was built on these three solid pillars. First, a suitable dividend return. You had to get paid. Second, a history of stable and adequate earnings, no wild swings. And third, backing by tangible assets. You wanted to know there was real stuff, property and equipment, behind your stock. It was all about what was known, what was established, and what you could physically account for.
In this chart here, it really lays out the sharp line they drew in the sand back then. Investment was all about the past, looking at established records, focusing on safety. It was like buying a piece of a real functioning business. But speculation? That was all about the future. It was about uncertain prospects about what might happen. The future, back then, was seen as a gamble. Plain and simple.
Okay, let's make this really concrete. On the left, you've got the Atchison, Topeka, and Santa Fe Railway. Look at that paid per share column. It's consistent. It's reliable. That's a clear-cut investment. Now, look to the right. That's American Can. Years and years of zero dividends. Buying that stock was a pure bet on the future. A classic speculation. The difference was night and day.
But then, after the war, everything changed. The whole economic landscape shifted, and suddenly those old rules started to feel, well, obsolete. A powerful new idea began to bubble up, and it was about to completely revolutionize how people thought about stocks.
And here it is. This is the entire new era philosophy, boiled down into one simple, incredibly seductive sentence. Forget the past. Forget the assets. Forget the dividends. All that matters is the future. All that matters is growth.
And just like that, this new theory took a wrecking ball to the old pillars of investing. If future earnings are the only thing that matter, then of course, dividend rates become unimportant. Asset values? Meaningless. And past earnings? They only mattered if they were pointing in one direction, up. Now, this new philosophy was plausible, it was exciting, but it was hiding two absolutely catastrophic flaws. First, it completely blurred that old, clear line between investment and speculation. And second, and this is the truly absurd part, it taught people to completely ignore the price of the stock itself.
Let's just look at the math here. The old school standard said a good stock was worth maybe 10 times its average earnings. But in the new era, people were happily paying 35 times a company's peak earnings or even more. And the conclusion wasn't that stocks were getting too expensive. No, the conclusion was that the very definition of value had changed.
So what exactly was this new era investment when you stripped away all the hype? Well, it was just old-fashioned speculation, but with a respectable new twist. You were only supposed to speculate on companies that had a nice, rising earnings trend. It was really just a fancy way of saying, investment is just speculation that works out.
The psychological impact of this was just staggering. This new way of thinking made getting rich in the stock market seem effortless. All you had to do was buy stocks with a rising trend and then just wait. It's no wonder this belief fueled a mass exodus from productive work right into the financial markets. It was a gold rush, and Wall Street was the destination.
All right, enough theory. Let's see how this flawed idea actually played out in the real world, because it led to some truly disastrous decisions by pretty much everyone, from regular folks to the so-called experts.
One of the biggest ironies of this whole era was the behavior of the expert investment trusts. These were the pros. They were set up to manage money using sound, time-tested principles. But in the heat of the mania, they threw their own rule books out the window. They ended up just buying the most popular, most expensive blue-chip stocks, just like everybody else.
This slide right here perfectly captures the market's one-track mind. You've got three companies, A, B, and C. The new era theory meant investors basically ignored their 5-year average earnings. They were focused on one thing and one thing only. Which way is the trend headed?
And this bar chart, wow, it just reveals a stunning disconnect from reality. On the left, you can see that Company C, which was Chicago Yellow Cab, had the highest 5-year average earnings. Solid performer. But look at the right bar. The market in 1929 valued Company A, Electric Power and Light, at more than double Company C, even though its earnings were lower. Why? Simple. Company A's earnings were trending up. And in this new game, that's all that mattered.
The tragic story of this one company, Schletter and Zander, is the perfect example of this trend-chasing madness. From 1925 to 28, its earnings growth was that beautiful, perfect upward curve the market was desperate for.
So, naturally, at its absolute peak in 1929, it went public, and then the inevitable collapse. By 1931, the company was being liquidated. The stock was worthless. That perfect trend turned out to be a perfect trap.
So what's the big takeaway from this incredible story of market psychology? Well, it's a really powerful lesson about logic, illusion, and the stories we tell ourselves to justify our bets. And honestly, it's a lesson that remains critically important for anyone investing today.
The core mistake of the new era was so subtle, but so devastating. It took a totally sound idea that stocks can have great long-term value and twisted it to support a dangerously unsound conclusion that the price you pay for that stock doesn't matter. They completely forgot that overpaying for even the best investment can wipe out your entire advantage.
And this all brings us to one final, crucial question for ourselves. The names change, the technologies change, but human psychology? That stays pretty much the same. So when we see a stock today with that beautiful upward trend, are we really investing in durable long-term value? Or are we just speculating with a much more compelling story? It's definitely something to think about.
So, what happens when the entire playbook for investing just gets torn up? You know, when the old rules completely fail, investors are left scrambling for a new philosophy, something that actually works. Today, we're going to dig into that exact search. We're exploring a new set of principles for stock investment, trying to find a reliable guide through all the chaos of the market. Let's jump right in.
Okay, so where did everything go so wrong? Well, first you had the old school approach. Just find a company with stable, predictable earnings and you're set. But that idea was completely shattered by just how unstable businesses had become. So then this new era idea pops up. Forget stability, just follow the upward trend of earnings. But that blind faith, that total lack of restraint, well, it led to what the author calls an appalling debacle. With both of these core strategies in total ruins, where in the world does that leave an investor?
All right, to get through this, we're going to take a little journey. First, we'll really look at the crisis itself. Then, we're going to investigate three very different philosophies that came out of the mess. This optimistic idea of just riding the economic wave, the really ambitious strategy of trying to pick individual winners, and the disciplined approach of buying things when they're on sale. And then finally, we'll uncover the one core principle the author believes is the investor's true north.
So yeah, we start with this fundamental crisis. The old playbooks? They're totally useless. The real question hanging over everyone's head is, if the old rules are broken, what new principles can we possibly trust to guide us? It was pretty clear the entire foundation of investing had to be rebuilt, literally from the ground up. Out of all that chaos, a new framework started to take shape, and it was resting on the three key pillars. First, a major shift in mindset. Stop trying to bet it all on a single stock and start treating investment like a group effort, through diversification. Second, a whole new level of rigor was needed. I'm talking about applying the same tough qualitative and quantitative test to a stock that you'd apply to a supposedly safe bond. And third, it demanded a much deeper, more real effort to figure out where a business was actually headed.
All right, that leads us right into our first big strategy to emerge from the wreckage, and it's a pretty optimistic one. It's basically built on that old saying, a rising tide lifts all boats. But the real question is, can an investor just bet on the general expansion of the economy and really expect to do well over the long haul?
This whole idea is called secular expansion, and at its core, it assumes that a country's wealth and its earning power are just naturally going to grow over the long run. And if that's true, then a well-diversified portfolio of stocks should just kind of ride that wave up almost automatically. It's really a bet on the whole system.
But, and this is a huge but, here's the crucial counter-argument. The author warns that after the bitter experience of the last crash, you just can't take this for granted anymore. We all know past performance is no guarantee of future results, right? The key takeaway here is that relying on the economy's general growth alone is just not a reliable way to get both safety and profit. Caution had to become the new watchword.
So if just passively riding the economic wave isn't safe enough, what about being a bit more active? Well, this brings us to the second major strategy, the really ambitious attempt to pick individual growth companies, the superstars that are expected to outperform everyone else.
Now, we have to get really specific about what a growth company is, because it's important. We're not just talking about a company that's having a good year. No, according to this philosophy, a true growth company is one whose earnings just keep marching forward from one economic cycle to the next. Even a major depression is just a temporary speed bump on its long upward path.
And to make this a little more concrete, check out some examples of companies that were considered the growth companies of their day.
You see these names like Coca-Cola, IBM, Dow Chemical. These were businesses that had shown this incredible ability to expand even when the economy was tough. They were the absolute superstars of their era.
And that brings us to the million-dollar question, doesn't it? It's really easy to look back and point out the winners. But can an average, even a really smart investor, reliably pick them out before they become those superstars? This is where this whole strategy starts to get incredibly difficult.
The author points out this fundamental dilemma, this sort of catch-22. If you go with a newer company, yeah, it might have an impressive but short record. How can you be sure it's not just a flash in the pan? But if you go with an established giant, you face a totally different risk, that it's nearing its saturation point. That point where all that incredible growth finally sputters out. You're basically caught between unproven potential and potential exhaustion.
Okay, so if history is a tricky guide, what about looking at a company's investment in the future? I mean, a common idea is to focus on companies with big research and development labs. Surely innovation is the key to growth, right?
Well, not so fast. The author's warning here is really stark. Just having a big, fancy research lab is basically meaningless on its own. To make a smart decision, an investor would need to become an expert, evaluating the quality of the research, the talent of the actual scientists, the commercial potential of the entire field. The point is, this is an incredibly difficult thing for any outsider to do, and the chance of getting it wrong is just huge.
And you know what? Even if you could somehow perfectly identify the next great growth company, you run smack into the biggest obstacle of all, the price you have to pay for its stock.
So here's the pricing problem in a nutshell. The market isn't stupid. Everyone knows these companies have great prospects, so their stocks already sell at sky-high prices. When you pay that premium, you're not just buying the business as it is today. You're paying for years and years of future growth that hasn't even happened yet. That's a huge gamble. The author's conclusion is blunt. It's almost impossible to figure out a fair price today for earnings that are completely uncertain tomorrow.
So if forecasting the whole economy is unreliable and forecasting individual company growth is just filled with peril, what's left? This brings us to our third major strategy, which shifts the focus completely away from prediction and puts it squarely on price. So welcome to the margin of safety principle.
The whole idea of a margin of safety is just beautifully simple and so powerful. It's the principle of buying something for significantly less than you calculate it's actually worth. This discount, this margin, it acts like a buffer. It protects you if the future turns out worse than you expect, or even if your own analysis was just plain wrong. It's a defensive, really business-like way to buy stocks.
Now, an investor can apply this principle in two main ways. The first approach is all about market timing. You just wait patiently for widespread pessimism to make the entire market cheap, and then you start buying. The second technique is more like a treasure hunt. You don't wait for a market crash. Instead, you're actively searching for individual bargains, specific companies that are undervalued even when the overall market seems pretty expensive.
Now, market timing sounds logical on paper, but it comes with these massive psychological hurdles. It requires just immense fortitude. I mean, you have to force yourself to buy when the news is terrible and everyone else is selling in a total panic. And then you have to sell when everyone is euphoric and totally optimistic. This often means sitting on the sidelines for years, which most people, let's be honest, find almost impossible to do.
Okay, so after looking at all these different strategies, the author offers us a true north, a single reliable touchstone to figure out what is a true investment versus what's just simple speculation. And here it is. This is the ultimate test for a true investment. The question is the price you're paying for a share of the company far less than what a smart, informed business owner would pay for the whole thing? Just asking that one question completely shifts your perspective. You stop being a trader of little paper assets, and you start thinking like a part owner of an actual business.
So at the end of the day, the crucial point is this. The author defines true investment not as forecasting the future or trading the market swings. Instead, it's the disciplined work of finding good, solid, profitable companies that are just currently unpopular and buying them at a significant discount to their real underlying business value.
So we've walked through three very different philosophies: the broad bet on the entire economy, the difficult hunt for superstar companies, and the disciplined search for a real bargain. The question I'm going to leave you with is this. After seeing these distinct approaches, which one of them best defines what investment truly means to you?
Welcome to The Explainer. Today, we're digging into a question that has been at the heart of investing for, well, about a century. What should a company do with its profits? Should it pay them out to you, the owner, as a nice, crisp dividend? Or should it hang on to that cash and reinvest it for future growth? And you know what? The answer isn't nearly as simple as you might think, and getting it right is absolutely fundamental to being a smart investor.
You know, it was the father of value investing himself, Benjamin Graham, who nailed the problem perfectly decades ago. He saw this deep-seated confusion about what to do with company profits. A confusion that, believe me, can have a massive impact on your returns. All right, so here's our game plan for today. We're going to start with what we're calling the dividend dilemma. Then we'll jump in a time machine and go back to an era when dividends were everything. From there, we'll see how Graham completely dismantled that old way of thinking, what he proposed instead, and finally, we'll bring it all into the modern day and see how his wisdom can help us as investors right now. First up, the dividend dilemma. So at its heart, this whole thing is about a conflict, a tension in your role as a stockholder. Think about it. Are you just along for the ride, waiting for a payout, or are you a real partner in the business?
So this really gets to the heart of it. You're basically wearing two different hats as a shareholder. On one hand, you've got the security owner. This part of you just wants that steady paycheck, right? You see the company as a cash machine. But then there's the business partner in you, the one who wants the company to pour those profits right back in to grow even bigger. And these two desires are constantly pulling in opposite directions.
Okay, so to really get why Graham's ideas were such a big deal, we've got to go back in time. We're going to look at the old Wall Street dogma, back to a time when the market was obsessed with just one thing, one number above all others, the dividend.
And the perfect case study for this is the American Sugar Refining Company, way back in the early 1900s.
Okay, look at this. This data just says it all. I mean, look at those earnings per share. They're all over the map, jumping from over $18 a share all the way down to just 2 cents. Total chaos. But then look at the dividend payout. Rock solid. $7 every single year. The market loved that stability, and it valued the stock based on that dependable payout, pretty much ignoring the wild roller coaster ride the business was actually on.
So what does this tell us? Basically, investors were acting like they owned a bond, not a stock. They weren't really focused on how healthy the business was or its actual earning power. Nope. All they cared about was getting that predictable check in the mail, that $7 dividend. In those days, predictable income was king.
Now, let's look at the flip side of this coin. Let's check out another classic example from that era, the Atchison, Topeka, and Santa Fe Railway. And believe it or not, this story is even more telling. For a whole decade, Atchison was just crushing it. I mean, their earnings were amazing, $12, $14, even $17 a share. But the dividend? It was stuck, just flatlined at $6. The company was earning more than double what it was paying out year after year after year.
And the result was pretty obvious, right? The stock price was just chained to that $6 dividend. The market was practically screaming, "We don't care how much money you're making. Just tell us how much you're going to pay us." The company's incredible growth and success were being almost completely ignored.
Right. And this is where Benjamin Graham comes into the picture. He looked at companies like Atchison, and he started to just tear down this old way of thinking. He starts asking, hey, this conservative policy you guys in the boardroom have of holding on to all this cash, is it really all that smart?
So Graham puts his finger on this basic conflict of interest. The typical investor is thinking, look, it's my money, I want my dividend. But the management comes back and says, nope, trust us, we're going to keep your money to make the company stronger for the future. And for generations, investors were just taught to nod and accept that management knew best.
And U.S. Steel is just a jaw-dropping example of this. Over a 30-year period, the company piled up a mind-boggling $1.25 billion in profits it never paid out. This was a massive war chest, a rainy day fund, built entirely with money that really belonged to the stockholders.
But here's the real kicker. After spending 30 years building up this massive financial fortress, you want to know how long it held up when things got tough? 1.5 years. That's it. A short downturn in business was all it took to completely wipe out the benefit, and the dividend got cut entirely. 30 years of savings, gone in a flash.
And this quote from Graham really nails his whole argument. It's so important. You see, there's this old saying, what's good for the company is good for the shareholder. And Graham points out that this has a huge, fatal flaw. Sure, keeping the profits makes the company's balance sheet look stronger, but whether that actually helps you, the owner, in the long run, well, that's a completely different question.
So, after taking a wrecking ball to the old way of thinking, Graham proposed a solution. He came up with a really powerful new principle, one that was designed to put the power back where it should be, with the owners.
And this, right here, is the core of his solution. Graham's point is this. Those earnings, they belong to the shareholders, period. It's their capital. So management shouldn't just get to keep the profits by default. No, they should have to come to the owners and specifically justify why reinvesting that capital is a better deal than just giving you the cash. Suddenly, the burden of proof is on management to convince you it's a good idea.
Now, let's fast forward. How have these ideas that were born in the age of steel mills and railroads, how have they been adapted and evolved for today's world? And that's the billion-dollar question, right? In a world of tech giants and lightning-fast innovation, do these principles from the Great Depression era still matter? And the answer is a huge yes. But they've definitely evolved.
See, Graham's original method was all about the numbers. He was looking for a margin of safety by, say, buying a company for less than its physical stuff was worth. But the modern view is much broader. It recognizes that so much of a company's value today isn't in its factories or inventory, right? It's in the brand, the software code, the network of users. So that margin of safety now also comes from the quality of the business, its competitive advantages, and its real potential to grow.
And this quote about Microsoft back in 2010 is just a perfect example of this new way of thinking. See, back then, most people thought Microsoft was, well, kind of washed up, a slow value stock. But a modern value investor saw a fantastic business with real growth ahead of it, trading at a good price. They saw management wisely taking those retained earnings and plowing them into a huge new opportunity, cloud computing, which ended up generating massive returns. Buying a great, durable, growing business at a reasonable price, that's the ultimate evolution of Graham's ideas. It's both value and growth. All right, so we've taken this whole journey through investing history. Let's boil it all down to one final actionable lesson you can use as an investor today. So here's the big takeaway. Graham's genius was teaching us to look past the dividend check itself and ask a much, much deeper question. For every dollar of profit your company keeps instead of paying you, ask yourself this. Is the management treating that money like it's yours? Or are they being smart stewards, investing it with the same care and focus on getting a great return that you would? Or are they just piling up cash? That question right there, about the intelligent use of an owner's capital, that is the real dividend factor that has stood the test of time. Welcome to The Explainer. Today, we're becoming financial detectives. We're going to look past the big headline numbers, peel like the layers of corporate earnings reports, and really understand the story a company's income account is telling us. So here's our game plan. We'll start with Wall Street's favorite shortcut for valuing stocks. Then we're going to tear it down and show you why it's so flawed. After that, we'll open up some real-world case files to see exactly how these numbers can be misleading. We'll also tackle a really special case, and then finally, we'll arm you with a much better framework for doing your own analysis. Okay, let's dive right in with the usual suspect, the formula you see everywhere. It's become a crutch for so many people because it seems incredibly simple. But you know what? That's exactly what makes it such a dangerous trap. I mean, on the surface, this looks totally logical, doesn't it? You just take the current earnings per share, the number everyone talks about, and you multiply it by this thing called a quality coefficient. Now, that coefficient is just a fancy way of saying, a number that captures the company's reputation, market hype, all that fuzzy stuff. It seems so clean. But here's the million-dollar question. What if that one number, that current earnings per share, is basically a house of cards? What if the very foundation of this whole way of thinking is completely wrong? Because as we're about to see, betting your investment strategy on this one, often shaky number, well, it can be a huge mistake. So let's start pulling out that thread. Let's talk about the earnings figure itself, because the truth is, that number isn't nearly as concrete as it seems when you see it on a screen. And look, you don't have to take my word for it. The source material is crystal clear here. It gives this really strong warning against getting fixated on just the earnings. When you do that, you're essentially trying to fly a plane in a storm with only one instrument on the dashboard, and that instrument might be broken. I mean, just think about what you're giving up. You're ignoring a company's actual tangible assets, its factories, its cash, and you're betting everything on a single number that can swing wildly from one quarter to the next. And most importantly, it's a number that can be actively manipulated to tell a story that isn't quite true.
And that right there is where our real investigation starts. It's not just about market volatility. A company's management has a surprising amount of leeway in deciding what that final earnings number looks like. So let's get into how they do it. Okay, I know these might look like super dry accounting terms, but trust me, these are the tools of the trade. This is where the magic, or the deception, really happens. For example, a company can take a huge loss and just tuck it away in a surplus account so it never hits the main income statement that everyone sees. They can tweak how they account for depreciation to make profits look bigger than they are. These aren't just details. They can fundamentally change the picture of a company's health. All right, it's time to crack open our first case file. We're going to look at one of the most common tricks in the book, misclassifying those special one-time profits and losses to make the business look way healthier than it actually is. Our first stop is 1926 with a company called Manhattan Electrical Supply. Now, if you just looked at the headlines, you'd think they were having an absolutely incredible year. But as we're learning, the real story is never in the headlines. Just look at the difference here. The company is shouting from the rooftops that they made over $10 a share. Amazing! But when our detectives go in and adjust for a few things, the real ongoing operational earnings, they're less than a third of that, around $3.40. So where did all that extra profit come from? And here's the trick. They sold off their battery division, which gave them a huge one-time profit. And you can bet they put that front and center on their income statement. But in that same year, they also had a massive one-time loss. So where did that go? Well, they buried it. They charged it directly to a surplus account, hiding it from plain view. It's a classic case of financial sleight of hand. You highlight the good stuff and you hide the bad.
All right, let's move on to our next case. This one shows how profits from selling investments, which has absolutely nothing to do with a company's core business, can create this powerful illusion of growth.
So at first glance, this is what you want to see as an investor, right? Income is soaring, nearly doubling in a single year. You'd be thinking this company is on fire.
But here's the smoking gun. If you dig a little deeper, you find that a whopping $560,000 of that 1928 profit came from a single one-time sale of investments. That one sale accounts for almost the entire increase in profit for the year. The actual business, it was basically flat.
Now this next move is, well, it's pretty darn clever. Companies can literally create profits just by buying back their own debt for cheap. So imagine a company has a $1,000 bond floating around, but in a bad market, it's only trading for $700. The company can just swoop in, buy its own debt back for $700, and then book that $300 difference as a profit. This became a really popular game during the Great Depression.
And this is a fantastic example. Look at this income statement from 1915. The company's actual operations brought in about $741,000, but they owed over $1 million in interest payments, so they were losing money. But then you see this magic line item, profit on redemption of notes, for $1.3 million. Without that accounting trick, they couldn't have even covered their bills. Okay, for our last case file, let's look at a company that basically threw all of these tricks into one report. And get this, this is actually the successor company to the first one we investigated, Manhattan Electrical Supply. Some habits, it seems, die hard.
This thing is a masterpiece of misdirection. Just look at 1932. Up top in the income account, they made sure to add in a $174,000 profit from buying back their bonds. It makes their loss look smaller. But then, down below, in separate accounts, they've tucked away over $2.4 million in various losses, from writing down inventory, from bad investments, all charged against capital and surplus so it doesn't hurt that main income number. It's the same old playbook. Showcase the profits, hide the pains.
Now let's switch gears and talk about a sector where this whole problem gets even more complicated and, honestly, a lot more dangerous. I'm talking about financial institutions, banks, insurance companies, investment firms. For them, this isn't just tricky, it's a whole different beast. So here's the crucial difference. For a normal company, selling off stocks is a special one-time event. But for a bank, that's their day job. So when the stock market is booming, their profits look astronomical. Everybody gets fooled into thinking this is their normal, stable earning power, and their stock prices shoot to the moon. This encourages them to take on more and more risk. But what happens when the market turns? Those earnings vanish, the stocks crash, and public trust gets shattered, sending ripples through the whole economy. So after seeing all these traps and all these games, how does a smart analyst, a financial detective,
actually cut through all the noise to get to the truth. What's the right way to approach this?
It all comes down to this three-part framework. You have to wear three different hats. First, you're an accountant detective. You have to go through the reports, strip out all those one-time items, and figure out what the true recurring earnings are. Second, you have to be a business analyst. You look at the trend of those real earnings and ask, what does this tell me about where the business is heading? And only then, third, can you put on your investor hat and start to figure out what the company is reasonably worth.
And I want to leave you with this final, really important thought. Even with the best analysis, the most careful detective work, the number you come up with is still just a more correct version of the past. It is not the whole truth, and it is definitely not a guarantee of the future. It's a humbling reminder that great investing will always be a blend of science and art, and it requires us to be skeptical, to think critically, and to always, always look beyond the headline number.
All right, today we're putting on our detective hats. We're going to go on a financial mission, looking way past the big, flashy numbers on an income statement. We're hunting for the secrets hidden in the fine print, specifically how these special items and extraordinary losses can completely flip the script on a company's story. Let's get into it.
I mean, that sounds nuts, right? Something straight out of a magic act. But what if I told you that, with a little bit of accounting sleight of hand, a company can make its future profits look way, way bigger than they actually are? That is the central mystery we are going to unravel today.
And hey, those aren't my words. That's a direct quote from our source material. And wow, what a statement. It just goes to show how serious this stuff can get. We're talking about shifting huge sums of money around, often leaving investors totally in the dark.
So, first things first, let's pull back the curtain on this illusion. How in the world are these earnings manufactured? Well, it all boils down to a very specific set of practices that can turn a company's financial picture completely upside down.
Okay, here's the trick. A company takes a massive loss in 1 year, but instead of putting it on their main income statement, they deduct it from their surplus account. You can think of surplus as the company's long-term savings account, all the profits from past years piled up. So this huge charge, it often goes completely unnoticed. But then, in the years that follow, the benefits from that big write-down flow back as pure income, making the company look unbelievably profitable.
Let's make this real. So, picture a company. They've got inventory and receivables worth about $2 million. Based on that, they're expecting to make a nice solid $200,000 profit next year. Simple enough. But what if, in this year, they decide to take an excessive charge against that surplus, writing those same assets all the way down to just $1.6 million?
Well, what happens the next year is pure magic. When they sell all that inventory, poof, the profit is suddenly $600,000. See that extra $400,000 they wrote down last year? It just reappeared as income. The big charge to surplus kind of flew under the radar, but you can bet this massive credit to income is going to get a lot of attention.
And that's the whole point. The reported earnings are now 3 times what they should have been. This shows you the danger, right? An investor who's just looking at that bottom line earnings number would think the company had an absolutely spectacular year, when in reality that profit was just manufactured the year before.
Okay, let's move from the hypothetical to a real-world financial mystery. This is the story of 2 giants in the tire industry back in the 1920s, a time when rubber prices were swinging like crazy. And trust me, their accounting choices tell us everything.
So on one side, you've got U.S. Rubber. When rubber prices crashed and they faced these huge inventory losses, they did exactly what we just talked about. They charged those losses directly to their surplus account, keeping them off the main income statement. But then you have Goodyear. They took a totally different route. They set aside reserves for potential losses out of their annual earnings. So one method hides the loss from the income statement, and the other one, well, it faces it head on.
So what did this look like to the public? Well, if you were an investor back in 1928 and you opened up a financial manual, this is what you'd see. And on the surface, U.S. Rubber looks like the clear winner, right? They're showing an average 3-year earning of $8.91 per share. Goodyear is only at $7.42. Seems like an open and shut case.
But of course, as financial detectives, we know you can't just take things at face value. The accounting methods were totally different, so that comparison is it's flawed. We've got to adjust the numbers to see what was really going on under the hood.
And bam! Look at how the story completely flips. This is the big reveal. When we adjust U.S. Rubber's earnings to actually include their inventory losses, their 3-year average plummets to just 49 cents a share. It's just gone.
And all of a sudden, Goodyear, with its consistent $7+ looks way more stable and way more profitable. The illusion is completely shattered.
And, this wasn't just some game with numbers. It had very real consequences. Just look at the stock prices during this time. The average price for U.S. rubber was 62, while Goodyear was hanging out down at 40. It seems pretty obvious that U.S. rubber's accounting successfully hid its weaker performance, and it convinced the market that it was worth more than its much more profitable competitor. So we've seen how these special charges can hide losses. But, and this is interesting, sometimes they can actually hide potential value. Let's flip the coin and look at another kind of clue you can find buried in an income statement.
This thing is called idle plant expense. Basically, a company has a factory or a mine that's just sitting there, not running. But they still have to pay for it, right? Taxes, insurance, maintenance. These costs are a drag on the current income, for sure. But here's the question. Are they a permanent problem, or are they a hidden opportunity?
Oh, this is a great story. The case of the New York Transit Company is the perfect example. A key pipeline of theirs went idle, and the cost to maintain it plunged the company into reported losses. The stock price just collapsed. It fell way below even the cash the company had in the bank. The market looked at that idle pipeline and just saw a permanent money pit. But a sharp analyst looked at the same thing and saw an asset with hidden value. And sure enough, the company eventually sold that pipeline for a huge amount of money, and stockholders got cash payments that were almost double what the stock's low price had been. Incredible.
This quote just nails it, doesn't it? The verdict of the market isn't always rational. Sometimes it's really just based on fear, on mob psychology, and on a super shallow reading of the numbers. By digging just a little bit deeper into an item like idle plant expense, an analyst can spot a massive gap between the market price and the real intrinsic value.
Okay, for our final section, let's add one more tool to our detective kit. This one is all about spotting expenses that absolutely should be in the income statement, but have been sneakily moved somewhere else.
These are called deferred charges. So think about a massive advertising campaign or the cost of developing a brand new product. The expense happens right now, but the benefits, hopefully, will be felt over several years. So the proper way to account for this is to spread that cost out over those future years. But here's the gimmick. Some companies will write off the entire future cost all at once in one big charge against surplus. And what does that do? It totally frees up all future income statements from that expense. It's like prepaying an employee's salary for 10 years in a lump sum, and then pretending you have zero salary costs for the next decade. Of course, your future profits are going to look artificially high.
And here's what this can look like out in the wild. Hudson Motor Car Company was charging things like special advertising and development of new models straight to surplus. I mean, these are normal, everyday costs of doing business. By moving them out of the income statement, they made their operating performance look a lot better than it really was.
And the impact can be absolutely stunning. Get this, in 1926, Kraft Cheese reported over $1 million in earnings. But turns out they'd been treating a huge chunk of their advertising costs as a deferred charge and then writing it off against surplus. When they had to restate their earnings to get listed on the New York Stock Exchange, their profit was cut by more than half, all the way down to just $461,000.
And the list just keeps going. The savvy analyst should always be on the lookout for things like bond discount amortization, losses from closing stores, or special reserves for new products, all of them being charged to surplus instead of income. Every single one is a red flag that future earnings might be seriously overstated.
And this all brings us to our final question. A lot of these practices were actually defended as being conservative accounting. Take the big hit early. But as we've seen, they can also paint a deeply misleading picture of a company's financial health. The critical takeaway is this. As an analyst, as an investor, you just can't read the headlines. You have to be a detective. You have to read the fine print, and you have to always, always ask what story the numbers are really trying to tell you. Today, we're cracking open some old-school corporate books to uncover some of the most clever and, let's be honest, some of the most shameless accounting tricks in history. You're going to see how, long before things got super complicated, companies found some truly creative ways to use their financial statements to mislead everyone.
So let me ask you this. Can you really trust a company's reported earnings? That big headline number everyone obsesses over, earnings per share. What if I told you that number could be a complete fabrication, that a company could look like it's making millions when in reality it's barely scraping by?
It really makes you question how solid those numbers you're looking at really are.
All right, let's play financial detective for a bit. We're going to investigate some of the most creative corporate lies ever told. The crime scene, the income statement, and the evidence, well, it's been there the whole time, hidden in plain sight inside dusty old annual reports. Our job is to follow the clues and see exactly how they pulled it off.
Okay, our first case is a real work of art. I mean, it's a masterclass in literally making money from nothing. We're heading back to the roaring 20s, a time when if you had a hot story and a big profit number, your stock could go through the roof.
So, check this out. This is the number that everyone saw. In 1929, a company listed on the New York Stock Exchange, Park and Tilford, came out and said they made over $1 million in net income. That works out to $4.72 a share. I mean, that's a pretty solid number, right? For sure, it got investors excited.
But was that income even real? I mean, that's the million-dollar question, isn't it? Look, your first instinct when you see a number like that is probably to just accept it. But a real analyst, our financial detective, knows you gotta dig. And boy, when they did, the whole thing just started to unravel.
And boom, here's our first big clue. You see, companies have two audiences, their stockholders and the tax man. And you can bet they try to make their income look as high as possible for investors, but as low as possible for the government. So clever analysts could look at the taxes they paid and work backwards. And what did they find? Park and Tilford told the government they only made $744,000. That's over $300,000 less than what they told investors. That is a huge red flag.
So where did all that extra phantom profit come from? Well, the answer wasn't on the income statement, it was buried in the balance sheet. Take a look at this goodwill and trademarks line item. It just, poof, jumps by $1 million in about a year and a half. And no, they didn't buy another company or some valuable brand, they literally just decided it was worth more.
Okay, so how on earth did they justify this? Well, their story was that they were capitalizing their advertising expenses. But here's the thing, that's not how accounting works. Advertising is an expense. You spend the money, it reduces your profit for that year. Simple. But what they did was take that cost, hide it on the balance sheet by calling it goodwill, and presto, their income looked way, way better than it actually was. I mean, this is accounting 101 of what not to do.
And if you needed a smoking gun, here it is. In the financial world, not having an independent auditor's report is the reddest of red flags. Think about it. It's like a restaurant telling the health inspector, nah, you can't come in here. It basically screams that no respectable accountant would touch these numbers with a 10-foot pole. For any smart investor, that right there should have been game over.
Okay, so that was a pretty straightforward trick. But now, let's look at something a bit more sophisticated. We're getting into the territory of a full-blown shell game, using parent companies and subsidiaries to hide the truth. The lies here get a lot more creative.
Okay, you gotta get ready for this next one because it is truly wild. A company called United Cigar Stores had tons of long-term leases for their shops. Now, a lease is a liability, right? It's a bill you have to pay every month. But this company had the genius idea to say, you know what? These liabilities, they're actually assets, and they're going up in value. And then they just started adding this totally imaginary value to their income every quarter.
I mean, this was just pure fantasy for so many reasons. For one, you can't pay your bills with appreciation. It's not real money. Two, a lease is a debt. It's not an asset. And even if you wanted to argue they were more valuable, that didn't just happen that quarter. They just made up a number. And the craziest part? The proper way to account for this would have actually lowered their profits, not boosted them.
And what was the result of all this financial alchemy? Well, they reported earnings of almost $6 a share in 1925. And to the average person looking at that, it would have looked like a fantastic growing company. It was a great story, as long as you didn't look too closely.
But of course, we're going to look closer. Once you take away all that nonsense, what were the real earnings? Just over $5 a share. So they inflated their profits by almost 15%, all by pretending their rent payments were a source of income. Unbelievable.
But wait, it gets even better. Because this deception didn't stop there. You see, United Cigar Stores was owned by a parent company, Tobacco Products. And they looked at this fake profit their subsidiary was creating and basically said, hold my beer, we can make this even bigger.
Yeah, this quote from the source material really says it all. This wasn't just a simple lie anymore. It was, and I quote, an unscrupulous exploitation of the whole system. They were literally stacking lies on top of lies, using the parent company structure to multiply the fake profits.
So get a load of these numbers. Tobacco products reported a massive $11 per share in earnings. How? Well, they took the dividends from United Cigar, dividends paid out of fake profits, remember, and then just tripled their value on their own books. It's insane. When you clean up the mess and look at the actual combined earnings, the real number was closer to 7.25. They overstated their profit by nearly 50%.
You know, as complicated as all that sounds, sometimes the tricks were just shockingly simple. I mean, our last example is maybe the most brazen of them all. It's about a railroad that literally figured out how to call its own cash new income.
The logic here is just, wow. Okay, follow this. Step 1. The parent company needs to show more profit. Step 2, its subsidiary doesn't have enough real profit to pay them a big dividend. So, step 3, the parent just donates $1.5 million to the subsidiary. Step 4, the subsidiary immediately gives that exact same money right back to the parent and calls it a dividend. And then the parent reports that money as earnings. It's exactly like taking cash from your left pocket, putting it in your right, and then announcing to everyone that you just got richer.
So after all that, I bet you're thinking, okay, that's crazy, but how could anyone have possibly spotted these tricks? And that's a great question. The good news is you could have. The clues were right there if you knew where to look. We basically have a two-part financial detective kit for this. Okay, so here are the two big tools you need. First, the balance sheet check. The golden rule is you never look at the income statement by itself. You always have to compare it to the balance sheet. When you see a weird asset like goodwill suddenly inflate out of nowhere, like with Park and Tilford, that's your alarm bell. And second, the income tax check. If a company's story to its investors is wildly different from its story to the IRS, something's fishy. It's a really simple, powerful way to see if they're telling the truth.
So when you look at all of these stories, the goodwill tricks, the fake lease income, the circular cash payments, they all point to one single incredibly important lesson. It's really the golden rule for any analyst or investor.
And here it is. This is the single most important thing to remember. Once you find evidence that a company's management is playing games with the numbers, you're done. You don't try to fix their math or guess what the real profit is. You just walk away. Because if they're willing to lie to you about the numbers, what else are they willing to do? It's a red flag about their integrity, and that's a risk you just don't take.
Now, a lot of the specific tricks we talked about today, like just writing up goodwill, well, the rules have changed, and you can't really do that anymore. But let's be honest, the motive, the desire to make your company look as good as possible, no matter what, that hasn't gone anywhere. It really makes you think, doesn't it? What are the misleading artifices of today? And do we have the right detective tools to catch them?
All right, let's pull back the curtain on a company's financial reports. We're going to look past the big flashing numbers and find the real story, and sometimes the little bit of magic that's hidden deep inside the accounting. So let me just ask you this. What if the profit a company shows you isn't really a hard fact, but more like a story they're choosing to tell? It turns out the way a company deals with its stuff wearing out can totally change the plot of that story. And you know, the biggest clues for figuring out what's really going on are often hidden in plain sight. They're tucked away in a line item that, honestly, most people's eyes just glaze right over. But that's exactly where the games are played. We are talking about depreciation. Now, I know, that word sounds incredibly boring, but stick with me here, because I promise you, by the end of this, you'll see it's actually a super powerful tool that can either show you the truth or completely twist it. So what is it really? Well, think of it this way. A company buys a big machine. It's not going to last forever, right? Depreciation is just an expense on paper that shows that machine is losing value over time. But here's the absolute key. It's a non-cash charge. No actual money is leaving the bank. And because it's just an estimate on a spreadsheet, it gives management a ton of wiggle room. And depreciation has a few cousins you should know about. You've got depletion, which is for when an oil company uses up its oil reserves, and amortization, which is for things you can't touch, like a patent. They all do pretty much the same thing, spread a big cost out over many years. Okay, let's get into our first case file to see how this all works in the wild. We'll call this one the case of shifting values, and it's all about how companies can just change the value of their stuff to make their profits look better. So here's the first trick in the book. The amount of depreciation you record depends on how much your assets are worth. So if you want to change your expense, well, why not just change the value of the asset on paper? It's a move called revaluation, and boy, can it make a huge difference.
But why would they do this? I mean, what's the motive? This quote from our source material just lays it out perfectly. They do it to make the earnings look better, which in turn makes the stock look more valuable. It's a pure and simple sleight of hand to boost the share price.
And this table just shows it all so clearly. Take a look at American Ice Company. In 1926, they wrote their assets up. That forced them to take bigger depreciation charges, which made their income look lower. But then, fast forward to 1935, and poof, they write the assets back down, slashing that depreciation expense and making their income magically look higher. American Locomotive did the same thing, cutting its asset value so much that their depreciation charge dropped by about 60%.
Okay, so messing with the value of the asset, that's trick number one. But there's another way to play this game. Let's open up our second case file, the case of erratic rates. Here, it's not about the asset's value, it's about the rate you use to depreciate it.
You know, what's interesting here is that this shows us what's supposed to happen. This is normal. Most companies have a clear, consistent policy. You know, a building gets depreciated at 2% a year, machinery at 7%, trucks at 25%. It's predictable, it's boring, it's what you want to see. But then you get something like this. This is American Sugar Refining, and their depreciation charges are all over the place. I mean, look at this. $2 million one year, then zero the next. $1 million, then zero again. This isn't a consistent policy, it's just picking a number out of a hat. It really looks like they were just plugging in whatever number they needed to make their profits look good each year. And sometimes you find a company that's just shockingly open about what they're doing. Get this. Baldwin Locomotive Works basically said, yeah, we take our depreciation expense and we deduct it from either income or surplus. Now let me tell you why that is a massive flashing red flag. Income is this year's profit. Surplus is the giant pile of all the profits the company has ever made. Taking a current expense and hiding it in that giant historical pile is like sweeping your trash under a giant rug. It makes this year's profit look way, way better than it actually is.
So you have to wonder, right? Does this stuff really matter in the grand scheme of things? I mean, how much can these little accounting games actually change the final profit number?
Well, the answer is a shocking amount. This slide right here is the smoking gun. Let's go back to Baldwin Locomotive. Over 5 years, they reported average earnings of $3.33 per share. But when analysts went back and fixed the books, put that depreciation expense back where it belonged, the real earnings were just 6 cents. 6 cents. That's not a small tweak. That's the difference between a healthy, profitable company and one that's barely scraping by. Now, these kinds of accounting games aren't just for manufacturing companies. Let's take a quick look at how these same ideas pop up in some specialized industries. The names might be a little different, especially when you get into the world of oil and mining. An oil company, for instance, has a whole bunch of things to write off. You've got the normal depreciation on their trucks and rigs. Then you've got depletion for the oil they're literally pulling out of the earth, and write-offs for leases that end up being duds. And these huge intangible drilling costs. It's a really complex picture with lots of places for numbers to get creative. And in mining, you had this huge split down the middle. Some companies, like Anaconda, would tell you their earnings before they even deducted the cost of the metal they dug up. Others, like Cerro de Pasco, did it the right way and included that cost. The big takeaway here is you absolutely cannot compare these companies to each other without making some serious adjustments first. It's apples and oranges. Okay, so we've seen the tricks, we've seen the traps, so how do you avoid them? This last part is all about giving you the tools you need, your own analyst's toolkit, for when you're doing your own digging. And the first rule, the most important tool you have, is comparison. A company's numbers mean nothing in a vacuum. You have to see how they stack up against their direct competitors in the very same business. This is a fantastic real-world example. Back in 1928, there was a proposed merger between Bethlehem Steel and Youngstown, and the people against the deal pointed right to this data. Just look at the ratio of depreciation to property. Youngstown was charging over 4%, while Bethlehem was only at 2%. What that suggests is that Youngstown was being more conservative, and that Bethlehem's earnings might have been a bit puffed up in comparison. So here it is. This is your checklist. These are the red flags to watch for. If you see big, sudden write-downs, or vague policies, or crazy, erratic charges like we saw with American Sugar, or rates that are way lower than their competitors, those are all signals to dig deeper. And that last one is a big one.
Anytime you see a company taking regular yearly expenses and hiding them in surplus instead of income, your alarm bells should be ringing. So you see, depreciation is so much more than some boring accounting term. It is a powerful lever that management can pull to paint a completely different picture of how their company is doing. Now that you know the story behind the numbers, the only real question is, which company are you going to go investigate first? All right, so when you're sizing up a company, you look at its earnings record, right? I mean, it's right there in black and white. Seems like solid ground. But how much should you really bet on it? Today, we're going to dig into what a company's past earnings truly mean and why that solid ground can sometimes turn into quicksand right under your feet. I mean, it's so tempting, isn't it? You see a company's profits just skyrocketing and your gut screams, "That's the one! That's the winner!" It just feels so intuitive. But is that simple picture the whole story? As we're about to find out, it's way more complicated than that. And honestly, getting this wrong is one of the biggest, most common traps an investor can fall into. You know, this quote just nails it. It says the earnings record is the most important and the least satisfactory aspect of security analysis. Think about that for a second. We have to look at it. It's pretty much the best clue we have about a company's future. But at the same time, it's often super unreliable and can even point you in the completely wrong direction. That's the paradox we're going to unpack. So that brings us right to the central conflict, the earnings paradox. Why is the most critical piece of data we have also the most, well, treacherous? To get to the bottom of this, we've got to look beyond just 1 year's profit and start thinking about a much more stable, more meaningful idea. And that key idea is something called earning power. Look, it isn't about one amazing year or one awful year. It's about consistency. It's really the company's average performance over a long haul. Think like 7 to 10 years, long enough to smooth out all the crazy ups and downs of the business cycle. True earning power is like a company's center of gravity, a number its results tend to circle back to year after year. Okay, but how do we actually find that true earning power? Because here's the thing, not all averages are created equal. A simple mathematical average can hide a whole lot of chaos. We need to figure out how to tell the difference between an average that reflects a stable reality and one that's, well, just a random number pulled from a bunch of wild, disconnected results. Let's dive into a really fascinating historical comparison to see what I mean. We've got two companies here from 1923 to 1932, S.H. Kress and Hudson Motors. Now, if you just glance at the bottom line, the 10-year average, Hudson Motors actually looks a little better. It's got $4.75 per share versus Kress's $4.36. So based on that one number, you might just say, okay, Hudson's the better business. But oh man, the real story is in the details. So what's so interesting here is the unbelievable consistency of S.H. Kress. Check out their annual numbers. They just hover right around that $4.36 average. Sure, they go up a little, down a little, but there's a really clear central pull. Each year's result is a pretty decent guess for the average. That stability tells you the average isn't just a number, it reflects the company's real, proven earning power. Okay, now look at Hudson Motors. It's the complete opposite. Their earnings are, well, they're all over the map. A massive $13.39 one year, and then boom, a loss of $3.54 just a few years later. The average of $4.75 is technically correct, mathematically, but it doesn't represent anything real. The company's earnings almost never even got close to that number. It's just an abstract concept, a meaningless average of totally disconnected figures. You can't predict anything from this. And then look what happened over the next 6 years. It's like the perfect proof of our analysis. S.H. Kress just kept on chugging along with its steady performance, with earnings still hanging out right around that same mark. And Hudson Motors? Yep, they kept up their wild swings, mostly posting losses. The stable company stayed stable, the unpredictable one stayed unpredictable. The past record, when you knew how to read it, was actually a fantastic guide. But, and this is a big but, here's the next crucial layer. Even a super stable earnings record isn't quite enough. The numbers have to be backed up by a real-world understanding of the business itself. You know, what does the company actually do? How strong is its position in the market? This is where the hard numbers have to meet good old-fashioned qualitative judgment. All right, take U.S. Steel during that same period. I mean, look at this. Its earnings record looks even more volatile than Hudson Motors. It hit a high of over $21 a share in 1929, and then just 3 years later, it posted a loss of 11. So based on what we just learned, you'd probably think its 10-year average of $8.13 is just as meaningless as Hudson's was.
But here's the qualitative override. U.S. steel was the absolute dominant force in a fundamental, permanent industry. I mean, steel is literally the backbone of the economy. The company's output and its profit per ton were actually pretty stable over the long run, even if the final earnings per share number swung like crazy with the business cycle. This entrenched, powerful position gave its long-term average a meaning that Hudson, just one car company in a fiercely competitive and brand-new industry, simply didn't have. So the analyst is looking for stable earning power, backed by a solid business. And this leads us directly to Wall Street's big mistake, because the market, well, it often does the exact opposite. It gets completely fixated on the wrong numbers and ends up drawing all the wrong conclusions. And right here, the conflict becomes crystal clear. See, the market tends to value companies based on their current earnings. This causes these wild price swings that just mirror whatever profits were that year. The analyst, though, thinks more like a business owner. They value the company on its average earning power over many, many years. The market assumes a trend is just going to continue forever, while the analyst knows from experience that reversals are way more common. This little thought experiment makes it even clearer. Just imagine 3 companies. They're all earning $7 per share right now. Company A has this fantastic upward trend, but its long-term average is low, only $4. Company C has a terrible downward trend, but a really high average of $10. And Company B is just perfectly stable. Now, who do you think the market would fall in love with? Almost certainly Company A, with that hot trend. But which one is actually the best business? And this quote really gets to the core error. The market sees a good trend and just automatically projects it out into the future, forever. It sees a bad trend and assumes the company is toast. But experience shows that's rarely how it works. Things like competition, markets getting saturated, and just simple regression to the mean, all of it suggests that a swing of the pendulum back the other way is far more likely than a trend just continuing on and on indefinitely. And this is exactly where the careful, thoughtful analyst finds their edge. By refusing to just follow the crowd and its obsession with current results and simple trends, the analyst can spot opportunities that the rest of the market completely misses. It's all about finding value where other people only see a messy track record. Let's check out a real-world example. Intertype Corporation back in 1939. At first glance, this record is not pretty. The earnings are all over the place, there are years where they lost money, and there's absolutely no positive trend to speak of. The stock was trading for just $8 a share. To a speculator who's just chasing trends, this company looks like a total dud. So based on everything the market seems to value, a great recent year, a strong upward trend, this looks like a terrible investment, right? The numbers are choppy, they're uninspiring. You'd probably just pass on this one, wouldn't you? Well, this is where the analyst starts digging. But here's what the analyst saw. They looked right past that messy income statement and went to the balance sheet. And what did they find? Nearly $20 per share in net assets. And you could buy those assets for just $8. Then, looking at the quality of the business, they saw a dominant company in a stable, necessary industry, printing machines. So the conclusion wasn't about trying to predict next quarter's earnings. It was about recognizing you could buy a solid, real business for less than half of what it would be worth if they just sold everything off. That, my friends, is a huge margin of safety. And this really brings us to the ultimate takeaway from all this. The goal of analysis isn't to be some kind of prophet who can perfectly predict the future. It's to be more like a detective who can penetrate the present reality of a business and truly understand its resilience. I mean, think about these 2 cautionary tales. J.W. Watson Co. made a super popular auto gadget, and its profits were through the roof, but the whole business was based on a fad. Then you had Coty Inc., the cosmetics company, in a similar spot. Soaring profits all based on a wave of popularity. In both of these cases, the market paid these enormous prices, just assuming those high profits were the new normal and would last forever. But a real analyst would recognize that profits built on fads or shifting public tastes are, by their very nature, incredibly vulnerable. And that leads us to the final principle. Don't try to predict next year's earnings down to the penny. It's a fool's game. Instead, use the past record and a deep, qualitative understanding of the business to answer a much more fundamental question. Is this a durable enterprise with a demonstrated earning power that just isn't being recognized by its current market price? It's all about deep understanding, not fortune-telling. So I'll leave you with this question that you want. The next time you look at a stock price, ask yourself,
what am I actually paying for here? Am I buying years of demonstrated stable earning power and real tangible assets at a reasonable price? Or am I paying a huge premium for a story, for a hot trend, for the hope of expected results that might never even show up? Thinking through that difference, that's the first real step to becoming a true analyst.
So when you're sizing up a company, it is so easy to look at a great track record and think, okay, this is the map. This is where they're headed. But here's a thought. What if that map is drawn in disappearing ink? Is a company's past really a reliable guide to its future?
Or could it just be a mirage? Something that looks so real, so solid from a distance, but the closer you get, it just vanishes, leaving you with nothing. That is the big question we're going to dig into today.
All right, let's get into it. Welcome to our explainer. Don't be fooled by the past. Why headline earnings can deceive. We're about to pull back the curtain on some really fascinating case studies from history that show just how easily a company's glowing past can hide a really shaky future. So here's our game plan. First, we'll talk about the trap itself, why our brains fall for this stuff. Then, we're going to open up the case files. We'll start by deconstructing a company's profit. Then we'll uncover a major deception buried in the fine print. And finally, we'll see what happens when an entire industry just changes overnight. And don't worry, we'll wrap it all up with a new analyst toolkit so you can spot these traps for yourself. Okay, first up, the past performance trap. I mean, look, it's totally human. You see a chart that's going up and to the right, and your brain just automatically thinks, yeah, that's going to keep going. We see success, and we just assume that success is going to continue forever. And that right there is the heart of the problem. We all get mesmerized by a string of big, beautiful profit numbers. But as we're about to see, just trusting that history without digging any deeper, well, it's a super dangerous assumption. To get to the real story, you gotta look past the shiny surface. You have to become a bit of a financial detective. Which brings us right to our first case file. So, let's put on our detective hats. We are going to deconstruct a company's profits and find out what it's actually made of. Okay, meet our subject, the Calumet and Hecla Copper Company, way back in 1936. They reported a profit of almost $4 million. Now, on the surface, that looks amazing, right? A solid, healthy company just printing money. The market absolutely loved it.
But see, a real analyst has to ask the hard questions. Questions like, where did that $4 million really come from? Are all profits created equal? And then the absolute killer follow-up. How long could this possibly last? Was this a repeatable performance?
And this is where it gets good, because when you dig in, you find out that that big, impressive number wasn't from one single stable business. No, it was actually cobbled together from, get this, 4 completely different sources. And each one of those sources had its own very different and, frankly, pretty alarming story. And this slide just lays it all out perfectly. Let's walk through this. So part of the profit came from selling old copper from the year before. That's a one-and-done deal, not going to happen again. Then there was the conglomerate mine. I mean, this thing was a workhorse for 70 years, but it was on its last legs with only 12 to 14 months left. The reclamation plants, they made the cheapest copper, which is great, but they only had 5 to 7 years of life left. That means the only long-term source of profit was the Amic mine, which happened to be their highest cost, least profitable operation. See, that huge 1936 profit was built on a foundation that was literally crumbling away. All right, let's open our second case file. This one takes that idea of looking deeper to a whole new level. Because here, the truth wasn't just hiding in the quality of the profits, it was buried deep inside the legal fine print of a contract that pretty much nobody bothered to actually read. Let me introduce you to the Interborough Rapid Transit Company, the IRT, back in 1917. These guys were posting insane earnings. Look at that, $26 a share. I mean, in 1917 dollars, that is a staggering amount of money. The market was absolutely euphoric. Analysts were recommending the stock like crazy. Everyone was just so excited about the future of the New York City subway. But here's the kicker, the little detail that changes the entire story. Buried in the paperwork was a brand new contract with the city of New York. And this contract had a hidden clause that was about to change absolutely everything for IRT's future. And you can see the bombshell right here in this table. The contract basically said that once new subway lines were built, the city would get first dibs on the profits. IRT's earnings were going to be capped.
So look at the numbers. Their actual past earnings were over $9 million, but the contract mathematically guaranteed that their maximum future earnings would plummet to just over $5 million. It wasn't a risk. It was a certainty. Their profitability was about to get cut almost in half.
And the fallout? Wow, it was swift and it was brutal. In 1917, they hit that peak of $26 a share. By 1918, the parent company stopped paying dividends. Just 1 year later, it was bankrupt. And by 1932, the IRT itself was in receivership. And the crazy part is, all of this was totally predictable if you just read the fine print instead of staring at those amazing past earnings.
Okay, for our last case file, we're going to zoom out a little bit, because sometimes the problem isn't just with one company's books or one bad contract. Sometimes the entire industry you're in fundamentally changes, making all your past performance totally and completely irrelevant. So let's take a look at Freeport Sulphur in the early 1930s. On the left, you see their past. All their profits came from a property they owned 100%. All the money went straight to them, but that property was running out. Now look at the right. Their future. It was all tied up in new properties they leased. And here's the catch. They had to pay huge royalties, up to 70% of the profits, back to the property owners. Their entire business model had been turned upside down. But get this. Even with this massive change, the market was still valuing the company based on its past. This quote from the source material just says it all. The market was valuing this new, unproven, and way less profitable venture at more than 6 times what was actually being invested. It was pricing the success of the old business model onto a brand new and much worse one. Just incredible. And you see this kind of thing happen all the time. Think about the zinc producers during the Great War. They made a fortune because prices were temporarily sky high. Obviously, that wasn't going to last. Or the copper industry, where new low-cost mines came online and dragged down prices for everybody, turning yesterday's heroes into today's average Joes. In every single one of these cases, if you relied on past profits, you would have walked straight off a cliff. So after all these scary stories, the big question is, how do we avoid falling into these same traps ourselves? Let's take everything we've learned from these case files and build a practical toolkit that you can start using right away. Here it is, 4 essential, non-negotiable questions you have to ask. 1. Deconstruct the profit. Just like we did with Calumet and Hecla, you gotta ask, where is the money really from? Can they do it again next year? 2. Read the fine print. You have to hunt for those hidden contracts that could sink a company like the IRT. 3. Assess the landscape. Has the whole industry changed? Is the past even relevant anymore? And finally, 4. Question new ventures. Is the company's value based on its proven history or on some unproven, speculative new thing, like we saw with Freeport Sulphur? And that really just leaves us with one final thought. As you look around at the hot companies of today, the market darlings with the amazing earnings reports, ask yourself this. Which one of them might be hiding a story just like one of these, deep inside their financial statements? Because remember, the past is just a data point. It's not a destiny. The price-to-earnings ratio. It's probably one of the very first things any of us learn when we start looking at stocks. But it's also one of the most misused. So today, we're going to look past all the daily noise and apply a really disciplined, timeless framework to the PE ratio. It's a way of thinking that helps us understand the huge difference between real investing and, well, just speculating. Let's get into it. So here's how we're going to break it all down. We'll start with the central puzzle of the PE ratio itself, then get really clear on what separates an investor from a speculator. After that, we'll lay out some concrete rules, put them to the test with a cool historical case study, and then dive into a key adjustment you absolutely have to know about. And finally, we'll wrap it all up with the right mindset to take with you.
All right, first step, the price-earnings puzzle. You'd think it would be simple, right? Just look at what a company earns and pay a fair price for it. But oh man, the reality is so much more complicated than that.
This quote just nails the problem perfectly. A company's earnings aren't some fixed number. They're always moving around. They go up and down with the economy, with what the competition's doing, a million different things. So if the E in your PE ratio is always shifting, how can you possibly build a solid valuation on it? It's like trying to build a house on quicksand. And that leads us to, honestly, one of the most powerful analogies in all of finance. In the short run, the market is a voting machine. It's basically a popularity contest. It's driven by feelings, by hype, by what's hot right now. But in the long run, it becomes a weighing machine, where the true fundamental value of a business, its assets, its real earning power, eventually gets reflected in the price. The trick is knowing which machine you're listening to. So to find our way in this kind of dual personality market, we have to first get really clear about who we are. Are we playing the role of an investor or are we a speculator? Because the way you approach things is going to be totally different.
Okay, let's really break this down. The investor, they're a realist. They want value they can see and prove, something based on a solid history of average earnings. They're using the weighing machine. The speculator, on the other hand, is an optimist. They're making a bet on future growth that hasn't actually happened yet, and they're often just going with the flow of the market's mood, following that voting machine. Now, there's nothing wrong with speculating, but you have to be honest with yourself and know when you're doing it.
Okay, so if we decide, yep, I'm taking the investor's path, then we need a disciplined framework. This isn't about gut feelings or hot tips. It's about having clear, conservative rules to guide every single one of our decisions. And this brings us to a single number, a really important one that's going to act as our North Star here. For this framework, that number is 20. It's like a bright line drawn in the sand. So here's the rule, plain and simple. An investor should not pay more than 20 times a company's average earnings over several years. Why? Well, because any price higher than that isn't really justified by the company's track record. It means you are absolutely counting on big future growth to make it worthwhile. You're speculating that the future will be way better than the past. So this rule is what defines the boundary between investing and speculating.
Now, what I love about this is how practical it is. First, you got to do the homework, analyze the company's record. Calculate average earnings over a nice long period, say 5 to 10 years. That smooths out all the bumps. Second, you apply the discipline. Don't pay more than 20 times that average, and really, for most companies, getting closer to 12.5 is even better. And finally, remember it's not just a numbers game. You have to verify the quality of the business. Does it have a strong balance sheet? Does it have reasonable prospects?
Okay, theory's great, but let's see how this whole framework actually works in the real world. We're going to hop in a time machine and go all the way back to December 1938 to check out some famous companies. So first up, take a look at Group A. You see these names? General Electric, Coca-Cola. I mean, these are the giants, the blue chip stocks everyone loves. But here's the twist. Even the best company in the world can be a terrible investment if you pay too much for it. Back in 1938, their prices were so high that their 10-year average earnings only gave you a tiny return of 2 or 3%. To justify that price, you weren't investing in their history, you were making a huge bet on their future. Now let's check out Group B. Here we see companies like Goodyear. The issue here isn't a crazy high price, it's that their record is totally unstable. I mean, look at the wild swings in their earnings, making over $10 a share one year, then losing money the next. When things are that volatile, it's just impossible to figure out a reliable average earning power. So by our definition, that makes them speculative. And that finally brings us to Group C. Now this is where things get interesting. This is where we find our potential investments. Companies like Adams Millis and American Safety Razor. Their earnings records aren't perfectly straight lines, but they are reasonably stable over the whole decade. And, most importantly, their stock prices offered a really satisfying return based on those average earnings. We're talking well over 10%. So, to just kind of wrap up what we see in these Group C companies, an investment-grade stock has to pass these key tests. 1, it's got a history of pretty stable earnings. 2, its price gives you a good return based on those average earnings. And 3, the company itself is financially strong, and you're not paying some huge premium way above what the company's actual resources are worth. It's the whole package of value and safety. Okay, now for something a little more advanced. Let's say you found a company that seems to pass all the tests. But hold on, your work isn't done yet. That earnings per share number that companies report, well, sometimes it can be a little misleading. You see, a company might have things like convertible bonds or stock options out there that could one day turn into more shares of common stock. And if that happens, the total number of shares goes up, which means each existing share's piece of the profit pie gets smaller. It's called dilution, and a truly conservative analyst always has to account for it. Let's make this super concrete. Take American Airlines back in 1939. The company comes out and reports earnings of $3.76 per share, and on the surface you think, hey, that looks pretty good. But wait a minute, the company had convertible bonds just sitting there. So a real analyst has to ask, well, what if all those bonds get converted into stock? And when you do that math, whoa, the impact is huge. After you adjust for that potential conversion, the true, fully diluted earning power drops all the way down to just $2.45 a share. more than a third of the reported earnings just disappeared. That is a massive, massive difference.
And this brings us to an ironclad rule for any serious analysis. Your valuation has to be based on the most conservative, worst-case scenario. You have to assume that all those options, all those conversions that could happen, will happen. This is how you build a true margin of safety into your work.
Okay, so we've covered the theory, the rules, and the nitty-gritty adjustments. Now let's bring it all back home to the single most important thing, your own mindset.
And so we come full circle, right back to this powerful idea. The voting machine is never going to stop. It's loud, it's exciting, it's fueled by the news of the day and what everyone else is thinking. But the investor's job is to keep their eyes on the weighing machine, which is patiently measuring the true, deep-down value over time. Your job is to ignore the shouting of the voters and just focus on the weight of the facts. So that's the fundamental question I want to leave you with. When you look at an investment today, which machine are you using? Are you caught up in the votes, getting swayed by the popularity contest of the moment? Or are you doing the hard, disciplined work of weighing the company's real, long-term earning power against the price you're being asked to pay? The answer to that question doesn't just define your approach. In the long run, it's going to define your results. Thanks for listening. You know, when you're sizing up a company, you usually ask the obvious questions, right? What do they sell, or how much money do they make? But what if I told you there's another question that's just as important, maybe even more so? How is the company built? It turns out there's this hidden formula buried in the balance sheet that can totally change what a company is worth. And today, we're going to pull back the curtain and see exactly how it works. So here's our game plan. First, we'll dive into a really strange financial puzzle. Then we'll try to find the perfect balance, that sweet spot between playing it safe and taking a risk. After that, we'll look at what happens when things go wrong, when debt becomes a real danger. We'll check out some wild, real-world examples that show just how extreme this can get. And finally, we'll wrap it all up and see what it means for you. All right, let's jump right into the heart of this mystery. I want you to imagine 3 companies. They are perfect clones of each other. Same product, same managers, and they earn the exact same $1 million. But when you look at how the market values them, they're wildly different. How on earth is that even possible?
I mean, this is the big question, isn't it? Can a company really just move some numbers around on a spreadsheet, take on a little debt, and poof, magically become more valuable? It just sounds way too easy to be true. But, well, the numbers we're about to see suggest something really weird is going on.
Okay, so here they are. Company A, B, and C. Company A is the simple one. No debt at all, just stock. And it's valued at $12 million. Pretty straightforward. Then you have Company B. It takes on $6 million in debt, and suddenly its total value jumps to $15 million. And then there's Company C, which goes all in with $12 million in bonds, and its value seems to skyrocket to $18 million. The more debt they add, the more valuable they appear to be. This right here, this is the paradox.
All right, to figure this out, let's just focus on Company A and Company B for a second. Company A, our all-stock company, versus Company B with its moderate chunk of debt. We're on the hunt for that perfect mix, that optimum structure that can actually create real value. Okay, so this is where it gets really interesting. Look at the earnings per share. When earnings take a 25% hit, Company B stock gets hammered, dropping 33%. So it's riskier. But now look at the flip side. When earnings jump up 25%, Company B's stock gets a 33% boost. That debt acts like a lever. It just amplifies everything. And if you're an investor betting on growth, that kind of amplification is exactly what you're looking for. So what does that fancy quote really mean? It's saying that a smart amount of debt, what they call senior securities, isn't a weakness. It's actually a strategic tool. As long as the bonds are safe enough that a careful investor would buy them, they actually make the common stock more powerful, more productive, and way more responsive when good things happen. And that means Company A, our all-stock hero, is actually what you'd call over-conservative. See, part of its stock is behaving like a safe, boring, low-return bond. But stock investors don't want to pay a premium for that. So by carving out the safe part into actual bonds, Company B makes its common stock a pure, more high-octane investment.
So we've seen how smart debt can be a good thing. But leverage has a dark side. Now we've got to turn our attention to Company C and see how this logic, when pushed too far, just completely falls apart.
On paper, Company C looks like the big winner, right? An $18 million valuation. But that entire number depends on one giant shaky assumption, that its $12 million in bonds are, well, actually worth $12 million. Let's see if that holds up.
And here it is. Here's the fatal flaw. Company C is earning $1 million, but it has to pay out almost half of that, $480,000 in interest. That means its earnings only cover its interest payments about 2 times over. You might think, hey, that's a profit. But in finance, that is a razor-thin margin. One bad quarter, and they could be in serious trouble.
Think about it. Would you, as a careful investor, pay full price for a bond from a company that's so close to the edge? No way. You demand a massive discount to take on that kind of risk. So that $12 million bond value on the books, it's not real. In the real world, those bonds are worth much less, and that causes the whole $18 million valuation to just crumble. This is what we call a speculative or top-heavy structure. It's basically a house of cards. It's way too risky for the bondholders, and it creates insane, whiplash-inducing volatility for the stockholders. And here's the ultimate irony. By trying to juice its value with all that debt, Company C probably made its actual real-world value even less than the other two.
Okay, enough with the theory. Let's see what happens when these ideas hit the real world with real companies and billions of dollars on the line. Because the effects of leverage out in the wild can be, well, absolutely mind-blowing. For better and for worse.
Just look at this number, 400 times your money in 8 years. That means if you'd put in $1,000, you'd have walked away with almost $500,000. How in the world does that happen? Well, you can probably guess the secret ingredient by now, an incredibly speculative, super leveraged capital structure.
So let's break down this magic trick. Look at the top line. The company's total earnings grew about 2.5 times. That's good, but it's not life-changing. But now, skip down to the third line, the money left over for the common stockholders. After paying all the interest on its mountain of debt, that number grew by nearly 20 times. That, right there, is the explosive power of leverage.
But remember, that lever works both ways. What goes up like a rocket can come down just as fast. To really see the other side of this, let's look at 2 companies that were in the same business back then. A.E. Staley, which had a top-heavy structure, and American Maize Products, which was built much more conservatively. The difference here is just, wow. Look at A.E. Staley on the left. In 1 year, they're making a massive profit of over $84 a share. A few years later, they're losing almost $24 a share. It's a total roller coaster. Now look at American Maize on the right. See how steady that is? It just chugs along in a nice, predictable range. That insane leverage at Staley turned every little business hiccup into a financial earthquake for its owners. And here's the punchline. This is what happened in the depths of the Great Depression. Look at this. Staley had way more assets. It even had higher average earnings. But because its financial structure was so incredibly risky, the market valued the entire company at less than the smaller, safer American Maize. The risk completely vaporized its value. So what do we do with all this? How can we actually use this knowledge to get an edge? Well, it all boils down to understanding this one critical idea called trading on the equity. This quote just nails it perfectly. In one of these super leveraged companies, the common stockholder is basically playing with house money, the bondholder's money. If things go great, the stockholder gets to keep all the massive profits. And if things go south, well, it's the bondholders who lose the most. It really is a heads I win, tails you lose kind of bet. And that's the definition of trading on the equity. It is a high-stakes, high-risk game. The common stock isn't really an ownership stake in the traditional sense. It's more like a lottery ticket. It's a cheap bet that the company can earn enough to pay off its huge debts and still have a jackpot left over for you. So if you were ever going to play this game, here are the rules for being an intelligent speculator. First, you have to admit you're taking a huge risk. Second, you cannot put all your eggs in one of these baskets. Diversify. Third, and this one's really key, try to find companies that use preferred stock instead of bonds for their leverage. Why? Because if a company misses an interest payment on a bond, it can be forced into bankruptcy. But if it misses a dividend on preferred stock, that usually doesn't happen. It gives the company breathing room, which can save your investment. And finally, know when to cash in your chips. After the stock has a huge run-up, it's not a cheap bet anymore. The risk-reward has changed, and it's time to sell. So, the next time you're looking at a company,
Don't just stop with the earnings. Go deeper. Look at the balance sheet. Because understanding the architecture of a company, how it's built, how it's financed, is the key to understanding the hidden engine that can either drive incredible wealth or lead to a spectacular collapse. The real question isn't just what does it earn, it's how is it built?
Welcome to The Explainer. We're going to tackle a question today that has lured and, let's be honest, mystified investors for decades. All right, let's just dive right in. Is a $5 stock a bargain? The thing is, the answer is, well, it's way more complicated and honestly more fascinating than you might think. It's the kind of question that has both made fortunes and absolutely destroyed them. And understanding that difference, that's everything. Okay, so here's our roadmap for today. We're going to start with the classic wisdom from the legends, right? Graham and Dodd. Then we're going to see how those ideas have evolved with a really sharp modern critique from Seth Klarman. And finally, we'll pull it all together into a timeless framework for how you should think about analysis. So first things first, what is it about low-price stocks that's so appealing? What is that magnetic pull of a single-digit price tag? The appeal is actually pretty simple. It's all about this idea of explosive returns. It's almost psychological. It just feels so much easier for a stock to jump from $10 to $40 than for a $100 stock to hit 400, even though it's the exact same percentage gain, right? The smaller number just feels more accessible, more possible. And look, this isn't just some gut feeling people have. This is a sentiment that's actually backed by history. As this quote from a 1936 study points out, there was a time when the data actually showed that in a rising market, a basket of low-priced stocks really did outperform a basket of high-priced ones. So there's some real data behind this feeling. Okay, but here's the million-dollar question, right? If the logic feels so straightforward, why do so many people get absolutely crushed buying these so-called cheap stocks? Well, the painful answer, and really the key to this whole explainer, is that not all low prices are created equal. So, how do you actually spot the difference? How do you tell a real bargain from a total value trap? Let's break down the single most important distinction you have to make. Okay, this slide right here, this is the core secret. A genuinely cheap stock is when the whole company, the entire thing, its total market value, is on sale relative to its actual business. A pseudo-cheap stock? That's just an illusion. It's a company that has sliced itself into so many millions of tiny shares that each individual piece looks cheap, even when the whole pie is wildly overpriced. And here we have a perfect real-world example of this in action. Back in the day, Barker Bros was valued by the market at less than $1 million, despite doing over $8 million in sales. I mean, think about that. That is a genuinely cheap stock. The whole business was on the bargain rack. Meanwhile, you have Wright Hargreaves, valued at over $38 million, on just $4 million in sales, simply because it had a ton of shares out there. That is a classic pseudo-cheap stock. And this right here explains exactly why so many people get burned. They get drawn into the hype, the story, the heavily promoted pseudo-cheap stocks. The real bargains, the genuinely cheap companies, well, they're often boring, forgotten, and completely ignored by the crowd. Opportunity is usually found in the quiet corners of the market. Okay, so let's say you've done the work and you think you've found a genuinely cheap stock. Well, guess what? Your work is just getting started. Now you got to put on your detective hat and figure out where the money is really coming from. So let's take a look at this case study, the Northern Pipeline Company, way back in the 1920s. On the surface, it looked pretty good, right? The earnings were there and the stock traded at a low price-to-earnings ratio. Seemed pretty straightforward. But, as any good analyst will tell you, that one little number, earnings per share, can be so misleading. It hides as much as it reveals. You have to dig deeper. You have to ask the most important question. What is the real story here? And wow, what a story it was. When you actually cracked open the books, you found out that most of the company's income wasn't even coming from its main business, the pipeline. Nope. The lion's share, about $4 a share, was coming from ultra-stable investments it held. This company was basically a conservative investment fund that just happened to own a pipeline on the side. Now, this is where the genius comes in. You can't value those two income streams the same way, right? The rock-solid, almost bond-like investment income, that's worth way more than the risky up and down income from the actual pipeline business. And when you valued each part properly, it turned out the stock was actually worth around $100 a share.
but it was trading in the mid-60s. It was a massive bargain hidden in plain sight, just because the market wasn't looking at the quality of its earnings.
I mean, this is such a powerful technique, right? But it just begs the question, does this classic playbook even work anymore? In our world of instant information, can you really find these hidden gems just by reading the financials? So for a modern take on this, let's bring in a modern legend, investor Seth Klarman. He basically argues, as you see in this quote, that the game has completely changed since the era of Graham and Dodd. What worked then might actually be a trap today. And his reasoning is just so compelling. First off, the information edge is gone. Everyone has the same data at their fingertips. Second, modern companies are way more complex, with all these hidden liabilities that make calculating a true liquidation value nearly impossible. And maybe most important of all, many of today's best businesses are asset light. Their value is in software code or brands, not big factories. So as Klarman warns, if you run a screen for stocks trading below book value today, you're far more likely to find a list of deeply troubled companies than a collection of hidden gems. So if the old formulas are broken, where does that leave us? What are we supposed to do? Well, let's try to bring the classic wisdom and the modern reality together. And this right here, this is the new way of thinking about it. The goal isn't to just mechanically find some simple formula anymore. The true, timeless lesson is about the discipline of the analysis itself. In today's world, you can think of the balance sheet less like a treasure map leading to buried gold and more like a vital health report on the state of the business. This slide really nails that fundamental shift in thinking. The old way? Using the balance sheet like a simple filter to find bargains. The new way? It's much more sophisticated. You're using it as a diagnostic tool to truly understand a company's financial health, its resilience, and all of its hidden risks. So what's the real takeaway for us today? It's that the analysis is about building a complete picture, not just finding one magic number. A strong balance sheet gives a company options. It gives it staying power. The real work, the real edge, is in looking for the red flags, understanding the trends, and most of all, reading the footnotes. That's where the real story is almost always told. And that really brings us to the ultimate point here. In the end, it's not really about the price of the stock or even the numbers on a page. It's about the quality of the questions you're asking. Is this price genuinely low? What is the real source of the income? And just how strong is this company's foundation? The tools will always change, but that kind of critical thinking, that's the one asset that will always give you an edge. You know, in today's market, it's so easy to get caught up in the daily stock prices, the hot trends, the growth projections. But what if I told you that one of the most powerful tools for an investor is something that most people just gloss over? We're talking about the balance sheet. Today, we're going to dig into this forgotten financial statement and unlock the power of one simple but absolutely crucial idea: book value. So here's the game plan. First, we'll talk about why this so-called forgotten statement is so important in the first place. Then we'll really get into the weeds of decoding book value, what it is and how you find it. But here's where it gets interesting. We'll look at when the numbers can actually lie to you. From there, we'll explore the wild, wild gap between market price and real value. And finally, we'll wrap it all up with a simple reality check that you can start using right away. All right, let's jump right in. Section 1, the forgotten statement. Seriously? In the mad rush to analyze earnings and predict the future, the balance sheet often gets left in the dust. But that's a huge mistake, because this document gives you a fundamental snapshot of a company's health that you just can't get anywhere else. I want you to think of the balance sheet as a company's financial X-ray. It's not just a boring list of assets and liabilities. No way. It shows you exactly how much real money, real capital, has been pumped into the business. It reveals its true financial condition. Can it pay its bills? It lays out the entire debt and equity structure for you to see. And maybe most importantly, it acts as a kind of lie detector. It gives you a way to check if the earnings a company is reporting are actually backed by real assets. It's the bedrock, the foundation of any serious analysis. Okay, so with that foundation in place, we can now tackle our main event, decoding book value. This is a concept that's actually pretty simple once you get it, but it's incredibly powerful. This is the tangible, physical value of a company that actually belongs to the shareholders. So what is it? Just imagine the company decided to shut down today. You sell off all the factories, the equipment, the inventory, you collect all the cash, and then you pay off every single debt. The money that's left over, that's what belongs to the shareholders. That's the book value. And the key word here is tangible.
We're not talking about fuzzy things like brand value or goodwill. We're talking about the hard assets, the stuff you can literally touch.
So how do you figure this out on a per-share basis? Well, here's a handy little shortcut. You take the value of the common stock, you add in any surplus cash or reserves, think of these as extra cushions of value, and then you subtract any of those intangible assets we just talked about. Divide that whole thing by the number of shares out there, and bingo, you've got your book value per share. So let's make this real.
To really see this in action, we're going to hop in a time machine and go all the way back to 1938. We're going to look at an absolute titan of American industry, U.S. Steel. This is going to show us exactly how to apply that formula to a real company's numbers.
All right, here it is, the condensed balance sheet for U.S. Steel. Now, I know it might look like a wall of numbers, but don't panic. We only need to pull out a few key pieces. We're looking for the common stock value, that's item 7, and then we need to grab all those surplus and reserve accounts, which are items 13 through 16. These are basically just different pots of money that belong to the company. These are the numbers we're going to work with.
And here's where we put it all together. See, we take that common stock value of $653 million and we add the $370 million from those surplus items. That gives us total net assets for the common stock of just over $1 billion. Now, we just divide that by the 8.7 million shares and we get a book value of about $117 per share. So what does that mean? It means back in 1938, for every share of U.S. Steel, there was $117 worth of actual physical stuff backing it up.
But, and this is a really, really big but, it's not always that straightforward. And that brings us to our next section, when numbers can lie. See, being a great analyst isn't just about doing the math. It's about being a detective, because sometimes the numbers on the page can be seriously misleading.
This is the question you have to ask yourself. What do you do when the stated value of something on a balance sheet is just, well, wrong? When the map the company gives you doesn't actually match the territory? This, my friends, is where the real work of an investor begins. This quote just nails the problem perfectly. You had companies, especially back in the day, that would put these totally arbitrary, low-ball values on their preferred stock. On paper, it looks like a small liability, but in reality, that preferred stock had a claim to a much, much bigger piece of the company's assets.
And the difference can be absolutely staggering. Just look at this example from the Capital Administration Company. As published, they listed their preferred stock as a liability of just $434,000. Seems manageable, right? But when you dig in and figure out that stock's actual claim on the assets, the real liability was almost $2.4 million. The official number wasn't just wrong, it was actively hiding the truth. And this wasn't some one-off thing. This was happening all over the place. Island Creek Coal had a preferred stock with a stated par value of $1. $1. But if the company liquidated, that stock had a claim to $120. Or look at Coca-Cola. They listed their Class A stock with a stated value of $5, but it was actually redeemable for $55. You have to look past the label to see what's really going on. This is why, as an analyst, you have to calculate what's called an effective par value. You can think of it as your own personal correction factor. It's an adjusted value that just ignores the nonsense number on the books and instead reflects what that preferred stock is truly worth based on its real claim on the company. Okay, so this whole idea of finding the true adjusted book value, this is what lets us make the single most important comparison in all of investing. We can now take our realistic book value and hold it up against the stock market's price. And this, folks, brings us to the most fascinating part of our journey, price versus value. This quote just blows my mind every time. Think about it. When an investor buys a stock, they're obsessed with the price per share. But when a business person goes to buy a whole company, they always start with a totally different question. What's the price for this entire business? It's two completely different ways of looking at the world. And that disconnect leads to some truly insane situations. Check this out. In 1930, the market valued General Electric at $2.7 billion. That was almost 7 times the value of all its tangible assets. Meanwhile, just 2 years later, the market was valuing Peprel Manufacturing at a tiny $1.7 million, which was less than 1/10 of its book value. You could have bought the entire company for less than the cash it had sitting in the bank. So what on earth was going on with General Electric? The market wasn't placing a value on the business, it was valuing a story, a dream, a speculative frenzy. The source calls it Wall Street's legerdemain, which is just a fancy way of saying it was a magic trick. It was smoke and mirrors, totally disconnected from the reality of the money invested in the company. And if you thought that was wild, look at this one. 1933, Commercial Solvents, a hot speculative stock, was trading for $142 million, a mind-boggling 16 times its book value. At the exact same time, Pennsylvania Coal & Coke was trading for less than $500,000, which was 1/16 of its stated assets. Get this, two companies with almost the exact same book value, and the market values one at nearly 300 times the other. It's just incredible.
So it all boils down to these two totally different mindsets. You've got Wall Street reasoning, which is all about price, momentum, sentiment, and stories. And then you have business reasoning, which starts and ends with one simple, powerful question. What is the price tag for this entire operation, and does that price make any sense?
So, this brings us to the most important part, the big so what. Our final section, the investor's reality check. How can we take these wild stories from the 1930s and actually apply them today? What's the practical takeaway for you? It all comes down to a super simple two-step sanity check. Before you even think about buying a stock, do this. Step 1. Multiply the share price by the total number of shares. That gives you the total market valuation. That's the price tag the market has put on the whole shebang. Then, step 2, look at that balance sheet and ask yourself, okay, for that price, what am I actually getting in terms of real, tangible stuff?
And really, that leaves us with this one final thought, the one question you have to ask yourself. In a market that moves at the speed of light, it's so easy to get mesmerized by the ticker tape. But the lesson of the balance sheet is timeless. Are we just paying a price for a flickering symbol on a screen, or are we making a conscious, deliberate decision to buy a piece of a real business? The answer to that question can make all the difference in the world.
Welcome to The Explainer. Today, we're cracking open one of the stock market's weirdest and frankly most illogical paradoxes. We're going to investigate a situation that seems like it should be impossible, a scenario where a company can literally be worth more dead than alive.
Okay, let's just dive right into the central mystery. It's a question that sounds like a riddle, doesn't it? I mean, the whole idea that a business, a living, breathing thing with employees and products, could be valued by the market for less than the pile of cash you'd get just by shutting it down, it just seems crazy. And yet, what we're looking at today shows this isn't some weird, one-off theoretical puzzle. It's a glitch in the matrix that happens again and again, where what people think a company is worth gets totally disconnected from what it's actually worth.
And our source material doesn't mince words. It calls this whole situation fundamentally illogical. Now, that's a really strong phrase. This isn't just a tiny pricing mistake. It suggests a deep, ongoing breakdown in logic somewhere. And if something's illogical, it means someone, somewhere, is making a huge mistake. So who is it? Is it the market, just totally swept up in fear? Is it the company's management team making bad decisions? Or maybe it's the owners, the stockholders, who aren't stepping up to claim what's theirs.
All right, so here's our game plan for unraveling this thing. We'll start with the big idea. Then we'll get our main tool ready for analysis. We'll look at a classic real-world case, see how these situations usually play out, and learn how to tell a real opportunity from a dangerous trap. And finally, we'll wrap it all up with the core market principle.
So, to really get to the bottom of this mystery, every detective needs the right tool. For us, that tool is a concept called liquidating value. You should think of it as our secret weapon, or maybe a magnifying glass, that lets us see a hard, tangible reality that the market, with all its daily noise and drama, often misses completely. So what is this thing exactly? Well, in the simplest terms, it's just the breakup value of a business. It's the pile of cash you'd be sitting on if you decided to call it quits today, sell off everything the company owns, and pay back every single person it owes money to. See, it's not about future profits or growth stories. It's about a hard, cold, conservative number of what the pieces are worth right now. It's the bedrock, the absolute floor value that, in a logical world, should prop up the stock price. Now, what's so useful here is that this gives us a practical way to figure this out, and you have to be realistic, maybe even a little pessimistic. First, you assume all the debts get paid in full, no discounts there, but the assets, that's a different story. Cash is cash, that's easy. But the money other people owe the company, you might only get, say, 80 cents on the dollar. An inventory sitting in a warehouse, you've got to slap a big discount on that, maybe only get half of what they say it's worth in a fire sale. The factories and equipment are the hardest part. You've got to be super conservative there.
So to boil it down, it's a pretty clear step-by-step process. You start with the stuff that's easy to turn into cash. You subtract everything the company owes, you apply those conservative discounts, and the number you're left with is what we call the net current asset value. And this is way more than just an accounting game. It's a really powerful way to find situations where the stock market has just completely lost its mind. Okay, theory is great, but let's see this in action with a real-life story. We're going to go back in time to 1931, right in the middle of the Great Depression, a time of absolute terror in the market. And we're going to look at the very strange case of the White Motor Company. Here it is, our primary piece of evidence, the company's balance sheet. Now, at this very moment, you could buy a share of White Motor for just $8. The entire company was being valued by Wall Street at a little over $5 million. The market was basically writing this company off for dead. But oh man, the balance sheet tells a completely different story. And this just perfectly shows the massive disconnect. The market price was $8, but when our source material does a conservative calculation of the liquidating value, they get to $31 a share. Just let that sink in for a second. The market was valuing the company at about a quarter of what its assets were worth if you just shut it down. This isn't a small gap. This is a Grand Canyon between what people thought and what was real. Okay, now this is the truly mind-blowing part. Let's forget about the factories, the machinery, the unsold trucks. Just forget all of it. If you just took the company's cash and government bonds and paid off every single dollar of debt it had, you would still have $11 in cash left over for every share. You could buy a share for $8 and instantly have a claim on $11 of pure cash. They were literally paying you $3 a share to take the entire truck manufacturing business off their hands for free. I mean, come on, how is that not illogical? So, you spot one of these crazy deals. What happens next? I mean, a gap this big between price and value can't just stay there forever, right? The tension has to break. Something's got to give. So what actually happens? What are the pathways that unlock all this trapped value for the investor who's smart enough to see it? Well, it turns out there are about 4 main ways this can play out. Sometimes things just get better for the whole industry, and a rising tide lifts all boats. Other times, the company makes some smart changes internally, maybe gets new management. But honestly, the 2 most common and powerful ways are when another, smarter company just steps in and buys the whole thing on the cheap, or when the company finally does the most logical thing and just liquidates. Let's dig into that sale or merger idea by looking at Standard Oil of Nebraska. Here was a company that was super busy, selling tons of gas, but it was barely making any profit. And you know the market, it's obsessed with profits, so investors had completely given up on the stock. So in early 1939, the stock's just sitting there at $6 a share. But look at the books. The net current assets alone, the cash, the inventory, minus all the debt, were worth over $12 a share. It's another classic case, trading for less than half of what its stuff was worth. The market saw a profitless company. A careful analyst saw a pile of valuable assets being given away for practically nothing. And here's how the story ends. A bigger competitor, Standard Oil of Indiana, saw what everyone else was missing. They didn't care about the bad profits. They cared about that valuable network of gas stations. They realized it was way cheaper to buy that network through the stock market than to build it themselves. So they offered to buy the whole company for $17.50 a share. Boom, nearly tripling the investment for anyone who saw the value in the assets. But sometimes there's no knight in shining armor to buy the company, and the business itself just doesn't have a future. In those cases, the most logical and, profitable thing to do is just shut it down and give the cash back to the owners. And that's exactly what happened with the Mohawk Mining Company. At the end of 1931, the market said Mohawk Mining was worth $11 a share, but a quick peek at the balance sheet showed a massive disconnect. Its net current asset value was a stunning $28.50 a share. It was like buying a dollar bill for less than 40 cents. So, faced with that undeniable math, what did they do? They did the only rational thing. They voted to liquidate. And over the next few years, that's what they did. They sold everything off and handed out the cash, paying out a total of $28.50 per share. It's a perfect textbook example where the math on the page became actual cash in shareholders' pockets, giving them a huge win. Okay, now this all sounds pretty amazing, right? Like a foolproof plan. But it's really important to get this next part. Not every stock trading below its liquidating value is a good investment. This is where you have to be a real detective and look a little closer to avoid something called a value trap. Let's look at a tale of two companies from 1933. You've got Manhattan Shirt and Hupp Motor Car. On the surface, they both looked cheap, both selling for less than their net current assets. But there was a critical difference. Hupp Motor was burning through cash like crazy. Its asset value was shrinking every single year. It was a melting ice cube. Manhattan Shirt, on the other hand, was stable. It had actually managed to hold on to its strong financial position through the worst of the Depression. One was falling apart, the other was holding steady.
And this brings us to the number one most important rule in this whole game. You have to analyze the trend. Is the company's value stable, or is it getting eaten away by losses year after year? A cheap price means nothing if the value behind that price is just vanishing into thin air. A real bargain isn't a sinking ship, it's a sturdy one that's just been overlooked. So all of this, the definition, the crazy case studies, the important warnings, it all leads us to one single, powerful, big idea. It's a fundamental principle that really governs these kinds of illogical situations. This is it. This is the core takeaway from our whole investigation. A situation like this just can't last forever. It creates this unstable condition that presents a really stark choice, a fork in the road. Either the market is just dead wrong and the price is way too low and it's going to have to correct itself, or the company is being managed so badly that it doesn't even deserve to exist anymore and it should just be shut down. It has to be one of those two things. Ultimately, what all this really shows us is that the market is not some perfect, all-knowing computer. It's a very human thing driven by fear and by greed, and it gets things wrong a lot. The principle of liquidating value is more than just a formula. It's a lens of pure logic. It's a tool you can use to cut right through all the emotional noise and see a hard, tangible reality underneath. And it leaves you with a challenge. The market is going to keep mispricing reality. The only question is, will you have the clarity to see the difference? Welcome to The Explainer. Today, we are digging into a really fascinating and honestly often overlooked relationship. The one between a company's owners, that's the stockholders, and the people who are actually hired to run the place, the management. It's a dynamic that is just full of potential conflict, and it creates some seriously strange puzzles in the world of finance.
So here's how we're going to break it all down. First, we're going to look at a strange paradox you see in the market. Then we'll get into the root cause of it all, and from there, we'll examine the central conflict that pops up. After that, we'll see a model for how things should work, learn from some pretty serious cautionary tales where they didn't, and finally, we'll talk about your role in this whole picture. All right, let's kick things off with a big question, one that really puzzles a lot of people in finance and gets right to the core of this whole owner-manager relationship. Think about that for a second. It just doesn't seem to make sense, right? You have a company and it's liquidating value, meaning the pure cash you'd get if you sold off all its parts, the buildings, the inventory, everything, is actually more than what the entire company is worth on the stock market. So why would the owners just let it keep operating? Why let it burn through that cash value, sometimes until there's nothing left? It's a totally logical question, but the answer isn't in some complex financial formula. Nope, it's all about human behavior. According to our source material, the answer lies right here, with the stockholders themselves. Now, this quote is, well, it's blunt, but it argues that the passivity of the owners is the real key to understanding this whole paradox. It basically says that stockholders, even though they are the legal owners of the company, very often just don't act like it. And this passivity, this tendency for owners to just not step up and assert their rights, it creates this huge disconnect. There's a gap between owning a company on paper and actually having any say in its future. You know, this isn't some new idea. We're talking decades ago. The famous scholars Berlin Means pointed this out in their groundbreaking book, The Modern Corporation and Private Property. They saw that we couldn't just assume anymore that a big company would be run mainly to benefit its owners. Instead, the real power, the effective control, often ends up in the hands of a small group of paid executives who might have a totally different set of priorities. This apathy is usually propped up by a few assumptions that, they sound kind of plausible, but they're actually deeply flawed. Stockholders fall into the trap of thinking, well, management knows more than me, so I should just trust their judgment, always. Or they think, hey, the stock price isn't really management's problem. And here's the big one. If I don't like what's happening, all I can do is sell my shares. The thing is, these are basically half-truths, and that makes them a really dangerous foundation to build your ownership on. And those flawed assumptions, they become genuinely dangerous, because the personal interests of the paid managers and the financial interests of the company's owners,
Well, they aren't always the same. In fact, they can be in direct conflict. Just look at this list. It really pinpoints where the personal goals of management can split from what's best for the owners. Compensation is the obvious one, sure, but the others are just as important. Management might want to expand the business, not because it's profitable, but because it gives them more power and prestige. They might want to hold on to cash instead of paying it out as dividends because cash is power. And here's the most critical one. They have a huge personal incentive to keep a failing business going, because if it liquidates, they're out of a job. It's not always malicious. It's just human nature bumping up against shareholder value. Let's make this real with a few examples. Take Bethlehem Steel. In this case, management was found to have paid itself cash bonuses that were just excessive by any standard. That's value that was directly taken from the pockets of the real owners. Or look at stock options. They're supposed to align everyone's interests, right? Well, they can be abused. At American Tobacco, officers got the right to buy stock at prices way below what anyone on the open market could get. That handed them massive potential profits, all at the expense of the stockholders. And this one is really something. At White Motor Company, managers got stock on credit. But when the stock price completely tanked, what did the company do? They just canceled the manager's debt. The managers were totally shielded from the loss, while the stockholders, the actual owners who took the real risk, they had to eat the entire loss. It's a classic case of privatizing the gains for management and socializing the losses to the owners. Okay, so it's not all doom and gloom. It doesn't have to be this way. Let's shift gears and look at a model where you had vigilant owners and responsible management actually working together, and it led to the best possible result for everyone. The story of the Hamilton Woolen Company is just a fantastic blueprint for how this relationship is supposed to work. The company was struggling, so management didn't just lock themselves in a boardroom and make a call. They showed respect for the owners. They laid out all the arguments for and against liquidation and put it directly to the stockholders. In 1927, the owners voted to give it another shot, and you know what? It was the right move. But then in 1934, when new problems came up, they put it to a vote again. This time, the owners voted to liquidate, and they unlocked all that asset value. The key here wasn't just what they decided, it was how they decided. The ultimate power rested with the true owners of the business. And the results of making a decision like that can be absolutely dramatic. This table from the source shows it plain as day. Look at American Glue. The stock was trading at $53, but after liquidation, stockholders got over $139 per share. That's not a small difference. It's a powerful reminder of how much value can be trapped inside an underperforming business, just waiting for owners who are willing to actually step up and act. But what happens when management uses its power not to help the owners, but to take advantage of them? For a really stark cautionary tale, let's go back and take a closer look at that White Motor Company's story. So the timeline here is pretty telling. In 1921, the company has a bad year, but they keep paying the dividend, which makes the stock look healthy. A few years later, they use that strong-looking stock to go out and raise $10 million in new cash from those very same stockholders. But then, in 1931, after a smaller loss, they suddenly suspend the dividend, and the stock price just craters. The timing, you got to admit, is suspicious. And this sequence shows you the nasty possibilities. See, during all this, White Motor was actively buying back its own stock. Cutting the dividends helped crash the price, which then let the company buy back shares at rock-bottom prices, often from panicked stockholders. It's a vicious cycle where the owner's own cash is being used against them to buy their shares on the cheap. Here's another jaw-dropping example. Westmoreland Coal Company. Over 10 years, the company spent its own cash buying back its own stock on the market. And the average price they paid? Just $8.67 per share. And here's the kicker. That price they were paying, it was less than half of the cash the company had in the bank for each and every share. Forget about their other assets, the coal, the land. They were literally using the company's bank account to buy dollar bills for 50 cents. It's just a shocking example of management using a pile of extra cash to take advantage of discouraged and uninformed stockholders. So where does all of this leave us? The paradoxes, the conflicts, the good examples, the bad ones? It all boils down to one fundamental lesson about what it really means to own a piece of a company. We have to remember the basic structure here. It's simple, really. Legally, corporations are the property of stockholders, period. The management team and the board of directors are not the kings of the castle. They are trustees.
They have a legal duty to act solely on behalf of the owners. That is their one and only job in that role.
And this quote just ties it all together perfectly. Being a stockholder isn't like buying a lottery ticket, where you just sit back and hope. The purchase is just the first step. True ownership is a continuing process. It's about exercising the care, the judgment, and the watchfulness that comes with owning something valuable. It means you have to pay attention to how your property is being managed. Your silence can be, and often is, mistaken for approval. And that leaves all of us with one final crucial question to think about with our own investments. It's not just about picking the right company to buy. It's about what you do after you buy it. So you are an owner. The only question left is, are you acting like one?
You know, in a world that is just obsessed with those big, flashy profit headlines, we're going to ask a slightly different question today. Is a company's strength just an illusion? Right here on The Explainer, we're going to go way beyond the income statement to uncover the hidden truths tucked away inside the balance sheet. So, let's start our investigation.
I mean, we've all seen this, right? A company drops a press release with record profits, and boom, the stock just soars. It feels like such a safe bet. But what if those profits are just a smokescreen? What if the real story, the one that could actually predict a company's collapse, is hidden in a document that, let's be honest, most investors just gloss over?
And really, this is the core idea we're digging into. Think of the income statement like a report card. It tells you how a company did over, say, the last quarter. But the balance sheet, that's the full physical exam. It reveals the underlying health, the financial muscle, and any of those hidden diseases that could end up being fatal.
So here's how our investigation is going to unfold. First, we're going to assemble our analyst toolkit. Then, we'll visit the scenes of some past financial meltdowns to spot the warning signs. We'll learn how to really question those reported earnings to see if they're telling the whole truth. We'll even dive into this really weird paradox of how losing money can somehow be a sign of strength. And finally, we'll see if these old-school detective methods can still crack cases in today's crazy fast markets.
You know, every good detective has their go-to tools. For a financial analyst, some of the most powerful ones are just a handful of pretty simple ratios. Now, these aren't just numbers, they are the questions we ask the balance sheet to get a quick read on a company's vital signs.
So our first tool out of the box is the working capital ratio. The easiest way to think about this is as a company's short-term survival check. We just take all the assets they could turn into cash within a year and stack them up against all the bills they have to pay in that same year. It's a really simple but incredibly powerful snapshot of their immediate financial health.
And the classic rule of thumb, especially for industrial companies back in the day, was a 2-to-1 ratio. Basically, for every $1 of bills coming due, you wanted to see at least $2 of short-term assets ready to pay them off. Now, it's not a rigid law or anything, but it is still a really useful benchmark. If a company is falling way below this, well, you need to take a much closer look.
Okay, next up is a much tougher exam, the acid test ratio. The key difference here is what we take out of the equation, inventory. And why do we do that? Well, because in a real crisis, a warehouse full of products might be next to worthless. This ratio asks a really critical question. If revenue just dried up tomorrow, could the company survive? A yes to that question, well, that reveals some true financial resilience.
All right, so we've got our tools. Now let's actually put them to work. We're going to head to the scene of some historical financial dramas to see how these simple checks could have flagged trouble way before it ever made the headlines.
You know, financial disasters almost never happen overnight. They almost always leave a clue, and it's usually this: a sudden pileup of debt. Now look, a company taking on new loans isn't automatically a bad thing, but it's for sure a reason to start asking some pretty tough questions. And the most important question is always this: why do they need the money?
Our first case study, Stokely Brothers, all the way back in 1937. Take a look at those rising liabilities. That borrowed money was being poured directly into inventory that just wasn't selling. This is a textbook warning sign. They were taking on debt not to grow, but literally just to stay afloat. The dividend suspension that came next, well, it was pretty much inevitable.
Now, let's compare that to Douglas Aircraft in the exact same year. Their debt also shot through the roof, which at first glance looks pretty alarming, but the context here is totally different. See, Douglas was borrowing to fund a huge wave of profitable new orders. This was debt being used as a bridge to future growth, and sure enough, a year later, the loans were paid off and the company was thriving. The lesson here is so crucial. It's not the debt itself that matters, it's the purpose behind it.
And this This brings us to a really fascinating twist in our investigation. What happens when the most obvious piece of evidence, the reported earnings that everyone is watching, is actually the most misleading thing of all?
Okay, so let's look at a case where the evidence itself is the problem. U.S. Industrial Alcohol's income statements from the Great Depression, well, they paint a picture of incredible resilience. For an entire decade, they reported consistent profits, adding up to nearly $7 million. To any casual observer, this company looked like a fortress.
But the balance sheet tells a completely different story. While they were claiming $6.7 million in profits, they also made almost $9 million in charges directly against their earnings, totally bypassing the income statement. And the most damning evidence? Their working capital didn't grow. It actually shrank by over $3 million. You add to that the $6.5 million they raised from selling new stock, and the reality is a staggering $9.7 million hole in their finances. The profits were an illusion. The company was slowly bleeding out.
All right, now for my favorite part of this whole thing, a case that is so counterintuitive, it just turns our basic assumptions completely upside down. We're about to see how a company can report losses to the world, yet secretly become much, much stronger.
So here we have Manhattan Shirt Company, right in the worst years of the Depression. Their income account tells a pretty grim story. Between 1930 and 1932, they reported a total loss of over $364,000. I mean, it looks like they're just another casualty of the economic collapse.
But this is where a real detective digs deeper. Instead of just looking at the accounting value, they'd estimate the liquidating value, what the company's assets would actually get in a real-world sale. And what they'd find is just astounding. The liquidating value per share actually went up during this period of so-called losses. The income statement was shouting failure, but the balance sheet was quietly revealing a success story.
So how in the world did they pull this off? Well, they aggressively converted their assets, their inventory, their receivables, into cold, hard cash. It's like this. Imagine you have a garage full of old furniture that you've got valued on your books at $5,000. You expect you'll maybe get $2,000 for it at a garage sale, but you end up making $4,000. On paper, you lost $1,000, but in reality, you are $2,000 richer than you expected to be. That's exactly what Manhattan Shirt did. They were so efficient at liquidating their assets that they created real value for shareholders even while the income statement was showing a loss. It is a total masterclass in financial strategy.
Now, I know what you're thinking. All of these examples are from the 1930s. It's easy to think, sure, that was them. But markets are efficient now. Computers have fixed all this. But have they really? Let's see if our detective's handbook still works here in the 21st century. As modern value investor Nancy Zimmerman points out, the game really hasn't changed. The core mission is still exactly the same. Find those disconnects between price and reality. Sure, the tools are faster, the data is bigger, but human behavior still creates these little pockets of inefficiency in the market for a patient analyst to find. Just take this 2018 example from General Electric. So they had two nearly identical bonds, one in US dollars and one in euros. Now logically, they should have been priced about the same, once you account for the currency exchange. But they weren't. The dollar bond was cheaper, and it offered a better return. This wasn't because of GE's financial health, it was just a market quirk. And for the analyst who actually did their homework, this was a clear opportunity.
And this brings us to the ultimate lesson, which is just so beautifully summarized by Graham's most famous student, Warren Buffett. The work of a true analyst isn't about constant action. It's about diligent preparation and just immense patience. You do the hard work of reading the balance sheets, understanding the real financial strength of a company, and then you just wait for the market to make a mistake and serve you up that perfect opportunity.
And so we end with this question for you. In a world that is completely dominated by high-frequency trading and algorithms that are all focused on income statements and price patterns, the balance sheet, it remains a source of truth. It's quieter, yeah, and it takes more work to understand, but it holds the real secrets. The only question is, are you willing to do the detective work to find them?
You know, when you buy stock in some hot new company, you probably think your money is going straight into building the business, right? You're funding innovation, you're funding growth, you're funding the future. But what if I told you that a huge slice of your investment pie could be gone before the company even gets started? We're about to pull back the curtain on the hidden costs of financing that can make a seemingly great deal surprisingly expensive.
So let's just ask that question flat out. What are you really paying for? because it's definitely not just for the company's assets or its brilliant business plan. As we're about to see, you're also paying for management, you're paying for the deal itself, and you're paying for a whole lot more that's often buried deep in the fine print.
Okay, so to really get our heads around this, we have to jump in a time machine. The year is 1929. The Roaring Twenties are in full swing, and the stock market feels, absolutely unstoppable. And it's in this crazy atmosphere that a massive new company comes on the scene, promising the public a piece of the booming oil industry, the Petroleum Corporation of America. I mean, it looked like a total can't-miss opportunity.
Now, just take a look at this setup here. The public pours in over $100 million. That is an enormous sum of money, even today, let alone back then. But pay close attention to that last point. The promoters, the guys putting this whole deal together, they didn't just get a simple fee. Oh no, they got something way more valuable: warrants. Think of these like golden tickets to buy over 1.5 million more shares at a guaranteed low price down the road, no matter how high the stock goes. And we're about to see exactly why these warrants are so important.
Because as it turns out, that massive investment from the public, well, it wasn't quite what it seemed. There were three distinct and largely hidden costs that investors were on the hook for right from the very beginning.
So here's the crucial thing to understand. Investors weren't just putting money into an oil company. They were paying for the privilege of being managed, and that payment came in three different and often invisible forms. Let's break down exactly what they were.
This image here kinda gives us a preview of the total damage. The original analysis broke down exactly where the public's money went. And as you can see, it added up to over $26 million in costs before the company had even bought a single barrel of oil. So let's go through these one by one.
All right, cost number one is the most straightforward one. The public paid $34 a share, but the company itself, it only got $31. That $3 difference, that's what's known as the financing spread, and it went directly into the pockets of the bankers and sellers as their commission. You multiply that across all the shares, and bam, that's nearly $10 million gone right off the top.
Now for the second cost, which is, honestly, a lot more clever. The warrants. Remember those golden tickets? They're a claim on the company's future success. But here is the trick. Their value doesn't just appear out of thin air. Imagine the company is a pie. The warrants are like a slice that's been secretly promised to the promoters before the pie is even served to you. That value is literally carved directly out of the shares investors thought they were buying.
And this chart just shows it perfectly. Look at the cash that actually made it to the company. Instantly, 1/6 of that value, almost $17 million, was legally assigned to the promoters' warrants. So for every dollar an investor put in, about 17 cents of its value immediately belonged to the insiders, not them. A huge chunk of their investment was just gone on day one.
And finally, cost number three. This is the gift that just keeps on taking. On top of all those upfront deductions, the company would of course have ongoing expenses. And this meant hefty management salaries and all sorts of corporate overhead would continue to be pulled from that investment pool over time, just eating away at the public's capital.
So when you add it all up, the financing spread, the value of those warrants, the future salaries, what's the total hit? It is a staggering 25 to 30%. Just let that sink in. For every $100 the public invested, between $25 and $30 was gone. Instantly. This wasn't some fee on future profits. This was an immediate sacrifice of their principal, the actual money they put in.
The source material just puts it perfectly, calling it an actual sacrifice of invested principal in return for management. Investors were paying a massive, massive premium for a management team before that team had even had a chance to prove they could deliver any value at all.
This whole situation really forces us to ask a much bigger question. How on earth was this even okay, let alone standard practice? Well, the answer lies in this fundamental shift in what an investment banker was, from a trusted agent for the public to a self-interested promoter.
Yeah, this slide just lays it out so clearly. Traditionally, a banker was like your trusted inspector, right? They represented you, the buyer, and made sure you got a fair deal on a solid, established company. But in the 1920s, that completely flipped. Bankers started creating the companies themselves. They became both the seller and the management. They were sitting on both sides of the table, setting their own massive compensation with nobody there to push back. The conflict of interest was just baked right into the system.
And this quote just nails it. The banker was no longer some neutral middleman. As the source says, in an important sense, he is raising funds from the public for himself.
Now you might be thinking, okay,
That petroleum corporation was a one-off, a crazy deal from a crazy time. But the thing is, this model of completely lopsided deals, it kept going long after the crash. Let's look at a couple more of these cautionary tales from the 1930s.
So first up, we have the American Bantam Car Corporation. In 1936, a group of organizers bought the assets of a bankrupt car company for just $5,000, a mere $5,000. Then they immediately turned around and launched a brand new public company based on those exact same assets.
Okay, this table is just wild. Look at these numbers. The promoters put in about $5,500. The public put up $1 million. But here's the insane part. The deal was structured so that the promoters' tiny investment had to multiply 180 times, turning their $5,000 into over $1 million before the public even had a chance to make any real profit. I mean, the public took on virtually all of the financial risk for almost none of the potential reward. It's a classic heads I win, tails you lose setup.
And here's the sequel. It's predictable, but it's still shocking. A few years later, the public investors had lost 70% of their money. Their $1 million investment was suddenly worth just $300,000. And the organizers, their initial $5,500 bet was now worth $250,000. So the public gets wiped out, while the promoters still walk away with a fortune. It's just unbelievable.
And our second example, from 1939, the Aeronautical Corporation of America. And wouldn't you know it, it's the same story all over again. In this case, the combination of high selling commissions and those valuable warrants for insiders ate up more than 1/3 of every single dollar the public invested. So the effect of all these upfront costs was just brutal. Think of it this way. So many new shares and warrants were created for insiders that the public's ownership stake got heavily watered down. It got diluted. An analysis at the time showed that even if this company became a massive success, the public's investment could at best only gain about 16%. Their potential profit was capped, while their potential loss was, of course, 100%.
So after laying out this pretty clear pattern of exploitation, the author of our source material comes to a pretty stark, and you might even say drastic conclusion about this entire practice.
Here it is, the author's final verdict, and it's pretty radical. The argument is that this whole model of funding new, unproven companies with public money is fundamentally broken. The huge upfront selling costs cripple these companies right from the start. Risky new ideas, the author says, should be funded by private capital, by people who can actually afford that kind of risk, not by the general public. And most importantly, simply disclosing these lopsided deals in some dense legal document, that's not real protection. It's just a loophole.
And this brings us right back to today. The names have changed, the companies are different, the regulations have been updated, but it leaves us with a really critical question to think about. Decades later, in a world of SPACs, IPOs, and crypto, are everyday investors still paying hidden costs that they don't fully understand?
All right, let's get right into it. We're about to pull back the curtain on one of the greatest financial capers of the 20th century. Seriously, it's a story packed with ambition, a whole lot of illusion, and a financial magic trick so potent it let two brothers build a multi-billion-dollar empire using almost none of their own cash. So this is the big question, right? How is that even possible? I mean, it sounds like the plot of a heist movie, something totally made up. But the thing is, this actually happened. Back in the Roaring '20s, this supercharged, wild time, a couple of brothers from Cleveland cracked the code. Now, they didn't invent the technique, but boy, do they perfect it. They built a financial structure so massive and so incredibly shaky that when it finally came down, the crash was heard all across the country. And the secret weapon they used was something called corporate pyramiding. Now, forget the boring textbook definition for a second. A better way to think about it is like a set of those financial Russian nesting dolls. You know, you create one holding company and you use it to control a second company. Then that second company controls a third and a fourth, and on it goes. And here's the magic part. You only need to own a little over 50% of the company at the very top of the pyramid to control everything underneath it. It's the ultimate power move, the ultimate form of leverage. And as we're about to see, it is absolutely a double-edged sword. To really see how this works, we need to meet our masterminds, the brothers, OP and MJ Van Swearingen. And you know, these guys weren't your typical Wall Street titans, not at the beginning anyway. They were real estate developers who kind of stumbled into the railroad business, and then discovered they had an absolute genius for financial engineering. They would go on to become the poster children for the incredible power and the devastating peril of the corporate pyramid.
Okay, so what's so fascinating here is that this timeline lays out their entire playbook. Look at this. It kicks off in 1916. They buy an $8.5 million railroad, but the $2 million down payment, they borrowed it. From day one, they were playing the game with other people's money. Then they hit the accelerator. They create these private, kind of shadowy corporations just to snatch up more railroads. But here is the truly brilliant part. By 1923, they start using the cash and the credit of the railroads they already control to buy even more railroads. It's like a snowball rolling downhill, just getting bigger and faster. By 27, they need more cash, so what do? They turn to you, to the public, selling stock in a new holding company. And then the final grand move in 1929, creating the Allegheny Corporation. This was the capstone on their pyramid, the one massive company designed to rule over everything else. So the key thing to realize is this. It wasn't just random luck. It was a repeatable four-step process. Step 1, set up shell companies for your takeovers. Step 2, use your existing company's money to buy new ones. Basically, make the empire pay for its own expansion. Step 3, when you squeezed everything you can from the inside, you tap the public markets. You let everyday investors like you and me fuel your growth. And then the final step, you consolidate it all under one massive umbrella corporation to keep an iron grip on control. I mean, it was just breathtakingly audacious. For years, nobody really understood what was going on because the empire was just so complex. But then came the smoking gun. This table from a 1930 report to Congress just ripped the curtain back. It looks like a simple 2-column ledger, but it tells you everything you need to know. On the left, you see the percentage of voting control the brothers had, and on the right, that's how much of the company's actual capital, their own skin in the game, they had invested. And the huge, cavernous gap between those 2 columns, well, that's where the real story is. And this chart just hammers the point home perfectly. Let's just pull one company out of that report, Père Marquette. The bar on the left shows their control, 100%. Total, absolute, unquestioned power. Now look at the bar on the right. That's their actual ownership stake, less than 1%, not even a penny on the dollar. Think about that. They had all the power, they got all the upside, but if the company went belly up, they stood to lose? Almost nothing. It's the magic trick in its purest, most extreme form. Maximum control, minimum risk. So they built this incredible pyramid. But to keep the whole thing going, to keep investors buying stock and pushing those prices higher and higher, they needed to make the companies inside the pyramid look like unstoppable profit-making machines. And that required a whole other level of financial artistry, a deceptive toolkit, if you will, filled with accounting tricks designed to create a powerful illusion of wealth. Let's start with the first and probably the most fundamental trick in the book. Just manufacture the earnings. I mean, it's pretty simple. If the numbers on your income statement look great, people are going to buy your stock. The real challenge was figuring out how to create those incredible numbers on paper without actually generating much new cash in the real world. And they had a couple of truly genius ways of doing this. First, let's say one of their smaller companies paid a dividend, but instead of paying in cash, it paid in the form of more stock. Well, the parent company would then record that stock as income, valuing it at its highest recent market price. This created massive paper profits without a single real dollar ever changing hands. The second method was even more shameless. They'd have company A sell some stock to company B, both of which they controlled, by the way, and then book the difference as a profit for the main holding company. It was literally like taking money from your left pocket, putting it in your right pocket, and then calling it income. All right, the next sleight of hand was all about making the stock feel more profitable to the average person on the street. Remember, in the 1920s, stock prices were going ballistic and everybody was chasing huge returns. So the trick was to give them the feeling of getting rich, even if the company itself wasn't really earning all that much.
So as we just saw, they'd pay dividends in stock instead of cash, but they also did something else. They constantly issued subscription rights. You can think of these as basically coupons that let shareholders buy more stock at a discount. In a roaring bull market, these rights were like gold. Speculators treated them like free money. And just look at the example of American and foreign power. Its stock price more than quadrupled, not because its earnings went up that much, but because it was just showering the market with these rights, creating an absolute frenzy of buying.
And now we get to the grand finale of their deceptive toolkit. This was by far the most sophisticated trick. This was the one that literally created billions of dollars in phantom value completely out of thin air. It all had to do with manipulating the book value, the supposed underlying worth of a company's assets. So this quote right here explains the whole game.
Let's break it down. Say your big holding company owns 95% of a smaller subsidiary. That means only 5% of that smaller company's stock is actually out there for the public to trade. This is what's called a thin float, and it's incredibly easy to manipulate. The insiders could use just a tiny bit of money to bid up the price of that tiny 5% slice. Then they could turn around and, with a straight face, revalue their own massive 95% stake at that new artificially inflated price. And just like that, poof, they'd instantly add millions or even billions to the parent company's balance sheet. And if you want to see the most spectacular example of all this at work, look no further than the American and Foreign Power Company. Just check out this table. It shows the company's actual real earnings available for its common stock. In 1926, it was about $218,000. By 1929, it had grown to about $6.5 million. Now, that's impressive growth, don't get me wrong, but that was reality. What Wall Street did with that reality was something else entirely. Wall Street took that $6.5 million in earnings and, using all the tricks we've been talking about, especially manipulating value through warrants and that thin float, they spun it into a total market valuation of $1.5 billion. Just let that sink in for a second. A company earning $6.5 million was valued at $1.56 billion. That's a price-to-earnings ratio of 240, at a time when 15 or 20 was considered high. It was a valuation completely and utterly detached from planet Earth. You see, a structure built on leverage and illusion can only stay standing as long as the market keeps believing in that illusion. And when the great crash of 1929 finally shattered that belief, these pyramids, they didn't just fall over, they imploded. The very same leverage that created unimaginable fortunes on the way up, well, it absolutely annihilated them on the way down.
And you know, the most incredible part of this whole story is that it was entirely predictable. This was not a new thing. A nearly identical railroad pyramid, the Rock Island Company, had already gone through this exact same boom and bust cycle. It collapsed in 1915 and completely wiped out its common stockholders. The dangers were known, the playbook was understood, and yet barely a decade later, the market eagerly lined up to buy tickets for a bigger, more spectacular sequel. And this right here, this just shows you the carnage. Here's our star performer, American and Foreign Power, just 4 years later in 1933. It's on the verge of bankruptcy. The safest investment you could have made, the senior bonds, had lost 60% of their value. The preferred stock was nearly worthless. And the common stock, the stuff that had flown so high, wiped out, gone. The $1.5 billion mirage had completely vanished, leaving behind a wasteland of very real losses for thousands of investors. And yet this is where it gets truly bizarre. Even in the depths of the Great Depression, with the company totally insolvent, the market's speculative fever hadn't entirely broken. Get this, the company's warrants, which were basically just long-shot lottery tickets to buy stock that was essentially worthless, had a combined market value of $48 million. This was more than twice the market value of the company's senior bonds, the securities that had the first claim on any actual assets. It's a perfect snapshot of a market completely divorced from any kind of logic. The sheer scale of this destruction was a national trauma. The collapse of these utility and railroad pyramids wasn't just some dry financial story. It was a huge political one. It forced a national reckoning and led to some of the most sweeping financial regulations in American history, leaving a legacy that we are still living with today. Yeah, Washington had to step in. The result was the Public Utility Holding Company Act of 1935. This thing was a direct assault on these kinds of structures. It famously contained what became known as the death sentence clause, which forced these insanely complex, multi-layered holding companies to either simplify their structures or be broken up. It effectively outlawed the creation of new pyramids in the utility space, tearing down the very playground the Van Swearingens and others had perfected. But the source material leaves us with this one final chilling observation, and it really is a powerful warning about human nature and financial markets. After that Rock Island collapse in 1915, investors had about a decade to forget the pain before they jumped right back into the Van Swearingen pyramid. Time and time again, it seems the lessons of one bubble are forgotten just in time for the next one to start inflating. And that really brings us to our final thought. The specific type of pyramid from the 1920s, well, it was legislated out of existence. But the underlying forces, that hunger for leverage, the allure of complexity, the belief that, hey, this time it's different, those things never, ever go away. So the question we're left with is this. Are the financial wizards of our own time just using new technologies and new instruments to build different kinds of pyramids? Dazzling new structures that maybe we won't fully understand? until they too come crashing down?
Welcome to the Explainer. So, how do the pros look at two competing companies and just know which one's the better bet? Well, it's not a gut feeling, and it's definitely not magic. It's a specific technique. Today, we're going to pull back the curtain on that exact method so you can learn how to spot hidden value and, just as importantly, avoid those hidden risks by comparing companies head-to-head.
You know, this is the classic dilemma. You've got two businesses, they're in the same industry. On the surface, they might even look identical, but if you dig just a little deeper, you might find that one is a future superstar while the other is, well, a ticking time bomb. The key to telling them apart is a really powerful method called comparative analysis. It's all about changing your perspective. You stop looking at one company in isolation and start seeing how it really stacks up against its rivals.
So, here's our game plan for today. We're going to start with the fundamental problem that every analyst faces. Then, we'll build out the financial X-ray toolkit they use to see what's really going on. After that, we dive into the history books for two really fascinating case studies. First, a wild boom and bust story from the railroad era, and then a head-to-head battle in the steel industry. These stories are going to lead us to a critical rule for when this kind of analysis works and when it doesn't. And then we'll wrap it all up with a final, crucial piece of wisdom on the human element in all of this.
Okay, so what is the big idea here? It's actually surprisingly simple. You never ever study a company in a vacuum. By putting it right next to its direct competitors, you create this background that suddenly makes its strengths and weaknesses just pop. That context is everything. It shows you opportunities and dangers that are completely invisible when you're just looking at one company all by itself.
And this is our core tool. Think of it as a system for answering some really important questions like, is this stock a bargain or am I about to get ripped off? Is it actually outperforming its peers or is there a stronger horse to bet on in the exact same race? See, this isn't about gut feelings anymore. It's about replacing pure guesswork with a structured, data-backed approach.
Right. Now, a good comparison isn't about just picking random numbers and hoping for the best. To do this right, you need a consistent framework, a set of what you could call standard forms that let you look under the hood of any company and see the same parts in the same order. So let's break down the essential pieces of that toolkit. This three-part checkup is really the foundation of any good analysis. First up, capitalization. How is the company actually funded? Is it built on a mountain of debt, or is it funded by shareholder money? Second, the income account. Is it actually making a profit from its day-to-day business? And third, the balance sheet. What does it own versus what does it owe? Together, these three things give you that complete financial X-ray we were talking about.
All right, that's enough theory. Let's see what this actually looks like out in the real world. A good historical case study can show us both the incredible power of this method and, how badly it can all go wrong. For our first example, we're going to jump back in time to the Roaring '20s to look at a dramatic tale of two railroads.
So on one side, we've got Union Pacific, a massive, conservatively run company with a really stable financial structure. And on the other side, we have the Chicago, Rock Island, and Pacific Railway, a company with a much more speculative, high-leverage financial setup. They're both in the same business, but their whole approach, it's just worlds apart.
So, in the boom years between 22 and 27, the market was just on fire. Business was getting better for both railroads, but something absolutely wild happened with their stock prices. Rock Island, with its risky, high-leverage structure, didn't just rise, it launched itself into the stratosphere. Just look at that number. Over 1,100%. Rock Island's earnings per share shot up by an unbelievable 1,158%. Now, to put that into perspective, the steady, conservative Union Pacific, it grew by a very respectable 26%. That's the difference leverage makes. In the good times, it's like strapping a rocket engine to your company. But that rocket engine had a fatal flaw. When the economy turned and the Great Depression hit, the exact same leverage that created that spectacular rise, well, it triggered an equally spectacular collapse. By 1933, Rock Island's earnings had completely vanished. Its stock was worthless. The company went bankrupt. And Union Pacific? The steady, conservative giant was still standing, having weathered the storm just fine. And here it is, the critical lesson. These two railroads were never truly comparable. Their financial DNA was just so different that comparing their stock performance was like comparing a racehorse to a ticking bomb. The very same thing that made Rock Island look like a genius investment in the boom guaranteed its failure in the bust.
So, that was our cautionary tale about comparing apples to oranges.
Now let's see what happens when we find a true apples-to-apples situation. We're going to jump forward to 1938 for a head-to-head matchup between two nearly identical steel companies.
Okay, meet our contenders, Continental Steel and Granite City Steel. At first glance, these guys seem like twins. I mean, they were trading at the exact same stock price, $17 a share. Even their net tangible assets were almost identical. By all accounts, these were true peers. But when you start digging into the operational numbers, a very different story starts to emerge.
And the conclusion was just unmistakable. When analysts ran the numbers, Continental Steel was the clear winner, right across the board. It had higher earnings, better profit margins, a stronger financial cushion, it even paid a dividend while Granite City paid nothing. This is the power of a true apples-to-apples comparison. The data clearly points you to the superior business.
This tale of two different industries, the railroads and the steel companies, it brings us to a really critical principle, something we can call the homogeneity test. Basically, the reliability of your comparison depends entirely on how similar the companies you're studying truly are.
And this illustrates the difference perfectly. In what we call homogeneous industries like steel or cement, the companies are kind of like rowboats in the same current. The tide of the economy tends to lift or lower all of them in a similar way. This makes their past performance a pretty reliable guide. But in heterogeneous industries like automakers or tech, it's more like a demolition derby. One company's success often comes directly at the expense of another's failure, and that makes these comparisons way less reliable.
So the takeaway is pretty simple. The more of a demolition derby your industry is, the less you can rely on the past numbers alone. And that's when you have to start asking those qualitative questions that don't show up on a balance sheet. How good is the management team? Really? What's their track record? Does this company have a powerful brand or some crazy new innovation that nobody else can match? These factors become absolutely crucial.
And that leads us to our final and maybe our most important lesson about using these powerful analytical tools. The data can tell you a lot for sure, but it can't tell you everything.
I love this quote because it's just so realistic. Look, analysis is not about finding a crystal ball. It's about shifting the odds in your favor. It's about replacing a wild guess with an educated one. You're not always going to be right. Nobody is. But over the long run, a disciplined process will always beat pure luck.
And that's really the ultimate lesson, isn't it? Comparative analysis is a powerful tool that sharpens your judgment, but it can never, ever replace it. The numbers give you the map, but you, the analyst, the investor, you still have to drive the car. Thanks for joining us for this explainer.
Welcome to The Explainer. Today, we're going to dig into one of the most fundamental questions in all of finance. Why does a company's stock price so often seem completely disconnected from its actual real-world value? We're going to explore why these gaps open up, and more importantly, how a sharp analyst can actually find them. So let's just start with the big one. Is the market always right? I mean, it's a question that really challenges the whole idea of an efficient market. If stocks were always priced perfectly, then these huge gaps we're going to be talking about, well, they just couldn't exist. The source material we're diving into today argues that the market isn't some perfect, all-knowing machine at all. And there you have it, straight from the text. The market isn't a calculator. It's a reflection of us, of human psychology. It's driven by our hopes, our fears, and yeah, our big mistakes. And you know what? That psychological element, that's the absolute key to understanding why prices can get so out of whack with reality. All right, here's our game plan for this explainer. We're going to start by getting inside the market's head, then we'll look at the big up and down cycles, and then the fun part, digging for individual hidden gems. We'll also cover how to profit from market freakouts, look for value beyond just stocks, and then wrap it all up with the value investor's ultimate secret weapon. Okay, let's jump right into this first section. If the market makes mistakes, we've got to ask why. What's causing these errors? It's not totally random. It turns out these blunders are actually rooted in some very basic, very human tendencies that we see over and over and over again. You know, most of the market's biggest blunders really boil down to one of these three things. First up, exaggeration. That's our tendency to take recent news, good or bad, and just blow it completely out of proportion. Then there's oversimplification, where we try to squeeze really complex situations into nice, neat, simple little stories. And finally, there's neglect, which is when the market just completely ignores perfectly good companies just because they're not the hot new thing. Now let's see how these little psychological habits combine to create the most obvious gap between price and value there is. the market cycle. This is where you really see mass psychology playing out on a massive scale. This might sound almost too simple, right? But it's actually a really profound observation. The very essence of a bull market is that prices go too high, and the essence of a bear market is that they fall too low. Prices will always overshoot fair value on the way up, and they'll drastically undershoot it on the way down. The million-dollar question, of course, is, can an analyst actually use this knowledge to make money?
So in an attempt to make this systematic, people developed formulas, kind of like this one. And the logic, you have to admit, is perfect. First, you figure out a fair, normal price based on long-term performance. Then, you just mechanically buy when the market is pessimistic and everything's on sale, and you sell when the market is euphoric and prices get crazy expensive. Simple.
But, and this is a huge but, while the math is easy, the psychology is brutally hard. Can you imagine having the guts to sell all your stocks when your friends are getting rich in a roaring bull market just because your formula says so? Or what about buying stocks in 1931, watching them fall even more and having to keep buying? Sticking to a rigid system like this requires a level of emotional toughness that, let's be honest, most people just don't have.
Okay, so beyond those big market waves, some of the most incredible opportunities are found by looking at individual companies that the market has either totally misunderstood or just forgotten about. This is where the real detective work comes in. And let's look at one of the most mind-blowing examples from the source material. We're talking about the great A&P Tea Company. I mean, at the time, this was one of the largest, most successful, most iconic retail businesses in America. A true giant.
Now, just look at the data here. This is what's so amazing. A&P was an absolute powerhouse. It was a cash machine, just churning out huge sales and profits year after year. Get this, even right through the Great Depression. I mean, look how stable those earnings are.
And this slide, this right here, just shows how completely absurd the situation got. In 1938, the entire stock market valued the A&P enterprise, the brand, the stores, all of it, at $126 million. But here's the kicker. The company had $144 million in net current assets, that's mostly cash and inventory, just sitting on its books. Wall Street was literally saying this legendary business was worth less than zero.
And the A&P story wasn't just some one-off fluke. An analyst who did their homework could find whole lists of companies like this. Take a look at this first group. They were all selling for less than 7 times what they earned in a year, and their stock price was less than the value of their easily sellable assets. That's a true double bargain.
This second group represents an even deeper kind of bargain. These are companies that were selling for 2/3 or less of their net current asset value. Just think about what that means. It's like finding a store that sells dollar bills for 66 cents, and then as a free bonus, they throw in the entire business, the factories, the brand, all of its future earning power, for absolutely nothing.
So let's circle back and really dig into that first cause of market mistakes we talked about, exaggeration. Because this is where things get really interesting. The market doesn't just get things a little wrong. It often gets things wrong in the most spectacularly emotional, over-the-top way possible. You see, speculators are always looking for action. They need a story, an excuse to get excited and push a stock's price around. And these are some of their favorite pretexts. A company splits its stock, which, by the way, changes absolutely nothing about the company's real value, and the price just soars. A merger gets announced, and all of a sudden, in the market's mind, 2 + 2 = 5. This slide shows the wild unpredictability you can get with these smaller secondary stocks. It's a tale of 2 companies. On the left, you've got Butte and Superior. They posted absolutely incredible earnings. And the stock price? It barely moved. The market just neglected it. On the right, Mullen's Body had a nice little profit bump, but it caught the attention of market operators. It was exploited, turning into this speculative rocket ship that had nothing to do with the business itself. It stopped being a company and just became a symbol on the ticker tape. And this whole exaggeration thing, it works in the other direction too. Wall Street absolutely hates lawsuits. The mere mention of litigation can send a stock price into a nosedive, often way, way more than is justified by the actual legal risk. And this creates a fascinating kind of opportunity, where a tiny legal claim can cause a huge, mathematically provable undervaluation for the analyst who's willing to do the homework. You know, this search for value isn't just about common stocks. The exact same market psychology that messes up stock prices
also creates some incredible bargains in what are called senior securities. We're talking about things like bonds and preferred shares, the investments that are supposed to be safer and more stable.
This step-by-step breakdown shows the perfect example of the market just not paying attention. So Youngstown buys steel and tube. After the deal, Youngstown is responsible for all the debt from both companies. But here's the key. The steel and tube bonds were secured by a mortgage on actual property, making them safer. Youngstown's own bonds were unsecured. Logically, the safer bond should offer a lower interest rate, a lower yield. But the market got it completely backwards.
The numbers here are just undeniable. The market was paying investors a higher yield, 6.85%, to own the safer of the two bonds, while only offering about 6% for the riskier one, from the exact same parent company. This is a clear-cut arbitrage opportunity, basically a risk-free profit that existed simply because the market failed to understand what was going on.
So, what's the big takeaway here? All of these examples, the market cycles, the hidden gems like A&P, the illogical bond pricing, they all point to the security analyst's true advantage. It isn't about predicting the future. It's not about guessing what the market's going to do next week.
The analyst's real edge is applying cold, hard, quantitative discipline in an arena that is absolutely dominated by emotion, by exaggeration, and by neglect. And that brings this whole lesson right to our doorstep today. The principles haven't changed a bit, but the challenge is still the same. In today's 24/7 world of breaking news and screaming headlines, can you maintain the fortitude to tune out all that noise, do the work, and see the real value that everyone else is missing?
Hey, welcome. Let's talk about something that's always fascinated me, the weird, sometimes totally illogical gap between what something costs and what it's actually worth. It's a puzzle that has made people fortunes and honestly has exposed some huge flaws in how we think about investing.
This quote, it just nails it. It perfectly captures that human tendency to trust a big, familiar name over what the cold, hard numbers are telling us. And that habit of clinging to an investment way past its expiration date, well, that's the engine that creates the market weirdness we're about to dive into.
So, here's what we're going to cover. We'll start with the big picture, the price versus value problem. Then, we'll get into these two personalities of stocks and bonds, the seasoned veteran and the rookie. After that, we'll look at the dangerous game of comparison, find some totally obvious market glitches, and wrap up with a wild story where the safest thing you could buy was also the biggest bargain.
Okay, let's kick things off. To really get a handle on these price gaps, it helps to think of securities as having one of two different personalities in the eyes of the market. Right, so you've got the established, well-known player, the company everyone's heard of, whose reputation is rock solid, and then you have the new kid on the block, the volatile up-and-comer. Just understanding how differently the market treats these two is the first step to seeing opportunities that, trust me, most people just don't. All right, so let's give these two personalities their proper names. We're talking about seasoned versus unseasoned securities. And this is where we'll see how a company's reputation can go head-to-head with financial reality and create some really interesting situations. First up, the seasoned issue. Now, what's super important here is that this isn't about how long the stock itself has been around. It's all about the company's reputation. Think of a household name, a brand that's been respected for ages. Their stocks and bonds are considered seasoned, and that good name becomes a massive force that props up the price. And this is where things get really interesting. Seasoned issues have something you could call price inertia. Their great reputation acts like this giant cushion keeping the price stable even when the company's financials are starting to look pretty shaky. Unseasoned issues, they're the complete opposite. They've got price vulnerability. Even a whisper of bad news can cause their price to just fall off a cliff, often way more than it should. To really see this inertia in action, let's jump into Time Machine and look at a perfect historical case, the United States Rubber Company. This was a giant in its day, a name everyone knew and trusted, a classic seasoned issue. But that trust made a lot of people blind to what was actually happening under the hood. Just look at these numbers from back then. For 2 straight years, the company was earning just enough to pay its bills, literally 1 times its obligations. And for a non-cumulative preferred stock, which means if they miss a dividend, they don't ever have to pay you back for it, that is a massive, massive red flag. There was basically zero room for error. Analytically, this thing was risky. But get this, here's the crazy part.
Even with those terrifyingly thin earnings, the stock was trading as high as $109 a share. 109. That is the definition of people buying on reputation alone, completely ignoring the flashing warning signs in the financials.
Now, on the flip side, you have the unseasoned issues. We're usually talking about smaller industrial companies that don't have that long public track record. Because they're so fragile, the author gives a pretty stark warning. Don't buy these things as a safe, straightforward investment. But, and this is the key, the real opportunity pops up only after they get totally hammered and fall into what's called a frankly speculative price range. Think like below 70 cents on the dollar. Okay, next up is a tool that pretty much every investor uses. Comparison. I mean, it seems so simple, right? Just find something better and make the switch. But as we're about to see, this simple idea can be a really deceptive trap if you're not careful. Here is the golden rule, and you absolutely have to remember this. You should never recommend a switch just because Company A is a little better than Company B. You have to be totally convinced that Company A is a genuinely good investment all by itself. If it's not, you're just treating one mediocre situation for another. Now, this is a perfect example of doing it right. Back in 1932, Ward Baking's bonds were not only way stronger than Bethlehem Steel's on paper. I mean, look at that interest coverage difference. The crucial part is that they were also strong enough that you'd be happy to buy them on their own. That's what makes the comparison valid. But now for the trap. In this case, sure, Spear & Company's preferred stock had better stats than Republic Iron and Steel. But when you looked at Spear & Co. in isolation, its own financials just weren't that great. Recommending a switch here would be a classic mistake. You're just moving your money from one questionable investment to another. Okay, now we're getting to my favorite part. We're moving beyond opinions and into discrepancies that are so obvious, they're basically mathematical proof. These are those rare moments when the market's pricing literally makes no sense. These are the absolute clearest opportunities you'll ever find. They happen when two securities from the same company, or securities that are legally tied together, are priced in a way that just completely ignores their contractual relationship. It's like the market forgot how to do basic math. Check this out. This Colorado industrial bond was guaranteed by another company, Colorado Fuel and Iron. It had to be paid off in full in about 14 months. If it wasn't, the preferred stock of the guarantor would probably be toast, worthless. And yet, the guaranteed, safer bond was trading for less than the much riskier preferred stock. That is a flat-out pricing error. And here's another one, just as wild. These Mobile and Ohio certificates had a dividend that was guaranteed by Southern Railway. That made them a senior obligation. They had to get paid. At the same time, they were selling for nearly 10 points less than Southern Railway's own preferred stock, which wasn't even paying a dividend. The safer, income-producing asset was cheaper. It makes no sense. We've saved the most powerful, the most mind-bending example for last. This is the ultimate market anomaly. A situation so bizarre, it flips the entire logic of risk and reward upside down. This is what happens when the absolute safest investment you can make becomes the cheapest. Just take a moment to let this sink in. A United States Liberty bond, backed by the full power of the U.S. government, was yielding more than a lower quality corporate bond from Union Pacific Railroad. The safer investment was offering you a higher return. In a rational world, this should never, ever happen.
So how on earth could this happen? Well, it had nothing to do with the quality of the bonds. It was all about human behavior. During the war, tons of people bought these bonds out of patriotism, and they often used bank loans to do it. After the war, they had to pay those loans back, which created this huge wave of forced selling. This massive selling pressure had nothing to do with value. It was a pure supply and demand shock that just temporarily broke the market's brain.
And that really brings us to the main takeaway. These gaps between price and value aren't just random static. They grow directly out of human psychology, out of inertia, bad comparisons, herd behavior, and strange market pressures that just overwhelm logic. And for the investor who's actually paying attention, these are the moments that create incredible opportunities. And that leads us to a final big question. The examples we looked at are from a century ago. Today, we have algorithms, instant information, high-frequency trading. So have these human-driven glitches disappeared? Or have they just found new, maybe more subtle, places to hide in today's market? It's something to think about.
What if I told you that for nearly 100 years, investors have been locked in this huge debate
a really fundamental argument about the right way to make money in the stock market. It all goes back to this classic book, Security Analysis, and it poses a question that's super simple, but also really profound. Are you trying to be a market timer, someone who predicts the future? Or are you a business analyst, just trying to understand what's right in front of you?
And look, this isn't some abstract academic question. Nope. This is the central dilemma that has split Wall Street right down the middle for decades. Can we, with any kind of real scientific certainty, actually predict where the stock market is headed? Or is this whole game just, well, a really sophisticated form of guesswork? Let's dig in and see what we can find out.
All right, so here's the plan. First up, we're going to break down the two opposing teams in this big debate. Then, we'll get into the book's really powerful case against trying to predict the market at all. After that, we'll look at the alternative, this cool concept called the margin of safety. And to wrap it all up, we'll see how these classic ideas really hold up in the crazy, globalized world we live in today.
Okay, so let's meet our two tribes of investors. You've got the forecasters and you've got the appraisers. I want you to think of it like this. They're both sitting at the same table, looking at the exact same game. But one of them thinks they're playing chess, and the other thinks they're playing poker. See the difference? The chess player thinks it's all about predictable moves and perfect information. The poker player? They know they're dealing with luck, missing cards, and a whole lot of human psychology.
And really, it all boils down to this one simple thing. The forecasters are obsessed with the word when. When should I buy? When should I sell? Their whole world is about trying to predict the future. But the appraisers, they're focused on a different question. What? What is this business actually worth right now, today? They're trying to understand the present. It's a totally different way of looking at the world.
Now, even inside the forecasters tribe, you've got two main factions. On one side, you have the chart readers. These are the folks who believe that a stock's past price tells you literally everything you need to know about its future. It's kind of like trying to predict tomorrow's weather by only looking at yesterday's forecast. Then you have the economic forecasters. They're looking at the bigger picture, interest rates, GDP, political stuff. They're more like meteorologists trying to build these super complex models of the atmosphere. For our purposes, we're going to focus on the chart readers because they are the purest form of this market prediction idea. Okay, so we've got these two very different philosophies. But here's where things get really, really interesting. The authors of this book, Graham and Dodd, they don't just say, we like this one better. No way. They take the whole idea of market forecasting, especially chart reading, and they just systematically dismantle it, piece by piece. Honestly, their argument is a total masterclass in logic.
So their case against charting really stands on four big pillars. First, they say, look, if this was a real science, wouldn't everybody be using it to get rich? And if everyone's getting rich, who's losing money on the other side of the trade? Second, where's the proof? Where's the long-term track record? Show me the billionaires who got there just by reading charts. Third, the whole idea that the past perfectly predicts the future. Is that really a bet you want to make with your entire life savings? And finally, and this is a big one, let's just say you do find a secret formula that works. Well, the second you start using it and other people catch on, poof, the advantage is gone. It's a self-destructing strategy.
And believe me, they do not pull any punches. They flat out say that a lot of people look at chart reading and see something that looks a whole lot more like astrology or, well, black magic than a serious financial strategy. That is not a gentle critique, right? That is a full-on takedown. It just shows you how deeply skeptical they really were.
Their analogy for it is just perfect. They say trying to use charts is like being a professional gambler at the horse track. Yeah, you can study the horse's past races, you can look at the jockey's record, check the weather, and you know what? You might even pick a few winners. But can you do it consistently enough, day in and day out, to actually make a living from it? The odds are just completely stacked against you. It might be a fun hobby, but it's not a reliable profession.
And you know what? They back it up with cold, hard data. Just look at this chart. It tracks U.S. Steel's earnings versus its stock price for nearly 40 years. Now, you'd think that when the company makes more money, the stock price should go up, right? That just makes sense. But look at it. It's all over the place. Sometimes earnings shoot up and the stock tanks. Other times, the exact opposite happens. It's chaos. It just goes to show the market has a mind of its own.
So, if trying to predict the future is basically a fool's errand, then what's the alternative? How are you supposed to invest with any confidence in a world you can't possibly predict? Well, the answer is the single most important concept in all of value investing. It's called the margin of safety. This right here, this is the bedrock of their entire philosophy.
The margin of safety is just a beautifully simple idea. I want you to imagine you're an engineer building a bridge. If you calculate that the bridge needs to hold 10 tons of weight, you don't build it to hold exactly 10 tons, do you? Of course not. You build it to hold 20 tons. That extra capacity, that is your margin of safety. It's your buffer, it's your protection against bad luck, against things you didn't see coming, or even against your own mistakes. In investing, it just means you only buy something when the price is so cheap that you have a huge cushion in case you're wrong. And this right here is the absolute key difference between the two approaches. Market analysis, the forecasting game, it's like walking a tightrope. You're either on the rope and you're right, or you fall and you're wrong. That's it. But security analysis, with a margin of safety, that's like walking across a wide, sturdy bridge. Yeah, you might stumble, you might even trip, but you're not going to fall off. It's a system designed to be resilient, not to be perfect.
Okay, so we've got this really powerful idea, the margin of safety. But that was all written a long, long time ago. How does a principle like that apply in our crazy, modern, totally globalized world? I mean, Graham and Dodd were writing when most investors barely looked past their own country's borders. Today, the investment universe is absolutely massive and interconnected, and that creates all kinds of new opportunities and a whole bunch of new risks.
Just look at this number for a second. It's staggering. Back in 1970, if you were an investor in the US, you could basically just ignore the rest of the planet and still have access to 70% of the world's stock market. But today, that number is down to 40%. The rest of the world has caught up in a huge way. So if you're not looking for great companies outside your own country, you're literally missing out on more than half the game.
And this chart is where it gets really exciting for a value investor. This shows how emerging market stocks have been valued compared to the US market. I mean, look at those wild swings. Sometimes they're dirt cheap, and other times they're insanely expensive. For a patient investor, someone who is willing to buy when there's panic in the streets, well, these moments of fear can be the opportunity of a lifetime.
But let's be real, it's not all sunshine and rainbows. Investing in other countries, especially in emerging markets, can be a really wild ride. The financial data you're looking at, it might not even be accurate. The currency could fall apart overnight. A new government could come in and just change all the rules on you without any warning. It's kind of like the Wild West of investing. And what that means is you need an even bigger margin of safety to protect yourself. So, we've seen how these core principles can still work in a global world. But what about the principles themselves? I mean, have they had to change over time? Think about it. The world of Graham and Dodd was a world of steel mills, factories, and railroads. Our world is a world of software, data, and social networks. The rules of the game might be the same, but the players have changed a lot.
You have to remember, Graham and Dodd lived through the Great Depression. They saw firsthand what happens when investors get swept away by hype and crazy stories. So naturally, they became obsessed with what they could physically touch and measure, things like factories, inventory, and cold, hard cash on the balance sheet. They just didn't trust anything they couldn't count. But today, I mean, the most valuable companies in the world don't own factories. They own code, brands, and customer loyalty. You can't figure out what a company like Apple is worth just by looking at its assets. You have to ask completely different questions like, how brilliant is the CEO? How strong is the brand? And are they making smart decisions with their money?
But here's the beautiful thing. Even though the types of companies have changed and the world has changed, the ultimate goal of value investing hasn't changed one bit. As a great modern value investor once put it, the goal is pretty simple: to eat well and sleep well. It's about making good money for sure, but it's about doing it in a way that lets you sleep soundly at night knowing you haven't taken any foolish risks. And that's a goal that will never, ever go out of style. So I guess I'll just leave you with this question to think about. In our world of high-frequency trading, super smart algorithms, and a 24/7 news cycle, does this old-school, slow and steady approach to investing even stand a chance anymore? Is this patient search for a margin of safety just a quaint, outdated idea? Or is it the one timeless advantage that the machines can never, ever replicate? What do you think?